take these statements into account as meaning that perhaps we got a slightly hazy but a view as far as de-escalation is concerned. Now, President Trump, of course, spoke, and we'll play out the sound bites. He said U.S. will be leaving Iran in 2 to 3 weeks. These are the latest comments which came in, and I think we played some of that on Power Breakfast as well. President Trump, by the way, is going to be addressing the nation, that is America, on the war with a war update. But this is going to be our time tomorrow morning, 6:30 a.m. tomorrow morning. And we'll see what he says. The news story which really sparked a wave of optimism, and this happened yesterday, was the Wall Street Journal report which said that President Trump is considering ending the war with Iran without reopening the Strait of Hormuz. Actually, the exact quote was this, right? Actually, he was asked about the Wall Street Journal story earlier last night, and this is what he said. He said, my sole function was to make sure that they don't have a nuclear weapon. They're not going to have a nuclear weapon. When we leave, the strait will automatically open. And of course, he said a bunch of other things as well, that, if you want the oil, go get the oil and things like that, right? Take this. He basically urged other countries to take the strait, go get your own oil, etc., etc. The Wall Street Journal story may just be a trial balloon. Planted by the administration to see how well it does and how it's taken in by the wider audience in America, whether it's acceptable or not. How do the markets react to it? And markets have actually reacted pretty well. That's the thing. Now, China and Pakistan have issued, and this is all happening parallelly, issued a joint five-point peace initiative to restore peace and stability. A lot of warnings coming through. We've seen so many Asian countries like Philippines and here in India, for example, and others as well, who've put in measures to lower the consumption of oil, gas, etc. And EU's energy chief is basically now saying that countries in the European Union should do similar things. Not going into details, but basically safeguard fuel supplies. The markets, the S&P 2.9% higher. It's the best single-day performance for the S&P since May of 2025. So that's quite something. Nasdaq was up about 4%. The Russell 2000, the small cap index, was up about 3.5%. The 10-year yield cooled off. It cooled off day before yesterday. It cooled off last night. And now the 10-year yield is 20 basis points lower than the high that it made on Friday. That's quite something. Market, by the way, pricing, if you look at US rates, they were pricing in rate hikes last Friday. They're back to pricing in rate cuts. So that's how fast this is moving. I'll just leave you with levels. We'll get a bump up and we'll get a higher start. These are all on the downward sloping channel that I've been talking about for the last 10 days. The resistance is 23,186. This is the immediate resistance on the way up. The support stands at 22,624 and then 22,200. GIFT Nifty will indicate that we are perhaps likely to start about 300, 350 odd points higher. So it's basically headline watching, but is directionally are we looking at not climbing the ladder of escalation, but de-escalating things. And I think markets will like it very, very much. Nigel has walked across with what the positioning is looking like. Nigel, take it away.
Well, it's a new series, April series 2026. Hopefully, it's better than March 2026 because it was an extremely painful series that we just concluded with a confluence of factors weighing down on the markets. There were numerous headwinds that emerged. You had a weaker rupee, a spike in crude as well as bond yields, foreign outflows as well as concerns on the economic slowdown. And because of that, we saw a very, very sharp drawdown on all the key frontline indices. The underlying structure, remember, on the Nifty, that looks weak because key levels have got violated. But the setup is extremely pessimistic, which could call for a tactical bounce. And April has been a favorable month with average returns of close to around 3.5% and a strong hit ratio of around 80%. So hopefully some kind of green is what we could long for in the month of April itself and the April series. Now, the rollovers on the Nifty, they were higher than the previous series. The roll cost on the Nifty, as well as quite a few individual stocks, well, it came down drastically. Now, that indicates aggressive carry forward of short positions into the April series itself. Now, since the shorts have rolled over the positions, the Nifty and the Nifty Bank, the open interest at the start of this series is much higher than what we have seen in the previous series as well as in the past series as well. In terms of participation, the positioning on the FI shorts, well, it's holding at around 2.6 lakh contracts on the short side, while clients, they are net long, but close to around 1.8 lakh contracts on the long side. So both the FI shorts as well as the client longs, well, in absolute terms, they're much higher than what we've seen in the past. But in percentage terms, it's more or less in line with what we have seen earlier. On stock futures, both the FIs and clients, they remain net long, though they're relatively lower in comparison to the previous series. Now let's get to the levels then on the Nifty. The Liberation Day low, that's extremely crucial. While a bounce towards the 23,000 odd mark, that will be met with resistance. Remember, the mood is extremely pessimistic, with momentum indicators such as the RSI drifting towards the 30-odd zone. That indicates markets are oversold in the near term. A bounce is due on the Nifty, but if crude stays stubbornly high and if the war escalates meaningfully, then all bets are off the table. But you should not rule out a tactical bounce from here all, though the 23,000 mark is going to be an extremely crucial resistance mark as well. The sector to track could be the Nifty IT index. It's outperformed in the month of March series itself after getting slammed in the February series. And going by the short roll aggression we've seen in majority of the IT names, any hint of good news could lead to a very, very sharp rally. So I'm going to be watching out for the IT index here again. And let's wind it down with the key triggers we're going to be looking at in April. There'll be the RBI, MATE, central banks, inflation data, other macro indicators as well. And Q4 FY26 earnings will start off as well. So the mood is pessimistic. Hopefully things look up from here on. For today's session, we start off well in the green. Hopefully we end with some solid gains as well.
Take that point, Nigel. Thanks a lot for that. So that sets up trade for today. That's the market right now, 350 points higher. And a quick update on the developing situation in the Gulf War. US President Donald Trump says that the regime change in Iran was not a goal for Washington and that the US could wrap up its campaign in Iran within 2 to 3 weeks. Let's hear him out.
Within 2 weeks, maybe 3. We're negotiating with them right now. They've been, again, we have had regime change. Now, regime change was not one of the things I had as a goal. I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job. But we want to knock out every single thing they have. Now, it's possible that we'll make a deal before that, because we'll hit bridges, and we've hit some. We'll hit some bridges. We've got a couple of nice bridges in mind. But if they come to the table, that'll be good. Iran doesn't have to make a deal, no. Yeah, I've spoken to a lot of people. It's a new regime. They are much more accessible. They are right, you know, they said, we have a present for you.
All right, that's some commentary coming in on the war from Donald Trump, indicating that he is inviting them basically for a deal as well. Matt Orton, who's the chief market strategist at Raymond James Investment, joins in now. Matt, every day is a new one. Oftentimes, you know, the same day there are new narratives coming in, and the market reflects that. As of now, though, the interesting thing is that, you know, we are expecting some sort of, and this time it's a little more serious than what we've seen earlier, the path to de-escalation. Do you feel that as well?
Good morning. So I think what we're seeing, and I think why the market reacted so positively today in the US, is we're starting to remove the tail. We're starting to remove the left tail from how bad things can go, because I think there's a clear signal on the side of the US and potentially on the side of Iran that there could potentially be a deal that we reach. Now, I think a lot of the price action that we saw today was reflective of a few different factors. I think number one was, you can't forget how bad the price action was on Monday. We had multi-standard deviation moves lower across a number of different stocks and sectors, and a lot of that was being reversed today because the market was just so oversold. And in addition to that, a lot of hedges that investors have had across sector ETFs, those were being unwound at the same time, and it's quarter end. And it's been a pretty rough quarter for equities, to say the least. And so there was rebalancing happening as well. So I think all of that came together to really lead to such strong performance. Now, while I'm certainly more optimistic, I've been hesitant to put new money to work in this market. I started to do so yesterday just because the market was so washed out. But I'm still cautious at this point, because 2 to 3 weeks is still 2 to 3 weeks. A lot of things could happen unless there is a deal that's actually announced. And the fact of the matter is that the Strait is not open. While peace is great from a humanitarian perspective. Unless the strait is open, there's still going to be upward pressure on energy prices, and that's going to be the bigger problem for the global economy and how that reads through to inflationary print. So I'm still cautious, but I'm certainly getting a little bit more optimistic on the path forward from here.
Yeah. Matt, to that point, right? Good morning, Prashant here. The Strait was open before the war started. And, I would assume the Strait would be open when the war ends. So why would we assume the Strait is not open? Maybe American ships won't pass and Israeli ships won't pass, right? But if the rest of the oil flows for everyone else, will it be an oil shock for the world? Why should it be?
So I think the challenge is we don't know, Prashant. So we don't know how Iran will treat things. We don't know if they might start to charge a toll in order to pass based on who they like or who they don't like. And let's not forget there's Japan, who's an ally of the U.S. You have a lot of the G7 nations that are still allies of the U.S. and NATO. And the rest of the entire Gulf community is still very, very wary of an Iran that still has capabilities for missiles and to patrol the Strait. They just attacked a Kuwaiti oil carrier overnight, and the UAE has even said that they're willing to use force to reopen the Strait. So that sends a signal to me that the Strait is not open currently, and I don't think there's reason to believe, or at least from an insurance premium perspective or a lot of different logistics in this market, that people are going to feel safe moving through without some sort of naval escorts or other frictions that are going to lead to the prices of energy to be higher. So even though we can say, people can open it up themselves, I still think higher for longer, unless there's conclusive action taken, is going to be what we see for global energy prices.
But that's, Matt, that's the problem, right? There's no conclusive action, right? The Strait sits right next to the coast of Iran. Right? So you got to end it. And I think President Trump and his administration has kind of realized it, that you claim victory, you got to claim victory, and you kind of walk away and let it go back to how it was before. Yeah, people perhaps, and it'll take time, as you said, right? Nobody's going to feel comfortable immediately. It's after all physical safety of the ships. But I think over time, don't you think this settles down? For oil prices, because that is what financial markets are most worried about. That's the channel through which markets get hit.
That's exactly right. It's energy has been impacting everything else across the markets, rates to currencies and to equities and fixed income. So the Strait is what really matters from the financial markets perspective. And I think you're correct, Prashant, that time can heal some wounds. I don't know if it can heal all of them, and there's going to be an uncertainty premium for a while longer. And I think the question that's still out there is what could transpire over the next 2 to 3 weeks, absent a deal being reached. And then you also just have to think of the congestion that's there and the amount of time it's going to take to unclog a lot of the backlogs that are there, and also just the damage that's already been done to physical infrastructure. So we've knocked out a lot of LNG capacity in Qatar. There's been damage done to oil refineries across certain Gulf states. So I think that is going to take a longer time to heal. So I don't think oil prices are going back to where they were pre-conflict, and it's going to take a while before we start to settle even maybe 80 into the 70s range. So I think we have to take that into consideration and be careful from an asset allocation perspective of how we're thinking about making investments. And so I still want to own some of these energy assets that I've been invested in throughout the course of this year, because I do think you're going to see those prices lead to higher earnings. And the question is just how long does this feed through into inflationary readings, and how constrained does that make global central banks to maybe restart the easing cycle? I think hikes, at least in the U.S., are off the table, and Powell, I think, helped calm nerves and also helped set the stage for this rally when he spoke on Monday.
Yeah, from rate hike expectations on Friday to rate cut expectations back priced in. Thanks very much, Matt. A good conversation, and we'll speak again. Appreciate your time here on CNBC TV 18. Let's just quickly run you through the interactions which are lined up here over the next 2.5 hours. So 8:35, we bring you a special chat with Colonel Douglas McGregor, who was the former senior advisor to US Secretary of Defense. 9 o'clock, we'll be joined by Rajesh Baheti on RBI's decision to defer the circular, the RBI circular to July. 9:20, Venugopal Gare of Bernstein will talk markets with us. 9:30, management of Endurance Tech talks to us about their new financial year guidance. Sammaan Capital will be in focus. They've, of course, received approval for that deal with IHC. So Gagan Banga speaks with us at 9:40. Piramal Finance management talking to us at 9:50. So Jairam Sridharan will be on the program. The AUMs crossed a lakh crores. And towards the end of the show, we have ICRA and TRISL on their half-yearly credit performance across India Inc. So that's the chat with Lata at 10:15. Okay, time for a quick commercial break. Our list of top stocks to watch out for with the research team coming up in just a bit.
Welcome back. You're watching us here on Bazaar Morning Call. It was a near 500-point decline that we saw on Monday. There was a break yesterday, and we're back here. And the GIFT Nifty indicating a 370-point uptick. So we might recover at the open itself, nearly 70% of the cuts that we saw on Monday. Individual stocks will be on our radar. And as always, our research team with us on CNBC TV 18's top stocks of the day. Let's start with Interglobe Aviation. Even as, you know, most things are seeing some sort of cool off crude from Monday, there has been a big jump in ATF.
Hi, yes, Mangalam. We've seen a sharp jump that's come in terms of ATF prices. When you look at ATF prices, 115% uptick for domestic flights, or over 100% uptick for international flights as well. ATF prices in Delhi were hiked to around 2,07,000 approximately per kiloliter. That was from 96,000 around last month. So sharp uptick there. Do not forget, for aviation stocks, obviously this accounts for around 40% of their cost. So sharp increase in terms of cost is a big concern that comes in for these these companies. Now, apart from that, let's also keep an eye out on Interglobe Aviation specifically, because they have appointed the new CEO, and this is coming in just 3 weeks after Peter Elvis has left the CEO position. So now the appointment is coming of Mr. William Walsh, who has around 40 years of experience in the aviation industry. He was currently with as a Director General at IATA since 2021. So he's got a good experience, good global experience as well. And given that, Interglobe Aviation is focusing more in terms of international expansion, it comes in and aligning with their strategy as well. The MD Rahul Bhatia also said that the airline is entering its next phase of transformation and growth, where Walsh will play an important role. And Walsh also commented saying that Interglobe Aviation is well positioned. Analysts are saying that Interglobe Aviation overall, this ambition to go global, this is a positive sign coming in of William Walsh coming in as the new CEO of the company. And obviously his mandate, his priorities are already set, right? They will have to be in terms of crew issue, resolving all of that, balancing low costs or reducing the costs in given times of uncertainty will be key there. But as of now, given the increase in ATF prices, Interglobe Aviation could actually see some red.
Okay, all right. Thanks a lot for that, Vinny, and belated happy birthday. Hope you had a good one yesterday.
Yes.
And we'll celebrate today in
Thanks
office.
so much for that, Nigel.
Look forward to some goodies, but wishing you a cracker ahead. Let's hop across to Ritu, though. She's here to tell us about Sammaan Capital. Morning, Ritu.
Good morning, Nigel. Going with green for Sammaan because that much-awaited deal with IHC is finally done. Now, IHC, through its arm, Aviation, is acquiring about a 41.5% stake through a preferential allotment. And importantly, it comes on board as a promoter now. Sammaan has already got about 5,652 crores and another 3,200 odd crores is expected in the next 18 months on warrants conversion. Now, after the open offer, which is at 139 rupees per share, IHC's total holding is going to go up to 63.3%. Now, what does this mean for Sammaan Capital? Of course, the balance sheet boost and stronger credit profile and therefore significantly improved access to funding. But importantly, Sammaan also now plans to diversify, go beyond mortgages, become a more diversified NBFC into MSME loans, personal loans, business lending, and even gold loans. They will also be consolidated as a core investment under IHC subsidiary Judan Financial in India, and that is going to anchor Sammaan's India-focused private credit play. Now, after this, Sammaan says the target is to be among the top 3 NBFCs by AUM by FY29, add 15 more products, 1,500 branches, and grow to a 50 million customer base.
All right. Thanks very much. And as I sort of teased out, we have the Sammaan management joining us a little later at about 9:40-ish or so, 149 on the stock. Well, Bharti is the next one we're going to focus on, and Vinny's back with details. Vinny, take it away.
Hi, so Bharti Airtel has actually inked a pact of around $1 billion for data center creation and investment there, and this is for a deal with Nextra, which is obviously the subsidiary of the company that is involved in the data center business. The valuation is going to be around $3.1 billion. And who's going to be investing with Bharti Airtel? There's going to be Alpha Wave Global that will be investing $435 million. I beg your pardon. Bharti Airtel will invest around $290 million. Carlyle will invest around $240 million as well. And Anchorage Capital will invest $35 million for this. The investment is obviously mainly aiming to spur the AI data center expansion that they have in terms of a plan. And do not forget, in Nextra, Bharti Airtel obviously is one of the main holders in terms of shareholding as well. Good investment coming in here, more in terms of boost for Bharti Airtel for the data center side of the business. We're expecting some bit of a green here today.
Right, some bit of green there, but let's go across to Sudarshan. Sudarshan, on electric vehicles, there's been a road tax in Karnataka.
There's a big policy shift as far as electric vehicles are concerned in Karnataka because state government has decided to bring back road tax on electric vehicles. Remember, since 2016, Karnataka government had exempt road tax on electric vehicles, but in 2024 there was a minor change and government had announced that it would charge or it would impose road tax on electric vehicles that would be priced more than rupees 25 lakh. But now, as per the new notification, all the electric vehicles will attract road tax and this will be linked to the vehicle cost. Now, for EVs that are priced up to rupees 10 lakh will have road tax of 5%. Priced between 10 to 15 lakh will have road tax of 8%, and priced above rupees 25 lakh will have the road tax of 10%. Now, Karnataka is important. So, in CY25, EVs had formed almost 6.4% of total volumes of passenger vehicles in CY25. And of that, Karnataka had formed almost 12% if you exclude Telangana. Now, what is more concerning is if we can see all the major states like Delhi, Maharashtra, and other states like Tamil Nadu also start imposing road tax on EVs, that will be major negative for companies like Tata Motors, even Mahindra and Maruti.
Got it. Okay. All right. Thanks a lot for that, Sudarshan. Going across to Ria. She's here to tell us about some more stocks that are in the news. Morning, Ria.
Well, good morning. Let's start off with Bharat Electronics first. They have received orders worth nearly 6,800 crores since the last disclosure of the company. Now, these orders include mountain radars from the Ministry of Defense and avionics package for the light combat aircraft from HAL, and also a major export order for communication equipment, electronic fuses, as well as strategic components. Moving on to HAL, though, they have come out with the provisional update for FY26. The revenue has come in at roughly 32,250 crores, which is up around 4% on a year-on-year basis. But remember, the company had guided for a revenue growth of around 8 to 10% for the year. The order book, however, remains strong for the company at 2.54 lakh crores, which is in line with the guidance that they had given. Garden Reach as well has come out with their provisional update for FY26 with the revenue at 6,400 crores for the year, up roughly 26% compared to the previous year. But this is also well below the guidance of around 40% that the company had indicated earlier. They haven't given any updates on the order book, however, but the company had targeted an order book of roughly 50,000 crores by the end of FY26, hinging on the next-gen Corvette order. Moving on to Aurobindo Pharma as well, which will be in focus today. The board meeting is to be held on the 6th of April to consider a share buyback. Nazara Technologies will also be in focus as the board has approved a 500 crore preferential issue of warrants, which will be convertible at rupees 260 per share. And the company has said that these proceeds will be primarily used to support the strategic acquisitions that have been recently announced, including Blue Tile as well as Best Play. Lastly, keep an eye out on Jubilant Foodworks as well. They are going to be exiting the loss-making franchisee of Dunkin' from the 31st of December of this year. And remember, the company operates roughly 27 Dunkin' stores in India as of December of last year. And in FY25, the company had recorded a revenue of roughly 37 crores, which is quite insignificant compared to the overall revenue of the company. And they had also recorded a net loss of roughly 20 crores in the last financial year.
All right, Ria, thanks a lot for that. So those are a bunch of stocks that we will be tracking in today's trading session. In case you missed it, a quick recap. Stocks with positive news flow. We have Sammaan Capital, Bharti Airtel, Bharat Electronics, Aurobindo Pharma, Nazara Tech, and Jubilant Foodworks. But stocks with some negative news flow. Interglobe Aviation on account of the high ATF prices. Auto stocks on the road tax on EVs in Karnataka, Hindustan Aeronautics, and Garden Reach Shipbuilders. With all of this, let's go across to Manisha now, who joins in with a roundup of all the action from the commodity market overnight. Manisha, there's been a moderation in crude prices.
Oh, it has been, absolutely. Monday morning, we were trading at $115 a barrel. We are trading at $105 right now. So $10 has been shaved off in the overnight markets there, with reports coming in. Of course, these are unconfirmed reports from Iran president saying that Iran is open to ending the war, but with guarantees. And then there are various reports and bites from New York Times, Wall Street Journal, etc., suggesting that the U.S. president has said that he's willing to end the hostilities even if Strait of Hormuz remains shut. Some profit-taking in the prices has come in because of that. And then you also have U.S. crude inventories, which jumped up by 10 million barrels in the previous week. So more inventories and easing concerns from the West Asia seem to be weighing onto the prices there. But what this has done is that taken the risk appetite on the higher side. And within that, metal prices have continued to gain. Gold prices are back above $4,700 an ounce. In the thick of this West Asia conflict, we saw the prices decline to $4,100 as well. Silver prices from $60 off a low in the month of March are back above $75 an ounce. We've seen copper prices gain up by a percentage point, zinc and aluminum trading at multi-month highs as well. So metals are back in favor.
Okay, all right. Thanks a lot for that, Manisha. Well, we'll slip into a short break, but on the other side, we'll have a very special discussion on the West Asia war with Colonel Douglas McGregor, who was the former senior advisor to the U.S. Secretary of Defense. You don't want to miss this one.
Welcome back. It's week 5 of the war, and markets, of course, are excited by headlines from the president of Iran, and of course, followed by confirmation coming in from President Trump, saying that he's ready to walk away from Iran, even if the strait remains closed. Well, let's get in someone who's seen all of this up and close for a while, and he's got strong views on the matter. He's a former U.S. Army Colonel, Douglas McGregor. He was also the former senior advisor to U.S. Secretary of Defense. Douglas, great to have you with us here. Good morning, and I guess it's good evening to you, wherever you are. Thank you for joining us, and thank you for making the time.
Sure.
Are markets interpreting this correctly, Douglas, that this is going to wind down, or at least, I mean, may not be a few days, but it's now de-escalation rather than escalation? What's your sense?
I would be very careful. President Trump has manipulated the markets here and around the world several times, saying things that turned out to be erroneous. What I think we can say is that he obviously recognizes that he's reached a strategic inflection point. He's got to do one of two things. Either he disengages and essentially admits that the effort to induce Iran to meet Israel's demands has failed, or he doubles down. Right now, we are continuing to move munitions, equipment, aircraft, ships, and troops to the region. That has not stopped. And everyone is getting ready, ultimately, for an intervention. So I would be very reluctant to assume anything at this point. I would assume that there will be more war fighting.
Well, Douglas, while you can't take what Trump says as permanent, this time around, the reason why optimism is being built is because there are unconfirmed reports from the Iranian side as well that they are also keen on ending the war. How much weight would you assign to that?
I think Iran is in a war for its very existence. Would it like the war to end? Absolutely. But the war has to end with the destruction of the threats to Iran. It's all fine, well, and good if we decide to disengage, fly, and sail away. They still have to deal with Israel. And Israel has made absolutely no indication whatsoever that it's willing to make peace. So I think we're going to have to wait for the Israelis to talk with President Trump. I assume President or Prime Minister Netanyahu will do that. If I were in India right now, knowing that India is doing about $180 billion in trade with the Emirates that are sitting in a kill zone, I would be very concerned. After all, India imports 85% of its crude oil. Tankers coming out of the Gulf are down from 75 a day to 3 or 4. And India is buying Dubai crude, I think, at $126 a barrel. Jet fuel in Singapore is up to $231 a barrel. We've got to be very careful what we assume, because if this war continues, it's going to be very, very hard on India, on its economy, on its population.
Hi, Douglas. Good to have you on the show. Pakistan has turned out to be an unlikely mediator. At least that's what President Trump says. Iran is having none of that. Do you think India would be in a better position, actually, to mediate this particular war that's going on?
Absolutely. India has the advantage of being no one's enemy, frankly. India is willing to be a strategic partner for anyone. It doesn't have permanent enemies of any kind. I thought that Prime Minister Modi was much better positioned to assist with this process, because anything that comes out of Pakistan will be dismissed immediately by the Israelis. You have good relations with Israel, you have good relations with us, good relations with Iran. But the Chinese have essentially introduced a proposal through Pakistan. I'm sure the Chinese are quite serious. They are very concerned about ending this for their own reasons as well. But unfortunately, I'm still very skeptical. There's tremendous pressure on President Trump from the Zionist billionaires and the Israel lobby to fight this war to the finish. They want the destruction of Iran. And that's why I say that increasingly all of us, we, you, all the great powers are going to have to look at their countries as resource fortresses. In other words, just-in-time logistics is out. We have to have just-in-case. We've got to start building up our reserves, not just oil, fertilizer, food, you name it, all of it. We're caught up in this problem everywhere.
Yeah, Douglas, just a couple of quick points, all right? You said, well, Iran is fighting for its survival, and even if U.S. were to sail away, there's Israel. Can Israel continue this war without American backing quickly?
Well, it depends on the president. If the president is serious, then he has to cut off Israel. He's got to tell them that you can't continue. We will no longer supply you with the munitions, the missiles, and so forth that you need. I don't see that happening.
Okay.
I think the pressure will be on the president to continue that regardless of what we decide to do. So I don't think we can disengage from Israel any more than we can easily disengage from the Persian Gulf.
Yeah, no, absolutely. The supply of arms and aid, etc., will continue to flow in all likelihood. What I meant was, without physical presence, without U.S. warships in the region, with missiles aimed towards Iran, can Israel kind of sort of continue this kind of escalatory action? But
I think Israel's in very bad shape. Yeah. I can't tell you with absolute certainty how bad that shape is, but they've taken a serious beating. They no longer are responding with surface-to-air missiles against the incoming missiles and drones. I don't think they've got much left. But again, under those circumstances, can President Trump very well leave? I don't think he can. I think he's going to be confronted with a real demand that he stay with Israel until the bitter end.
Yeah, but this war is also deeply unpopular in the U.S., right? His popularity ratings have gone down after every conflict. Popularity ratings for past presidents have gone up. But
you've got to remember, when you say unpopular, most Americans are not yet affected in any way. Only 1% of the American population is related to anyone in the military. When the war became unpopular in Vietnam, it was largely because of the draft.
Yeah.
People did not want to serve. But we don't have that now.
We don't have that. Yeah, absolutely. Just last question from my side. If the U.S. were to go away, right, and there's this Wall Street Journal story which President Trump has confirmed last night that, well, the opening the Strait of Hormuz was not our aim, and others can do it, and it's not a precondition for us to leave. If the U.S. were to disengage, do you think the Strait was open before this war started? Why should we assume that it won't be open after the war ends? I mean, at least if the U.S. were to walk away. What's your sense?
Well, listen, I think you've made a valid point. The people that shut down the Persian Gulf were not the Iranians. It was Lloyd's in London. It's the inability to underwrite shipping. The insurance brokers won't do it. You're talking about $10 million a tanker just to travel through the Strait of Hormuz. This is not going to work. So I think if we pull out completely and distance ourselves, yes, I think the Strait will eventually open. I also think that Russia and China, and I would hope India, will also be part of a commission that sits down and straightens out the arrangements for the Persian Gulf. We should have a treaty that ensures access to everything for everybody. But you see, Iran has said very clearly, if you are supporting Israel in the United States, you're not going to have access. And anybody who is part of an alliance with the United States or Israel is not going to have access. So it's just not a question of us shedding our interest in the Persian Gulf. It's more than that. And I think the Iranians are not going to easily give this thing up. Remember, from their standpoint, if it's not permanently reached, their country remains permanently at risk. And they don't want to go through this again. And I certainly understand that.
Take that point, Douglas. Thank you so much for joining in. The key takeaway from me is that the world has to move away from just-in-time logistics to just-in-case logistics after all that has taken place. We all hope that there is peace, but at the same time, we also hope that the work starts to flow for everyone as well, for the betterment of everyone involved in economies, etc. Let's shift focus, speaking about economy itself, from the US macro cues. Fed Chair Jerome Powell, speaking to the students at Harvard University, also gave an outlook as to how the conflict in West Asia could affect the Fed and its inflation target, the Fed meeting it or not. Let's listen into that conversation.
The tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between 0.5 and a full percentage point to inflation, but that's a much smaller thing than we saw during the pandemic inflation. And and of course now we're facing events in the Middle East which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out. We've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while, and we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make that decision.
Okay, well, that's Jerome Powell essentially saying, well, maybe a little bit of look through all of this near-term inflation concerns is needed. And I think the market took it with both hands and repriced things on the interest rate curve. If you look at the 2-year, the 10-year, etc. Well, the other big, talking head on CNBC was Warren Buffett, chairman of Berkshire Hathaway, who says that he wishes the Federal Reserve had a zero inflation target, signaling his concern over rising prices and the impact on the economy. He added that he's bought about $17 billion in U.S. Treasury bills, and that's just this week. Listen in to some of that commentary.
The Fed can print money, and we have a President Trump, who would like to see the Fed cut rates. Would you cut rates if you were there right now?
I don't know what I'd do there. I wish they had a zero inflation target.
Right.
But, I mean, once you start saying you're going to tolerate 2%, that compounds pretty dramatically over time. And you're saying to people, if you're getting less than 2% on your money, you're going backwards. And actually, if you pay tax, you may pay tax on the 2%. I mean, I don't like that particular goal. But
so inflation is maybe what you'd be more concerned about. I mean, that's what Alan Greenspan always said.
Yeah, I would care about inflation. I would compare what I really would care about is the stability of the banks.
The other big story which is developing is the concerns around private credit, and this is Buffett on that issue.
The banking system is, in some senses, very strong, in other senses, very fragile. I mean, J.P. Morgan, in the last couple of annual reports, reported doing $10 trillion of business per day. Now, that's an unsecured policy. Now, they know what they're doing, believe me. I mean, there's nobody smarter than JB. But I didn't want during the 2008 period, I didn't want anything unsecured, out there for a day. I mean, who knew? Nobody was any good, I mean, the world is very interconnected, and everybody panics.
But is it the banking system we should be concerned about right now, or is it the shadow banking system, the private credit at this point?
It's all parts of the banking system because they all affect each other, and the troubles from one can spread over to another, and well, you saw what happened. I mean, in 2008.
But at risk of potentially, I don't want people to say that you are commenting on what's happening in the private credit situation right now. What do you think of the private credit situation right now? Are there enough concerning issues there that you worry that it could cause a contagion in the banking system?
I don't think I know.
Okay.
I do not think I know what, but therefore I want to be prepared for anything. And therefore we will always have cash around. And we'll have treasury bills. We won't have money market funds. We didn't have them in 2008. We won't have commercial paper in 2008. There's just one thing that's legal tender.
But just to put a fine point on it, you don't think you know what's happening out there. You've had this huge cash hoard north of $350 billion. It's just there waiting for any time. It's not that you necessarily think that there's something on the horizon. It's just the longer time goes.
Sure. No, I always want to have cash, and I never want to buy anything just because people think the market is going up.
Yeah.
Right, good old Warren Buffett. Let's take a quick break. We'll come back on the other side. We focus on some volume buzzers, also get you excerpts from our exclusive conversation with Atanu Chakrabarti, who's the former chairman of HDFC Bank. Welcome back. Now, 12 days after abruptly resigning as the chairman of HDFC Bank, Atanu Chakrabarti has broken his silence. And this is a big CNBC TV18 exclusive where Chakrabarti raised concerns over the governance of the bank and the underperformance of the stock. He questioned the characterization of the mis-selling of AT1 bonds in Dubai as a technical lapse, saying issues persisted for 8 years before action was taken. He also said that he does not regret his resignation. Hear him out.
I feel if large number of customers are hurt, some amount of regulatory, or rather large amount of regulatory focus has come on the bank. It also brings reputational risk. Something goes on for 8 years and suddenly we take an action. People will say, those are concerns addressed, go home. I feel that these conduct issues should not arise at the first place. However, if they are termed as technical, it leaves a little bit of a leeway. That is where the incongruence took place. There are many other matters, and apart from that, underperformance with respect to the share value not performing up to the mark, which meant that shareholders' wealth was not getting maximized. Also, CASA was low, and cost-to-income ratio was high.
Did you regret having written this letter?
No. Why should I? I guess materiality or issues, they are subordinate to the larger matter that I mentioned. And what I mentioned was internal to me. As I had told you, that it caused dilemma for me. Whether it causes for the bank, its board has to address that. If it causes dilemma to me and I find it difficult to live with, I should move on. They feel it's okay, let it be done. So I guess for me, that's where the entire thing ends, because I've got over with my dilemma.
Did you have run-ins, differences of opinion with the management over some of these issues? So
during that course, differences would be there, not only with would be expressed, people would express a different view, vice versa. With everybody else, it could be there. And as a chairperson, it's also my role to bring all the differences as much as possible within a certain boundary. Therefore, I don't think personality differences are generally played up as a causing factor because people feel that...
It wasn't the determining factor for your resignation?
No, not at all, not at all.
The reappointment of Mr. Jagdishan as CEO, were you opposed to the reappointment?
The matter of his reappointment, ideally, the process is it should be first discussed in the NRC, that's a Nomination and Remuneration Committee of the board, and then comes to the board, in which both the chairperson is just a member. It hadn't even come there along with the full documentation. So something which was not even discussed, how could differences be there?
Okay, all right, let's move on then. That part of the show, we get Hormuz, who joins in to tell us about the big movers on Monday, and some of them were backed by delivery. Morning, Hormuz.
Good morning, Nigel. And while we are seeing some likely bounce in today's session, there was a sharp sell-off in a lot of these stocks on Monday. Start off with the GMR Airports. The stock was down around 5% in Monday's trade. There was a block deal as well that took place. Monday's volumes were the highest in over 4 months. 6.5 crore shares were traded, the 20-day average of 1.5 crore. The delivery volumes were the highest in 2 months as well. Close to 74% of those shares were marked for delivery. Close to 5 crore shares for delivery, the 20-day average of around 71 lakh shares. Copthall Mauritius was the seller in the block on Monday, and BNP Paribas was the buyer. And the stock is down around 24% from its 52-week highs, which is close to around 110 rupees. Now, Ashok Leyland was the other one that saw a sharp sell-off. The stock is down around 10% in the last 2 sessions. Monday's volumes were the highest of the year so far. Over 5 crore shares were traded. The 20-day average is 2.2 crores. 61% of those shares were marked for delivery. So that was 3 crore shares for delivery. The 20-day average is just over 1 crore. And here too, the stock is down around 30% from its 52-week highs, which was just in February of this year. So in just 30-odd sessions, the stock is down around 30% from those levels. And lastly, Grow is the biggest single day fall that the stock saw in the last 4 months. Prior to Monday's fall, though, the stock was up modestly in 4 out of the last 5 sessions. Monday's volumes, both on the traded front and the delivery front, were the highest in over a month. So close to 3.5 crore shares were traded on Monday. 20-day average of 2 crore shares, 1.5 crore marked for delivery. The 20-day average of around 62 lakh shares. So the post-listing high of 193, the stock is down around 25% from those levels. While this month is nothing major, but in May, there's a major lock-in that will end on the 12th of May. Around about 60% of those shares will become eligible for trading.
Okay, we'll take a quick commercial break here, Hormuz. Thank you very much for that. We'll come back in just a bit. We have the pre-opening rates coming up in just a bit, 3 minutes out. We'll also have Rajesh Baheti of Crosseys Capital Services on RBI's decision to defer its circular, which of course came out sometime back to July. We'll also connect with Somal Mehta of Mirai Asset of Sher Khan and Sudarshan Sukhani of the Technical Trends for some trading ideas coming up in just a bit.
We're back, about 30 seconds to go for pre-open, 15 minutes to go for the opening. GIFT Nifty is indicating a big bump up at opening. So we do have our technical experts with us, Saumil Mehta of Mirae Asset Sharekhan, and along with him, as always, Sudarshan Sukhani of Technical Trends joins in as well. Now, the GIFT Nifty implied open has accelerated to near 400 points. Sudarshan, you've been saying that the market is in a structural downtrend and stay away. Now, with this 400-point uptick and after the big correction that we've seen in all of March series, do you think there is a trade in the April series?
Yeah, good morning. See, I modified my view on Monday when I said that the first signs of base building are now coming. The market went to 400, is testing that 22,400 lows, and today that test seems to be getting successful. Now, it's not the end of the decline. We can again go back to those lower levels, but the sense that the market is now finding support at lower levels, bouncing back, that is the first signs of what I think some of us would say green shoots. So today, and probably for the next few days, till something else happens, the trade is to look for sharp dips and go long. This is a high-risk trade, but it's worth taking. Rather than put a stop loss and then, get stopped out on volatility spikes, it is much better to use options. So use options to take long positions and expect a lot of volatility. But if this is a base building process, then we are buying at the almost at the lows.
Okay, got that, Sudarshan. What about you, Saumil? What's your take? We had a very, very treacherous fall in March, but hope is that April has been traditionally a good month, so hopefully we get some green. What would you do? The gap up is indicating nearly 500 points now.
Good morning to everyone. We are still in the downtrend. That's no doubt about it. Monthly, weekly, quarterly charts, all lower top, lower bottom formations. But we do have positive divergence on the daily charts, which is a good sign. And we may have a good bounce, and we should definitely, trade for this bounce. The bounce I'm expecting would be till 22,750, 23,000 maximum, and that's where my target lies for a bounce. We shouldn't forget that we are in the downtrend. So in the overall medium-term outlook, we should try to sell on rise. But for this bounce, in the very short term, there are buying opportunities, and definitely there are some stocks which are looking really good. Pharma would be one of them, and power sector would be one of them, where I'll be looking to buy.
Yeah. And let's get to individual names then. Sudarshan, morning. Saumil, you go first. What is on your list?
I have Power Grid on my list. Power Grid has been consolidating all this while in the last 1.5 months, trading above 2040, a daily moving average, forming a triangular pattern. I think I'll be expecting this triangular pattern to break on the upside. Stop loss would be 287 and target would be 315. And my second stock would be Coal India. Coal India has been in the uptrend, consolidating in the last couple of weeks above 40 daily moving average, forming a flag pattern. I'll be expecting this pattern to break on the upside. Stop loss would be 438 and target would be 475.
Sudarshan, what about you?
Well, DMart is a buy with a stop under 3,900. It's coming in as a buy after a long time. LIC Housing Finance is a buy with a stop under 485. I have two intraday shorts. Remember, I'm expecting a lot of volatility intraday. Exide Industries is a short with a stop above 295. And IREDA is a short with a stop above 110. But broadly, we should be looking at sharp dips today to buy.
All right, sharp dips today to buy. An interesting one. DMart, obviously, over the last 3 days has been announcing store openings, and they've reached the 500 store mark with 85 stores added in FY26. So it's been a resilient stock all through this decline and currently now doing well as well. We do have Saumil's individual picks left as well. Okay, we move on and let's go across to some regulatory news. The Reserve Bank of India has deferred the implementation of its revised capital market exposure norms to July 1st, 2026 from the earlier April 1 deadline. What does this delay mean? Rajesh Baheti, Managing Director at Proceeds Capital Services, joins in. We'll obviously take a closer look at the hike in securities transaction tax as well later. But just on this one, the capital market exposure norms that have been delayed, Rajesh, what do your initial calculations suggest?
Well, there could be a couple of reasons. A, the state of the market, the state of geopolitics. RBI may have thought it prudent that to give a 3-month window, further window, in order for that liquidity extraction that they're planning to do in the markets, that this was probably not the best time. Second reason could be that while there was absolute clarity in terms of the norms for brokers who have no proprietary trading, as well as for brokers who have no client trading, who do only proprietary work, there was confusion in respect of how bank guarantees would be split up for clients and for brokers, that to both businesses. And I don't think that clarity had come till the very end as far as the RBI was concerned. So maybe in order to just think through this, the RBI is taking time. But I don't think any major relief is in the offing. So it's just a 90-day window to kind of give a little reprieve to the market in really tough times.
Yeah. So just some help at the margin, Rajesh, right? Not a change in thinking or anything of that sort.
Yeah, and there's this clarification needed for brokers that have this mix of business between prop and client as to how to classify which guarantee goes for what. Because once you send a bank guarantee to the clearing corporation, it all becomes very fungible. So it's difficult for banks to either classify something as pure prop or pure client, and for brokers to do that. So there is a bit of confusion in that.
Yeah, absolutely. It's been a tough place for markets to be in, Rajesh, for a while. Since we have you on, can I ask you, is there anything else which can be done without structurally altering things? I mean,
yeah. So while everybody has been talking about the need to curb excessive F&O speculation, and you've seen all regulatory aims being taken towards this, whether SEBI, whether RBI, or whether it be the government of India, there has been no parallel move to encourage delivery-based trading, either by way of reduction in capital gains tax or doing away with delivery-based estate. So while it's okay to talk about discouraging one segment, we are also trying to encourage another segment, and I see no move from anybody to encourage the other thing.
Do you think that that alone will be enough for a lot of the FII flows to come by?
Look, FII flows have 2-point problem. A, that premium that everybody put on India at some point in time had to go, and it's probably going now over a blinding period of 3 to 4 years. Second problem is most jurisdictions that compete with us don't levy any capital gains on their FPIs. So foreigners trading their markets do not have to pay tax, whereas foreigners trading our markets have to pay tax. The other big problem is foreigners trading our markets have to pay tax on the rupee gains, even though they might be negative in dollar terms. And given the way the rupee has turned out in the last 12 to 18 months, I think that's also a big problem for FPIs.
Yeah. Rajesh, we'll leave it there. Thank you very much for joining us. Good speaking with you, and hope to talk again soon. Thank you. By the way, it's an important piece of information which is coming through right now, and we should dial Shivani for a quick conversation on the phone. So let's just put up Indigo as well, because we have the rates in the pre-open session, right? Indigo is that the correct rate? That's the end of the pre-open. Yeah, it's up 3% right now, 4,063. So the news what we got earlier was that ATF prices, jet fuel prices, have basically gone up 100%, basically doubled, right? That's the cost. That's the biggest cost for all airlines, which would have had a huge impact for commercial operations. For it'll affect demand, it'll push up ticket prices substantially, and of course have an impact on demand as well. Now IOCs, the clarification which is coming through, that the ATF price hike is not for domestic commercial carriers. It is for non-scheduled, ad hoc, and charters. So, it's basically for the luxury end of the segment, luxury or more discretionary part of the flying segment, and not commercial everyday flying that most people use. Apparently, the rates for commercial airlines is going to be announced later today. So this is an important clarification which we want to put out. Shivani is here with more. Shivani, take it away.
Well, yes. Good morning, Prashant. And absolutely, the rates for commercial airlines will be put out later today. But, the difference might not be that big from what we know today for the charter and for the airlines. While there will be a difference, but we can't expect it to be a lot of that difference because globally the ATF prices have soared a lot. While sources now tell us that the government is stepping in this matter, and the center is weighing in multiple options to cool ATF prices. And there are two key levers that are in focus. One is the VAT cuts, and the second is the crack spread caps. Let's break it down one by one. The crack spreads is essentially the refining margins of these OMCs, the gap between the crude oil and the jet fuel prices. Typically, this stays in the range of $15 to $30 per barrel, but it has now spiked to around $70 per barrel. So airlines and oil companies are working on a proposal to cap this margin between $10 to $22 per barrel to bring prices back closer to normal levels, however much they can be done. Now, at this time, the government may push states to also cut VAT on ATF, which is a major cost component for airlines in India. So the idea right now is simple: reduce input costs, stabilize fares, and protect airline profitability all at the same time. But there is a trade-off, of course. Lower crack spreads could hit oil company margins. So for now, it's a balancing act between the airline survival, the consumer fares, and the oil company profits.
Yeah, that's well put, Shivani. The last move from the government, which was the government taking a cut in excise, meant that the government balance sheet gets hit a little bit. But I think, the burden will have to be shared between the government and the companies as well. And of course, the aim is that the consumer, so far as possible, is protected, and perhaps the impact gets to them the last. So that seems to be the aim. So government with the excise cut, this, of course, with refinery profitability perhaps being capped a little bit. And so far, we'll see if, the impact is, how much the impact goes through to the consumer. But we'll wait for those rates later today. Let's get the 9-10 calls out of the way. Sudarshan is here with us. Sudarshan, what do you have?
It's LIC Housing Finance. Buy LIC Housing Finance with a stop under 485.
All right. Sudarshan, wanted to ask you about a couple of big boys and Reliance Industries, that was outperforming for bulk of this last 1 month or so. However, in the last few trading sessions, it's broken the 200, the 20 DMA as well, the simple moving averages. What do you make of that, big boy? Because that's like an index by itself.
Yeah, see, the breakage of these moving averages is not relevant because the whole market is falling. So Reliance is not going to outperform to that extent. But Reliance remains a favorite. I think every trader should understand it's not a trading script, it's a portfolio holding. So these dips are meant to add and accumulate Reliance. But as I told you, it's not a trade.
All right, we take that point, Sudarshan. But, I'd like your views on Jubilant FoodWorks as well. On Monday's trading session, it saw a big cut. In fact, all through this month, given the LPG sort of crisis, the street was a little perturbed about Jubilant FoodWorks' ability to deliver those pizzas, especially at a seasonally strong time, which is the IPL. But now the company has gone ahead and done two important things. One, it's decided not to, renew the agreement with Dunkin', which was earlier a drag on its numbers. And the second part is that it's gone ahead and, as expected, renewed its agreement with Domino's for the next 15 years. So let's see, at pre-open, the stock is up around 3% after a big cut that we saw on Monday. Do you have a chart call on that, Sudarshan?
Yes, my chart call is that it's, again, one of those very sharp buy on dips opportunities. It's a positional trade. Nothing is an intraday trade. But if you're looking to park your money for a few weeks, it's a very good idea.
Okay, all right. That's Jubilant food for you. Sammaan Capital, we want to focus on. Ritu is back with us with details. Ritu, take it away.
Well, yes, big news for Sammaan Capital. That much-awaited deal with IHC is finally getting done. So IHC, through their arm, Aviation, are going to acquire about 41.5% stake through a preferential allotment that has been done. And they will, importantly, come on board now as a strategic promoter of the company. So Sammaan has already got about 5,652 crores and another 3,198 crores is expected in the company in the next 18 months once the warrants conversion happens. So we're looking at more than 8,800 crores of capital infusion into Sammaan. Now, once the open offer is done, which is at 139 rupees per share, IHC's total holding is going to go up to about 63.3%. So what does this mean for Sammaan? A stronger balance sheet, stronger credit profile, and of course, an improved access to funding as well on the back of that credit improvement. But importantly, their plan is also now to use this leverage to diversify beyond mortgages into MSME loans, personal loans, business lending, the higher yielding gold loans, all of that as well. And of course,
well, we got market opening, Ritu. Thanks very much for that. 2.5% higher on the Nifty, 22,871. That's about 2.33% in the green. About 2.6 higher on the Nifty Bank, 51,640. The Sensex is up by a similar quantum. So this is a very good start to this Wednesday morning. 1,700 points on the Sensex and about 500 points on the Nifty. So we are back at about 22,800-ish levels. Advanced decline, 1,600 stocks are higher, about 240, 250 stocks are lower. So it's after 2 days of 4:1, 10:1 kind of declines to advances ratio. This is everything in the green kind of a day. At least everything. There's one stock that's a Nifty heat map for you, which is in the red. That's ONGC. But look at the other side. Piramal Finance, Trend, Bajaj Finance, BEL, L&T. I mean, essentially stocks snapping back after a few days of extreme pain. Especially actually for the large caps, which have been down and out. So 500 on the Nifty holding so far. Mangalam.
Well, straight off the bat, the good part is that the India VIX is down 6% as well. So it had seen a big spike on Monday. That coming down would provide some sort of support for the bulls. Shriram Finance, obviously the top gainer. Trent is the other one, up 5%, has been a big underperformer in all of FY26 and now going into FY27 in style. Also, we have better store additions coming in for that one. Alongside that, looking at Avenue Supermarts as well, that also opens about 5% higher in today's trading session as the company's opened 85 stores in the fourth quarter, the quarter that went by. Among the F&O losers, the only loser, the sole loser is Oil India, which is currently down by a smidge because of the oil prices coming off a little bit. Black Buck is lower, Travel Food Services is lower, Gensol continues to sell off, but on the way up, we do have a bunch of stocks which are buzzing around and seeing a big move. And, the pharmaceutical stocks as well, marginally in the green, not so much, underperforming today after having outperformed earlier. The tech stocks, we have Cyient, which is up 6%, Angel One in the capital market space, up around 5% as well. But today's day definitely does belong to financials. We spoke about Shriram Finance as the top Nifty gainer. Look at the banking gainers at the bottom of your screen. Also, something like an M&M Financial or the others, all of them up and about in today's trading session.
Well, that's right, Mangalam. Plenty of stocks actually are bouncing back, and some of those stocks are the ones that got the hardest hit earlier. So let's get a few of them up for you on the screen. Tata Motors CV, well, good bounce is what we're seeing on that particular name. So, that one's up close to around 4% or thereabouts. Remember, these stocks have pulled back drastically, so they are seeing bounce from those levels. Then you have Grow. That one as well had pulled back. I think it went to around 150 rupees. But that stock clearly is, bouncing back. And in style, very, very high volumes on that name. Ganesha Ecosphere, I think we should get that stock up for you. There was a notification that came in overnight with regard to the recycling of PET bottles, which is favorable for the company because there was a lot of uncertainty. Remember, Ganesha Ecosphere, came down to a third of what it was at its peak. But, because of this relief that's come in there, the stock actually is up close to around 8.5%. So it appears there is some policy continuation. We'll try to understand more with regard to that. But that's up close to around 8.5%. Massive move is what we're seeing on that. Switzerland, a stock that's half from the top, that's up close to around 4.5%. So good move being seen on that one as well. 550 points, gentlemen. Not such a bad start to the series. In fact, a very good one. And we have made up for all the losses that we saw on Monday's trading session, which is encouraging. The Nifty Bank up 1,500 points as well. Yeah, Mangalam.
Take that point, Nigel, and of the stocks that you spoke about as ones which have taken a big cut and now bouncing back, one of them that stands out is Zaggle Prepaid, up in double digits right now, 10% higher. The company has given two updates to the exchanges this morning itself. The first one, obviously, is the guidance for FY27, where they do expect their consolidated revenue to grow at around 40%. And standalone revenue between 25 to 30%. Additionally, they've also laid out their AI strategy. I mean, such is the market where all you got to do is use the word AI and the street will lap it up as an important strategy, and that's exactly what's taken place on Zaggle as well. The contours of that obviously we'll read through in a bit, but this is again another stock which off its 52-week high is still down about 55-60%.
Yeah, absolutely. And I think what $600 or so was the high, right? And 180 around is where we left off. So it's a big jump, 10% this morning. So yeah, I mean, it's a good start, and actually I can say it's a great start. Let's see if we're able to hold the gains as we go through the motions today. BSE is up 6.5%, and it's the largest volume-led gainer across on the NSE at this point in time. It's followed by Shriram Finance, which is, at about 916. There's DMart, which is up 5-6%. I'm just tracking this gains, but also along with volumes and where the volumes are the strongest. Keynes, of course, is another one. Garden Reach and Trent and CDSL. Some of these capital market plays are not doing badly at all. And of course, I mean, these shipping companies, right? Cochin Shipyard, I think we highlighted. Mazgaon, we highlighted. Garden Reach, I think we highlighted. So these are up between 6 and 8% this morning. So across the board, there's a spattering of green and advanced decline now. By the way, 2,500 up and less than 100 stocks lower. So that is how extreme the moves have been. Absolutely binary kind of price action one day after the other.
Just one more point, Prashant, because you had pointed that out, the advanced decline on Monday's trading session, we had close to 1,300 stocks that made fresh 52-week lows. And that's a bit extreme. I've seen that in the past. Once that happens, then, peak pessimism is coming about. And the hope is we have reached that stage. So let's see how that goes.
Well, we're closer to being up 600 rather than being up 500. So a little bit more. As we get into the markets in a real way. Venugopal Garre is with us, Managing Director and India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks for joining us. So you raise a pertinent point, Venu. You look at valuations now for the Nifty 50, and you go back in time to 2021, right? That period, 21, 22, and you kind of say that, well, valuations look based on that comparison looks reasonable, looks cheap even. But then you say that if you look at valuations and where they were pre-2014, then they're not cheap really. They're decent, but they're not cheap. So what's the correct metric to look at when you compare these valuations?
Thanks, Prashant. I guess I don't know whether investors are actually looking to buy stocks, but thinking that stocks have fallen, because I get a lot of questions these days more on what to do if the conflict continues through the year. But having said that, now that stocks have corrected, probably it's pertinent to look at valuations. There's no right measure for it. One way to look at it is more in terms of where we are in growth cycle. If you were to take the 2021 sort of a measure, very clearly thereafter India went into a couple of years of very strong earnings growth. You can say it was probably after years of general weakness in earnings. It was also a cyclical rebound. It was also led by the willingness to keep higher fiscal deficit, which led to a capital expenditure push as well. Right? There's so many things that worked well in post-2021 for a couple of years before things faded off. Now, if you were to look at the growth cycle today, we are not really in a very hefty growth cycle. It's been almost 18 months with meager earnings growth. The next 12 months as well, while there's an expectation of earnings recovery, and this has nothing to do with war. Even when the war was not there, we were not really looking at consensus building in a very large earnings growth for the next 12 months. Any growth that was being built was for the year after, not necessarily the next 12 months. So from that construct, valuations, while have corrected, and maybe even fair, but are not cheap relative to the past. That's the only argument I would probably make.
All right. Hi, Venu. Good morning and good to see you. When, what about the worst case scenario, Venu? I wasn't covering financial markets in 2008, but suddenly that ghost seems to be re-emerging. Some people talk about that. Crude oil prices move up, the rupee weakens, and the markets get clobbered. Would you think that something like that can happen? And in terms of the Nifty as well as the rupee, What are the extreme levels you would look at in terms of a correction from here on? We're already down more than 12% from the peak. The rupee has slipped very, very rapidly. What's the worst case scenario on both these two?
Yeah, I mean, it's always good to look at worst case scenarios. It doesn't mean we want the worst case scenario to play out. But at least in your mind, you would have those levels at which you know that if I invest at the worst case levels, I'll still make money, decent money over 5-10 years. So the idea of doing it worst case scenario was not to scare the market, but was to look from investing paradigms. Now, GFC was a good measure because it was, pretty much of an upheaval in a lot of macro metrics globally as well as for India, even though the direct linkage of India with during the GFC phase with the issues in the world was a bit lower. But if you were to look at the current juncture is tricky simply because if the war had continued, it looks like probably it'll end in a couple of weeks. But if it continues through the year, the vulnerability is very high at this juncture. There are two main things out here that we are significantly dependent on crude. Of course, a lot of discussion would have happened on the channel in the last couple of weeks on current account deficit impact, fiscal deficit impact. And we are also heading into a year where monsoons are not expected to be that great. Putting all this together, the reality is that there is going to be pressure on macro growth. So if macro growth pressure is there, there's going to be an impact on earnings growth as well. Now, at this juncture, consensus is building in close to a 12% odd earnings CAGR over 2 years. Now, historic measures do suggest that you'll see earnings cuts as well as a valuation getting trimmed down when a worst case scenario is built. GFC was about 12-13 times earnings. At this juncture, after the rebound today, we're probably closer to 16 times 2 year forward on the index on, of course, numbers which are not cut yet. So if you assume a 10% cut, that's not a worst case scenario. And assume multiples to probably remain at the current levels, so slightly moderate to 15x perhaps, not even 12, 13x. You're looking at Nifty below 20,000, roughly in the 19-20,000 range. I'll probably say those are the levels which would probably characterize as worst case. Now, in terms of currency, there's a direct linkage. This is an issue where you are going to see CAD issues, and plus remittances as well. We don't know how things will pan out this year. Even if I assume remittances to essentially not fall year on year, we're still looking at a pretty large and a steep outflow from point of view of CAD. So less than 1% GDP going up to probably 3% plus. And that, of course, has an impact on currency. So that's something that volatility we need to live with. RBI will, of course, continue to defend as far as possible. We don't want steep volatility and steep depreciations. But the ability to get that also beyond a certain stage will reduce if the war continues. So all of the caveat out here is the war continues.
Right. Short point. If the war continues, it gets lower from here on. And your worst case scenario, given the current metrics, could be about 10% lower, around 19 to 20,000 for the Nifty itself. But you do make a point on the IT pack. IT fears are, largely AI driven. We've seen the IT stocks bounce back, but with the kind of correction that we've seen, what are the valuations telling you? Is the worst priced in the IT pack?
Yeah, so, I think IT is the most hated sector, by the way. So trying to defend that sector is not an easy task, especially because every week you will see some new announcement from the AI majors in terms of developments. And it may or may not have direct implications in terms of businesses. And more importantly, people don't really assume at this juncture that there's going to be a positive impact on IT spending and AI projects coming in, which would still need some handholding from outsourcing based players like IT services in India, still very low cost models. So you're going to see that wave. Now, put in perspective, if you were to assume valuations from an implied growth perspective. So what does implied growth mean? Implied growth means is the current stock price, what does it assume in terms of the kind of growth it will deliver over the next 10 to 15 years? Now, IT services, when we did this exercise yesterday, is implying about 5.5% earnings growth for the next 15 years. Now, that is the worst that we've essentially seen in history, which primarily means the stocks are actually cheap. Unless you believe that you're going to be 5% growth for the next 10 years is what these companies deserve to deliver. I don't think I'm in that camp, 5% earnings for the next years, though. I do believe there's a cycle, so I think IT is a bit cheaper than what it should be.
Yeah, 5.5. So, yeah, cheap. Prices are, the stock prices are implying 5.5% earnings growth for the foreseeable future, which you think are too low.
For the next 10, 15 years. not even foreseeable future. So Nifty is seeing in 10.5% earning growth for the next 15 years. IT services is pricing in 5.5% earning growth for the next 15 years, just to characterize where these growth rates are.
Yeah, fair enough. Venu, what else is looking, where is the market pricing in too much pessimism? Where else?
I think financials look very interesting, honestly. If I put a positive hat, I'm overweight financials. I think financials is an indirect impact situation, but I'm not broadly, too worried about valuation there. I think people are already starting to worry about credit risks, but I think it's manageable in this cycle because there's not been too much of excesses in the last couple of years or 2-3 years anyways. So financial looks interesting in my view, and probably the one that I would for a rebound. That's the other one. See, the 50-wise telling has anyways been pretty stable and interesting as a space, and I think that's the one which probably also worth looking at. And maybe a bit of utilities, but that's more defensives. So these are the broad packs that I would look at. I don't adventure or be too adventurous to look at sectors which are deeply impacted, be it some of the consumer impacted stock or be it energy, because till the time the clarity on when war gets over, it could just end up being a pretty volatile phase for investors. Getting in, getting out every day is not an easy task.
So if you have to give us some ideas that you like post the recent correction, contra idea will be IT. And besides that, you're seeing utilities as well as private banks, right? They would be sectors that you're relatively positive on.
Yes, that's absolutely correct.
Yeah, Venu, is it? I remember a couple of years back you came out with a small and mid cap list where things were looking very attractive. This is a few years back. Time to put out a list once again?
I currently have zero in my SMED portfolio, thankfully, for the last 18 months. Interestingly, if we were ever to reach the Nifty worst case situation of 19,000-20,000, I guess that's the time when SMIDs become extremely attractive. SMIDs have corrected quite a bit in the last 18 months. I wouldn't really call them screaming buys as well, because there's been a lot of earnings correction as well in the SMID universe. So to that extent, these are probably not overvalued, not in a bubble zone for sure, but not cheap either. So I would still wait out before taking a call on taking a lot of weight into SMID. I think large caps is a better way to invest at least for the near term.
Yeah. Just one last quickly, Venu. The entire consumption space, right? And private banks is also, at the end of the day, feeds into consumption. But will you be worried about the impact on consumption because of AI? I mean, for example, I think Oracle has announced a large round of layoffs. White collar jobs being hit. That's where bulk of the consumption comes in from. Will you be tracking that closely, or you think it's overblown?
Interestingly, most of the job losses we hear is in US than India, which is an interesting debate altogether. So India, you don't really see AI-led job losses in a very material way at this juncture across enterprises. And that is very, very clear. I just reiterate this point. Enterprise AI adoption at this juncture is extremely low. And if you were to just isolate IT services as a space, yes, there is a headcount acceleration or addition is not happening out there, which primarily means that if you continue with that paradigm with no growth in employment in that particular category of employment, which is probably employs about 10 billion IT plus BPO, then you're going to start to see an impact a couple of years down the line, not this year, because there's a lot of areas where employment is created. So AI overall basis, one needs to worry for sure, because it's still in a path of development. You're going to see improvements in terms of AI models over time, which means the risk of disruption could increase over time. But the next 1 year, 2 year, 3 years, I really don't think it's something which is to an upheaval with respect to jobs in India. 3 year out, 4 year out, yes, we should worry.
All right, we will monitor that as we cross that bridge. But for now, you believe that IT is fairly attractively priced, or it's priced a little deeper than what its underlying fundamentals would be. But we do have management with us.
Well, that's right. Thanks, Venu, for joining in. And if you drop that list, we request you to join in as soon as possible. Investors are wondering what to buy. So we'll wait by in case you do right. But good to have you on the show. And thanks for giving us a bit of a check in terms of valuations as well as levels you're looking at. That said, let's move to another company, Endurance Technologies. It's in focus. Remember, aluminium prices have moved up. There have been supply concerns as well that have been triggered by the West Asia conflict. Remember, this is an aluminium-intensive company, so rising input costs could be one of the key monitorables. To discuss this and more, we're joined by Mr. R.S. Raja Gopal Sastry, the Group CFO of the company. Hi, sir. Good morning, and thanks a lot for joining in. Well, let's get a couple of basic factors first out of the way. One is, since the the breakout of this particular war, have you had some kind of impact on your sales, on some of your logistical issues? Point number one. And point number two is, how much higher is the input basket now? If I compare it with, say, a month and a half ago, and do you think you'll be able to pass it on at some point of time to your clientele?
Both questions, let me say that yes, this is a difficult situation right now. The difficulty is that how do we run our production lines and ensure that we get material, fuel, gases, all those things have been difficult times. But what was put to test is the agility of our entire team who handles the supply chain, the ability of our vendor base to support us. And these things really did come into good play. In terms of understand, when you spoke about is our production affected, as of now, no. We have put in place all those plans we had in place because of our enterprise risk management approach, where such disruptions are well documented and we have an approach to deal with them. So these plans were put in place. So the team on the ground, right from marketing, the sourcing and procurement and production, including ensuring that we are able to use alternate fuels for our smelters and other areas where we need gas. So we have managed to run our production so far. And we are also watching very closely. We don't see an immediate risk to our production, but yes, we are watching the situation very closely. And from the pricing perspective, yeah, there has been a significant increase, both in the spot prices of gases and also in the aluminum. As far as the pricing is concerned, we are allowing and we are looking at it as a temporary blip so that we don't make any permanent damages to the relationship which we have with our customers. And we have a very good dialogue, and we have our OEMs and other customers actually talking to us, encouraging us and telling that there will always be an ability to pass on the impact, because we do have this arrangement that commodity increases will be passed on to them. Some with a quarter lag, some on a real-time basis. So these arrangements are there. While there is an inflated bill because of aluminum, almost 54% of our material has got some amount of aluminum in it, including the casting business and the alloy wheel business, which is about 38% of our total business. So, but we have an arrangement to pass it on to the customers. And we are doing very good record keeping to see what we are paying where to ensure supplies are coming in. And we have a good understanding with the customers also to pass it on. Okay. Regarding gases too, that's the situation. It's record keeping, ensuring that we get the gases, and wherever possible, we are moving to alternate fuels, we're moving to liquid fuels, we're changing the burners. So it's a lot of agility and a lot of team strength which is coming into play, putting engineering.
Right, Mr. Sastry, if I could come in, if you could quantify it, as you're saying, up till now, you have managed to run your capacities. You're confident with regard to the discussions that you've had with your clientele that they will absorb some part of that, the cost spike that we're seeing. But if you have to quantify the cost spike, what would it be? Because you have aluminum prices that have moved up, steel prices have moved up as well, and gas availability is down, which in turn could impact operations. So fuel costs basically for you will go up. So if we have to compare it, what would it be in terms of an increase? And would it be fair to say that in the first quarter of the new fiscal year, that's quarter 1 FY27, we could see some kind of a margin pullback?
See, margin in terms of percentage will get affected because we will get a rupee to rupee compensation on the increase in the material. As a percentage, it will get affected. But however, on a rupee to rupee basis, we will still get all that which you are spending. And that's the arrangement. As far as aluminum is concerned, the arrangement to the customers that we get compensated 100% of the increases which we are paying today. Significant increase in the spot prices, I would say, close to 20-25% is also what we are witnessing. But we have the acceptance of the customer that we continue procuring at those costs, and they will also be passed on during the upcoming quarters.
So how much lower can the margins go in the first quarter? I mean, last 3 quarters, your margins have compressed from what? Standalone margins from 14% all the way down to 12%. And what's your revenue growth projection going forward?
Revenue is very strong. You would have noticed that post the festival and post the GST cut also, the demand as far as two-wheeler production has been very strong, and it's continuing to be so. And what's also interesting is that there is a premiumization which we are seeing, that all the people who were buying two-wheelers, instead of spending less, they are trying to go for
we get that point.
offering.
We get that point. Margins, can it go lower to below 10%? Is that a possibility?
Definitely not. Not supposed to give that forward-looking statement, but that is not a situation we are seeing.
All right.
We definitely would be passing on, and we did have pressures in our margins because the kind of growth we have had, you would have seen that almost 20-22% growth.
Take that point
with all the new programs.
Thanks a lot, Mr. Sastry, for joining in and giving us this quick update. Wish you good luck. And out of time right now, but let's move on and let's speak about Sammaan Capital, formerly known as India Bulls Housing Finance, announced the Abu Dhabi-based IHC deal, which will become a promoter after acquiring 41% stake in the company through a preferential allotment of equity shares and warrants. Gagan Banga, who's the MD and CEO of Sammaan Capital, joins in. Gagan, congratulations, the deal has finally come through. The question, obviously, nearly $1 billion coming into your business from now and over the next 18 months. How do they get deployed? What are the kind of ROEs that you're targeting? And by doing so, you also become a more diversified NBFC. So what places are you targeting growth in? What does your AUM mix look like going forward?
Yeah, so I'll break that up into 3 parts. Clearly, one is witnessing globally and in India a trend where there is significant consolidation in financial services. The bigger companies are tending to become big. And we are fairly confident that with this capital infusion, and more importantly, to have such a large promoter as IHC, we will be participating and be significant players in that. And to that order, we are clearly targeting to be amongst the top 3 NBFCs over the years to come. The growth targets are fairly clear. It's a distribution-based expansion that we're going to be doing. There is a lot of tech play that's going to be happening. From being a monoline company, which is focused on mortgages, we've identified low to mid-income segment to be the segment of expansion. We feel that there is a macro tailwind in this, where there is going to be continuous increase in the segment in absolute number of people. And whatever are the loaning requirements of the segment, we would look forward to cater to those across the country. The goal very clearly is first 18 months bump up profitability through a reduction in cost of funds. I expect about 200 basis points of stock cost of funds to play out over the next 6 to 12 months. And the 18 months after that, by which time all the new products would have been tested out and the tech play would have efficiencies would be getting witnessed. We do a significant bump up on disbursements to get to that 1.3 lakh crore mark, which we set for ourselves for fiscal 29.
Gagan, hi, good morning. Prashant here, and congratulations. It's been a long time in the works, and it's now finally sort of got the clearance. By the way, just a quick 30-second detour. So IOC has clarified that ATF, that is jet fuel prices, have indeed been hiked by 8.5% and not 115% as notified. Oh dear. So there was that 115% number which was put out in the morning. This is coming in from the country's largest oil marketing company. They're saying, well, the hike is 8.5%, not 115% at this point in time. Of course, Indigo is surging as we speak. I think it was up about 3.5% as that news started to come in. And now it's up 5% right now. So, of course, I mean, the low was about 3,900 and change. It's back above 4,100, almost 4,150. At this point in time. We should try and get the IOC representative and ask them what really happened. but this is 8.5%, much more manageable, obviously, compared to a single biggest cost item as far as airlines go. Gagan, sorry for that, just wanted to take note of it. In terms of what IHC will eventually hold in the company, right? They're obviously not going to get any shares at the earlier declared price. They'll have to up it, right? So is there a discussion on that? Will we see it, or will they remain around this 42, 43%?
I think the more important point from our perspective, which is Sammaan Capital's perspective, was that they should have control. The regulators have given them a controlling shareholder position. They will be classified as promoters at the close of the open offer, irrespective of whether there are any shares taken up in the open offer or not. Now, it's really IHC's plan as to where they want the shareholding to be, how they want their capital to work. If it was for me personally, I would say put more capital into the company and its affiliates. Let's go and put that to business and create value for shareholders, which is a multiple of earnings. But then it's their capital, and they really have to take a call as to whether they want to own more of the company or use their money to expand the business.
Hi, Gagan. Good morning. Good to see you, Ben. Finally, the green signal comes about. There were some rough edges that got sorted out. So congratulations on actually getting this deal done. Give us a few numbers, though, the expansion plan, both in terms of number of customers, the number of branches as well. And ultimately, you'll get a multiple based on the return ratios. So what is the targeted ROE, say, in the next 2-3 years from now?
Yeah, so by fiscal 29, I would look at a higher teens sort of an ROE. And the other important aspect would be the number of customers, because then you get the second wave positive impact of being able to cross-sell to those customers. So what we're targeting is roughly 5 crore customers by fiscal 29, and ROEs in the range of 18 to 19% by fiscal 29.
All right, 18 to 20% by fiscal 29. And what about credit costs? Because one, you have cost of funds that will reduce. On the other, you will increase your dispersals as well. How does that tie in with what your FY29 credit cost guidance or targets would be?
Fiscal 29, we would be running at about 100 to 150 basis points of annualized credit costs, as low as 20 to 30 basis points on the mortgage assets, and obviously higher on personal loan type of assets. So we would cover the spectrum. There would be a wide range of credit costs basis the pricing of the asset, and as a company, we should be settling at about 100 to 150 basis points of credit costs by fiscal 29.
Would there be any, kitchen sinking at some point in time? I just wanted to understand that, because now that you have some money and, you will be using to refinance some of the older loans that you have, save on costs out there, but also bump up your books by, doing some sort of kitchen sinking.
There are a variety of options. Some of our peers have used it. We've had 6 months to prepare for it. All I can tell you at this point in time is, historically, the company has operated at very strong capital ratios. The whole idea of this exercise is to make sure that our credit ratings go up. They go up to the AAA levels. And similarly, on the international side, they go up to at least the sovereign levels. And for that, we are mindful that capital adequacy needs to remain comfortably over 20% to be at par with other rated AAA peers. And we are in a position to do so. The strategic objective also is to make sure that this whole business of legacy growth, et cetera, the way that we had to kind of navigate the environment back in the day, all of that has to be put behind us. There is one book, and that book would grow at a certain rate and get to 1.3 lakh crores. Whatever steps need to be taken have been taken, will be taken, and I'm very, very sure that we would have an average credit cost of about 150 basis points, 100 to 150 basis.
That still doesn't answer our question, right? 6 to 12 months in the very near future, do you have anything which is vulnerable? You might want to just get rid of that take that hit once and go on with life?
If there is any, at the appropriate time, I'll come back to you. It's very difficult to articulate these strategies in interviews.
No, we're just trying to alert the investors and the viewers, right? The last thing they want is a bit of a shocker coming out. So that's what Mangalam's question is. Should they be watching for something in the next couple of quarters?
Nigel, the shocker would be if capital ratios dip. Where I'm telling you that we are very, very comfortable on our capital ratios with whatever steps that we may take, we would continue to remain very strongly capitalized at well above 20%. There is no shocker coming.
Okay. All right. Again, we'll hold you to it. Thank you very much for joining us and running us through, the plans for Sammaan Capital post this capital infusion. We'll have to see if IHC decides to up their open offer price, which they will need to do if they need to go up beyond where they already are, beyond that 60% number. Look at Indigo. Indigo is the stock of the morning. And I was saying this in the morning. It was up 3% in the pre-open session. There was clarity at that point. There was clarity starting to come through that it is not for commercial airlines. It is for non-scheduled and charters and those kind of flights, etc. Now there is one more clarification coming that the hike itself. And by the way, we were saying that the rates for commercial airlines will be notified later. And now that rate, the IOC has notified the rate for commercial airlines. It's 8.5%, which is, of course, significantly lower than the actual increase in jet fuel prices. So jet fuel prices internationally had hit $200. But here in India, that hike has been about to the tune of 8.5%, which basically means that oil marketing companies and refineries perhaps are being asked to absorb the hit. And that is the pyramid. That is the waterfall, which is, in terms of who takes the hit, right? The government, companies, that's a public sector, maybe private sector at some point, and consumers right at the bottom, right at the end. So that is the big move. Let's put the intraday up for Interglobe Aviation. The moves basically materialized right in front of our eyes, right? I mean, as that headline started to flash through, we were up 4% and it's basically up 8.5%. And that's almost 2 lakh crore market cap company we're talking about. So that's a massive move now, closer to being up 9% on the day so far.
Yeah, and the additional tailwind, obviously, for Interglobe Aviation is that the announcement of a new CEO that has come by. William Walsh in the past has been known to turning businesses around, British Airways as well. It was a large part of cost curtailment, a large part of making operations lean and a lot more of an operational turnaround. So that clubbed with the news that we're just talking about, all of this, along with the fact that the stock has been one of the worst hit in the last couple of months, ever since the skirmish began. Even after a 9% up move that we're seeing, the stock over the last month or so is down about 12%, and from its peak, down a fair bit as well. So all these factors working in favor of Interglobe Aviation, up around 8% right now. New leadership coming in, lesser than expected ATF price hike, and the stock price correction explains the big move that we're seeing on that stock. Take a short break, come back. The management of Piramal Finance joins us as the company's total AUM has crossed 1 lakh crores.
Welcome back. We got the market, which of course is up close to being 600 points higher on the day. And Indigo, as we were pointing out, is up 9%. So, just to be clear on Indigo, it's a 100% plus increase for charter flights and basically anything non-commercial and non-scheduled. And it's 8.5% for commercial flights, which is which is what matters for airlines like Indigo, etc. And I think that's the reason why the share has jumped to the day's highest points, a big one. Well, let's move on. We were talking with one financial services company, and we got another one with us now. Piramal Finance management is with us. Assets under management now crossing the 1 lakh crore milestone. How are things set up? How are things looking? And we have Jairam Sridharan. He's MD and CEO of the company with us. Three talking points, right? I mean, AUM scale up and growth momentum, outlook for asset quality, and of course, funding mix and cost of funds going forward. Jairam, good morning. Great to have you with us here. Thanks for joining us. Congratulations, I should say first. I want to start with point number 2 out of the 3 points that I outlined, which is if you are seeing across your portfolio, especially on the unsecured side, etc., some pain, some disruption because of what we are seeing out there caused by this Iran war, energy costs spiking, etc.
Good morning, Prashant. Thanks for having me here. The short answer to what you're asking is no, not yet. My guess is that you might start seeing something in a little bit, but right now, the pain is not yet visible. So if you look at the epicenter of the gas problems right now, let's say the LPG crisis, etc., the small restaurant owners and so on, we have spoken in our consumer base to about 150 of these customers and try to gather from them what's going on. What we realize is that these guys are under a little bit of pressure in terms of availability of gas, etc. So they've of course gone ahead and cut their menus, but their footfalls are still there. Their billings are still largely intact. There is about 10 to 15% of them who are very small and who have had to shut shop because commercial availability of LPG is low, and who are waiting for that to re-emerge. Now, in terms of repayments, March repayments have been fine. There has been no problem. Of course, repayments in the lending business tend to happen in the early part of the month. So by that time, the war wasn't actually in full flow. So it's not super clear whether that's what we are going to see in April as well. So we have to wait the next 10 days to actually see what happens in April. But in March, the repayment rates were just fine. Of course, there are MSMEs under stress, and there will be a desire on some of their part to see whether some sort of restructuring solutions, etc., can come through. But it is a small minority. The large proportion of the population is still fine. Asset quality numbers are going to look just fine as far as Q4 is concerned for most of the sector.
For Q4, which is the Jan to March quarter. Yeah, okay.
Yes, the quarter ended yesterday. Yeah.
You've always been, Jairam, quite candid about the risks you see, and you've flagged off risks far into the future, which have materialized over the last couple of years. Do you see this showing up? Because the expectation is that this continues, this energy shock continues for a while longer. You are going to start to see a lot of these disruptions materialize. They're not there yet. But do you reckon they will be a problem? I mean, a quarter, 2 quarters down the line?
It's a good question. I would watch the July and August months. I think August is where I really expect to see impact of what has happened so far. See, what tends to happen is that when somebody faces a shock, they don't immediately stop repaying. Everybody has a little bit of a buffer, a little bit of savings to dip into. They dip into the savings. They're able to get through a month, 2 months. So they will get through. They've already gotten through March. They will get through April, probably May as well. And after that, they will start getting into default if they continue to have pressures. And then it'll take 90 odd days for it to actually show up in your NPA numbers. So NPA ratios or slippages will actually rise, in my opinion, in August, based on what has happened so far. So lending is a patient business. Events that happen today actually, foreshadow what you're actually going to see in numbers many months later. So watching the sector's numbers for Q4 or Q1 isn't really going to show as much. It's the Q2 numbers that you got to watch really closely.
That is, and which segments do you expect? I have 2 questions. Which segments for the industry do you see this coming up as a problem? And what is the size of the problem, if there is any way to think about it, Jairam?
Yeah. So see, it's right now, the focus is a lot more on the MSME sector. The large corporates have not been impacted as much. Of course, somebody who's very import dependent is going to feel the pressure a lot, even if they are not related to the oil sector because of what has happened to the USD INR. So import guys are impacted. Anybody who's in the immediate kind of value chain of fuel, restaurants, the catering companies, courier companies, a bunch of these guys are transporters. Everybody is going to get affected right off the bat. Then it's going to spread to second order and third order, which is very hard to even conceptualize where all the impacts will be. But the epicenter is going to be the MSMEs who are directly linked to the oil ecosystem, right? Who take it as input. Most likely, that's going to be the epicenter. That problem is not a huge one. Let me give you our example. In our business, of the 1 lakh crore portfolio that we have, we estimate about 1,000 crores to be in this epicenter. So that's about 1% of our portfolio. For larger banks, etc., which have a lot more prime population, it might even be smaller than that, right? So it's not a very large population that's in the epicenter right now. But if that epicenter grows and there are more people that get impacted by that, then you will need to start worrying.
Sorry, did you get the number? You're saying that epicenter, of course, is MSMEs.
Within MSMEs, people who are
exposed to,
who are users of fuel of any kind.
Yeah.
Right. That's where the epicenter is going to be.
And that subcategory for Piramal Finance, exposure-wise, is about 1,000 crores.
Correct.
That's what you're saying.
Correct.
Okay, and then I mean, second order, third order, etc. We'll have to just see what is the issue. Yes. Regulators, as you said, lending is a patient game. Regulator, of course, will also be watching this carefully. You don't think anything needs to be sort of worked on or nothing, right? I mean, at this point.
We have read from coverage from all you media people that there is some conversation going on at regulators' end to offer some sort of a restructuring program. We have not heard anything. The regulators haven't spoken to us, or the ministry hasn't reached out to us. You probably know more about this than I do.
Right, we'll try and figure that out. I just had a couple of questions, and they're more topical in nature with regards to your ECB borrowings in FX, if you have any, with the kind of weakness that we've seen in the rupee. What's the kind of impact that it may have on your books? That's point number one. And secondly, the buzzword, artificial intelligence. A lot of companies like yourselves are using it to either generate better leads or reduce costs, or at the same time improve the quality of loans that are being given in terms of them being able to return. So could you quantify the impact of that? So one is on the ECB, which is here and now. The other, over the next few years, you'll probably see improved benefit of artificial intelligence.
Fantastic questions. On the ECB side, right now, the impact on us is zero, because as a company, our policy has been to hedge 100% of all our ECB exposures, both principal and coupon. So we have borrowed so far about $1.7 billion over the last 2 years through various kinds of ECB instruments. The entire 1.7 billion is fully hedged, both principal and coupon. So in that sense, the USD INR movements don't have any impact on us. What it does impact, though, is ability to raise new ECBs. So if you wanted to go to the market today and raise money in dollars, it would be super hard. The market's not open, and lenders would find it very, very hard in the international market to actually lend to an Indian corporate or an Indian NBFC. It'll be very, very difficult. So incremental borrowing, you'll have to put on hold and wait for the market to stabilize. But the existing borrowing of about $1.7 billion that we have, there is no problem there. It's all completely hedged.
And on artificial intelligence, the second part of the question.
On your AI question, see, AI is fundamentally reshaping kind of 5 aspects of business, the way we have called it out, right? One is underwriting, the second is customer experience, the third is OpEx, the fourth is growth, and the fifth is software development, right? Those are the 5 areas that we have called out as places where AI has had the greatest impact. Software development, for example, we write all of our software ourselves at Piramal, and 80% of the software being written today is actually being written by AI. So it is huge in terms of its impact on that front. The most visible thing that an external person can look at is the OpEx trajectory. And you will notice that over the last 2 years, Piramal Finance's OpEx has continued to fall dramatically. We have had almost a 270 basis point improvement in our OPEX ratio over the last 2.5 years. A large part of that is due to AI. I have also guided that going forward, I expect another 50-60 basis points of improvement still in the bag, based on a lot of other projects that we have in the mix right now. So you should continue to watch that curve for us and see that it will keep trending down in the next 5-6 quarters as well.
Jairam, before all of this, and thank you, this is a pretty detailed explanation in terms of what's going on. Before the Iran war started, right, late February, the general feeling was that, and not feeling, it was borne out by the fortnightly data from the RBI and credit growth, that credit growth was picking up. And it was going into the economy in various sectors, autos, et cetera, et cetera. Whenever this thing winds down, right, will we pick up from where we left off, or it kind of gets muddled now for a while?
I think it's much more the latter of what you said. See, if you look at financial year 26, the first almost 45 weeks or 40 weeks of the financial year, we had fairly tepid credit growth, right? 10, 11, 12%. But the last 5, 6, 7 weeks, we started seeing significant increase in credit growth, right? And so by the time the year ends, we'll probably end kind of about 250 basis points higher than where we were running throughout the year, right? So the last 10 odd weeks of the year have ended up being very good. I didn't quite understand why the numbers have suddenly ticked up, but they did tick up. But the war is absolutely going to change that. There is no question about it. Credit demand is going to come down because uncertainty has increased. And also supply is going to come down because lenders like us are going to look at what I said earlier, which is, hey, risk might increase in July, August, and people might start putting on some brakes. So supply might reduce as well a little bit. And in general, these things, when a shock like this happens, the shock takes time to transmit through the entire ecosystem. And you should expect at least a 2-quarter, 3-quarter period of transmission of that shock. So झटका एक मोमेंट में लगता है, लेकिन सरदर्द उसका 3 क्वार्टर तक रहेगा.
सरदर्द तो पिछले काफी टाइम से चालू है. What can we say? Never a dull moment, right? Something or the other. Finally, it was all kind of sort of the negatives were starting to maybe fade into the background. That trade deal and these FTAs, and it was looking a little better. But I think it's all, of course, the rupee and the sharp depreciation, Jairam. I mean, any implications from a lender point of view?
Yeah, the borrowing side is, the last 2 years, NBFC sector has borrowed a lot from the international market because in the Indian domestic market, deposits were very slow in growing. So there was not enough deposit money domestically for everybody to borrow and grow. So you saw a lot of NBFCs, ourselves included, going to the external markets and borrow a lot. But if the rupee does what it has been doing and there is so much volatility and that shows up in very high hedging costs, etc., that makes external borrowing implausible. So we have to wait for a lot of stability to come. Otherwise, a big source of funding has actually temporarily gone away. Though I will hasten to add, this type of thing happens all the time. Like these cyclical things, these markets are very cyclical. There are pockets or windows when they are very attractive and long windows when they are very unattractive. We have just entered an unattractive window just now.
All right, sir. Pleasure speaking to you as always. Thanks a lot for joining in on CNBC TV 18. We look forward to having a chat with you as the quarter progresses. Wishing you all the best for the new fiscal. Well, by the way, we have some important flashes actually that are at the bottom of your screen. And there is some further clarification that's coming out. And this is from the Ministry of Petroleum. They have said that they passed on only a partial and staggered hike of 25% to the airlines in the domestic travel. So that's important. I think that's why IndiGlobe has cooled off a little bit from the top. And the other point they're saying is that the foreign routes will pay for the full increase in ATF prices. So that is substantial, actually. For the time being, the stock is holding on to those gains. But there is some clarification that's coming in there. Airlines will pay, full for international travel. That's the foreign routes in line with ATF prices as well. So just keep that in mind. The ticker is keeping it alive out there. But that's the clarification that's coming in there. So we just thought we'll alert our viewers on that. Stock is still up 8.5%, but I think it's come off a smidge from the highs of the day. So keep an eye out on that.
Yes. Nigel, the actual increase in jet fuel cost, right? I mean, I think that's the reason why the stock is holding, is because it is substantial. I mean, I think they're doubled. Jet fuel prices globally, have doubled. So for now, it is a staggered 25% increase, right? That's what the news flash is saying. So even at the full limit of 25, and if assuming it stays at 25, I mean, the full impact is not being passed through, they will. This is good for consumers, of course, who'll have to bear with slightly higher, not slightly, maybe meaningfully higher ticket prices, but not, substantially higher prices if the entire jet fuel price hike had been passed on to airlines. Single biggest cost item for airline companies. We'll take a quick commercial break here. 42.80. Indigo is holding on. Maybe it's given up about 1% from the highs, but still it's got a solid 8% going. Manisha is here with a focus on commodities on the other side. Stay tuned. Welcome back. From equities, we move on as always to commodities, and Manisha is here with the metals on her mind. Manisha, morning.
Thank you for that, Prashant. So while March wasn't so great, we've seen April start on a stronger note for many of these metals. Well, gold actually gained 3% overnight and silver was up 7% as well. There are signs of de-escalation in West Asia with the kind of reports and statements that we've seen from both the parties. Iran, for one, has said that they are open to ending the war, but with guarantees. We do not have confirmation on this statement therein. But there are various reports, and we've been playing those bites since morning on what the US president has said, suggesting that he is willing to end hostilities even if Strait of Hormuz remains shut. In the meanwhile, you also are looking at US dollar strengthening. You're looking at global treasury yields elevated. That continues to weigh on the non-yielding assets therein. But the traders at this point in time seem to be completely writing off any possibility of a US rate cut in 2026. I want to get gold on your screens, and we are trading at around $4,700 an ounce onto that one. For the month of March, it has been a 13% decline, which has been a biggest monthly decline since October 2008. But we are off the lows because, remember, we did see 4,100 on the lower side as well. So 4,700 is a huge jump coming in for gold prices. But we've seen 5,600 of an all-time high. So that is 19% off those kind of record highs still continuing in case of gold prices. Silver should come in on your screens because we are back around $75 an ounce for that one, which is a 2-week highs. We have seen prices decline to $60 an ounce in the month of March. From those kind of levels, it's a bit of a gain. But for March, it still is 20% of a decline. And this is the biggest monthly decline since September 2011. Also for silver, all-time high was $120 an ounce that we saw in the month of January. So we are down 40% from those record highs as well. If you look at the overall metals in the month of March for base metal prices also, aluminum is the only one which is actually in the positive for March, up by nearly 12%. This is the strongest March that you have seen since 2018. Copper should come in on your screens, and we've seen a 9% decline on that one. This is the biggest decline we've seen since July 2025. Palladium with an 18% decline is the worst monthly performance that you have seen since October 2008. And there you have zinc in the negative as well for the month, for the quarter as well, down by nearly 3% for the month of March.
All right, Manisha, thank you very much for that. That's Metals in Focus. We'll take a break. We are back. It's our special segment, is the economy. Lata will be speaking with ICRA's K. Ravichandran and CRISIL's Somsekhar Vemuri on credit performance in the second half of FY26. Coming up in just a bit.
Welcome to Its Economy. Credit quality was not an issue at all till last year. But with tariff uncertainty and now war, did the credit quality of Indian corporates show a wobble in the just ended second half of FY26? More important, will we definitely see some credit decline, that is decline in credit quality in the current year, starting today? Joining me are rating heads of two of the largest rating agencies, CRISIL's Somsekhar Vemuri and ICRA's K. Ravichandran. Good morning, gentlemen. Thank you very much indeed for your time. First, the easier question. Mr. Somsekhar, what was the performance in the second half itself? Was there a decline from Q1 or H1?
So we look at a metric called credit ratio, upgrades to downgrades. That came in at about 1.5 times in the second half. Yes, there was a moderation from the first half of about 2.17 times. And that was largely on account of the fact that we've seen a slight dip in our upgrade rate, a slight increase in our downgrade rate. And all of these are primarily on account of the fact that, there was an aftermath of the US tariff tantrums which export-oriented companies had to deal with.
So largely the number of downgrades were in the export exposed or US export exposed sector?
That's right. That's right. And having said that, I mean, what I would also want to highlight is reaffirmation still accounted for a bulk of our it's almost 82% of reaffirmation. So it implies more of stability. Marginally, 1.5 still indicates we upgraded more number of companies compared to downgrades. It's a moderation from what we have seen in the first.
Okay. Got it. Well, actually, this is the first time I have seen the two rating agencies have a different view. Actually, ICRA is not seeing a fall in credit quality. What has been your first half, second half, your second half observation versus the first half, Mr. Ravichandran?
In our case, the credit ratio was 3.2 times in second half versus 2.8 times in the first half. Perhaps, the picture is somewhat skewed by the upgrades which happened in few sectors, especially in the financial services, where we had to upgrade companies focused in the capital market play. There are a couple of groups where they represented the entire value chain. So when we upgrade, we tend to upgrade several companies in the group because we take a consolidated view. So 2-3 groups have accounted for a lot of these upgrades. Secondly, in the real estate space, more importantly, commercial real estate space, again, there are certain large groups where we had to be upgraded because momentum has been fairly strong in the commercial real estate space. And also some of the SPVs which were getting into the REITs mode. Since most of these REITs are AAA rated, because of this transition, also we saw a fair amount of upgrades. But otherwise, in the core sectors where we have been seeing the pain, if we were to exclude these two aberrations, then perhaps the ratio was somewhat lower compared to the first half. That's how I would summarize the momentum.
Okay, yeah, as I can see in textiles textiles you could clearly see. Even in power, there has been a slight deterioration. Very slight, but there is a deterioration. But now for the more important question, gentlemen, the world is not so much worried about the quarter that was, but that the quarter that will be. And Mr. Vemuri, over there, you seem pretty worried in terms of what might happen in the current quarter, the quarter starting today. Where are the pain points that you are expecting?
What we have done, Lata, in the uncertain times that we are living in, we carried out a stress test based on certain assumptions. And we clearly laid out those assumptions. One is the fact that we expect the conflict, West Asia conflict, and the disruptions to last for about 4 to 5 months in total, which includes the month of March, which went by, and consequently in the higher prices on oil and crude and gas supplies, etc. So based on that, we looked at about 30 sectors which have, in our opinion, some degree of impact, direct or impact on account of this conflict, which account for about 65% of our overall rated debt. And of these 30 sectors, what our conclusion is that 23 out of these 30 sectors, we see limited to no impact on account of the West Asia conflict, primarily because the balance sheets are fairly strong, or they have the ability to pass on the impact of higher input prices or the logistic costs, or they have very limited dependence on gas. And that accounts for almost 90% of the overall rated debt that we have considered in our study. There are about 6 sectors, which we see some degree of moderately negative impact on the overall credit quality. These include airlines, these include specialty chemicals, flexible packaging, polyester textiles, diamond polishers, as well as auto component players. Again, mostly the issue is that there is likely to be an impact on their operating margins, given that they may not be able to fully pass on the impact of higher fuel prices. But it's still moderately negative kind of an impact because balance sheets still offer some degree of a respite. The one sector where we are seeing it will be quite negative is ceramics, on account of the fact that we are likely to see a revenue share of almost 1/3 and margin hit of almost. This is one of the more vulnerable sectors. But having said that, this accounts for less than 1% of the rated debt. Overall, our credit quality outlook for the corporates is still more of a stability, given that balance sheet strength is fairly strong. Median debt equity ratio is less than 0.5. Interest coverage ratio is upwards of 5 times. So I think it's more of a stability, but with a caution on account of the fact that we don't know how long the conflict will last and period of stabilization.
No, Mr. Veburi, I know that you all assess credit quality and not earnings, but willingly you are going to look at numbers. Would you say that we have to be prepared for a lower earnings growth, profit growth in the quarter starting today, April, May, June, compared to Q4 or compared to year ago Q1?
Our stress test that we've done is based on a scenario where probably the stabilization period will last for a quarter, maybe a month, a quarter to 4 months, and if that plays out, then clearly yes, you would see an impact on the earnings and the cash flows. Having said that, again, it is still a scenario, lot of moving parts. Just yesterday we've seen more overtures from both the countries that there is a de-escalation possibility, and also what impact it has on the infrastructure, the oil and gas infrastructure in the Middle East is something which also needs to be.
We cannot enter that discussion because what is said today gets erased tomorrow. So we have to wait for lasting peace. Mr. Ravichandran, similar question to you. Can we assume with reasonable certainty that the best of credit quality is behind us and we may start seeing credit pressures on banks and NBFCs in the April, May, June quarter?
Yeah, I would agree with that assessment. For India, consumption has been one of the major driver of growth. So with the uncertainty around the recent events, fuel price increase, and a lot of SMEs have been impacted, so that has changed the sentiment in smaller towns. And to that extent, we believe there will be a second-order impact on consumption and also some of the sectors like real estate, etc. From that point of view, the lenders who are exposed to these sectors, to MSMEs or other vulnerable sectors like ceramics and so on and so forth. Even they may feel marginal uptick in the credit quality, credit pressures. So from that point of view, overall, I agree with the assessment that the credit ratio perhaps has peaked and it may moderate in the coming quarters.
Okay, your thoughts, Mr. Veburi, on the financial sector itself. You all are forecasting 13% credit growth compared to about 14-15% as of March 16 that the Reserve Bank reported. Reserve Bank data showed. So credit quality, credit growth, deposit pressure, does it mean that the finance sector is going to see continued worries for at least the first half?
Clearly, from a growth perspective, a tad bit of a moderation, given that there is this conflict which is there, and hence a lot of private investments. You could see some degree of a wait and watch, which would be there. Having said that, the consumption, is something which is likely to persist, and hence the retail is something which is likely to. In terms of asset quality, I think we have seen for a fairly long period of time the NPAs were about 2.5% kind of a range, and we when we looked at the overall corporate side of the picture in terms of our ratings roundup, we are not seeing too much of a pressure. It's more of a outlook which is of stable but cautious kind of an outlook. So unless the conflict prolongs, for a fairly long period of time, if it is something which is going to be contained in a relatively shorter duration, I think we should be able to manage. The capitalization levels for both the banks and NBFCs are also fairly.
No, that I don't think is in question. My point was only whether incrementally the delta is a red arrow down. That is the worry. It doesn't really mean that we are going to be in a crisis mode. But clearly, there is a question mark over ability to raise deposits. And a very important point you make in the CRISIL note, that the wealth effect declines when the stock market is down, over the past 2 years, whether that would also have an impact on the extent of retail consumption. That's the time we have. But thank you very much, gentlemen. The second half, they're a bit divided. That credit quality has also already started showing some tremors, according to CRISIL. ICRA still sees credit quality good. But in the quarter starting today, there are clearly going to be some impact. Nothing hugely worrisome, but the delta is clearly lower as far as credit quality is concerned. We wrap up on Bazaar on that note. Chartbusters coming up.
Increasing chatter of a possible truce in West Asia sends global equity markets soaring. The Indian markets too opened with a gap up. The Nifty up over 2%. All sectors trade with gains.
Interglobe Aviation is the top gain on the Nifty as the Ministry of Petroleum only passes on a partial and staggered hike in jet fuel prices. The airline has also appointed former British Airways chief William Walsh as its new CEO.
Strong surge in defence companies. BEL rallies as it received orders worth nearly 6,800 crore rupees over the last 2 days. GRSE too rallies despite annual revenue failing to meet expectations. Stocks across the street see gains.
Avenue Supermart sees gains of nearly 8% as store opening momentum picks up. The company opened 58 stores in the fourth quarter with the total store count now above 500. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and we start off the new fiscal, a new series, a new month with solid gains. It's been a long while since we said that, Mangalam. You can just have a little bit of a peep up and just take a look at that. Yes, it's looking quite good. That's green on the screen now, Mangalam. Couldn't have expected a better start.
Couldn't have expected a better start, Nigel, to the April series. In fact, as we speak, 2,800 stocks in the green for just about 150 in the red. It's something that we haven't seen in a very long time. Alongside that, we have a lot of the sectors doing extremely well. So IT, for one, is doing extremely well. We've seen some traction in metals, banking stocks as well. So across the board, there is a big amount of gain. The question is whether this sustains or not. As of now, all indicators point towards this sustaining. Largely, the biggest of them all is the India VIX, which is down 9%. Typically, earlier when we would see the markets move higher, the India VIX was still higher. And now, as we speak, the India VIX down 9% will give some support to the bulls. Let's get in Rajesh Palvia from Axis Securities for a quick technical check on the market as well. Rajesh, do you think today's bounce is a little more formidable than what we've seen earlier? Or would you say that this is still volatile markets and there is no clear trend which has emerged?
Yeah, hi, good morning, Mangalam. Good morning, everyone. So looking at the rollover data, the market was, having the data of short built up. We have seen a surge in the open interest on the Nifty as well as in the Bank Nifty, despite we have fallen so much in the previous series. But yes, looking at the gap up opening and now Nifty is sustaining about 22,700. So some unwinding trade on the short side is taking place. So for the day, 22,700 on the Nifty spot is very important to watch for. If he continues to trade above these level, maybe we could see another round of short covering action in second half. On the higher side, 22,950 needs to take out. If Nifty able to take out these level, I think we could see a more pullback action towards 23,000, 23,050 kind of zone in the continuation of this pullback. So those who are intraday trader follow the stop loss of 22,700. Above 22,950, we could see another 150 point rally from here onward. For Bank Nifty, it's interesting to watch as we are now negotiating with a major supply zone of 51,200, which is very important for Bank Nifty. If we able to sustain above these level, then here also we could see some short covering action to play out and possible extension of this pullback towards 51,700, 51,800 we may see during the course of day. So here also one can trail at this juncture stop loss at 50,900 to hold the position. Some of the stocks where we are seeing good traction is from the metal space. Hindalco is looking very promising. The way stock managed to give breakout of falling trend line, I think here we may see furthermore upward momentum. 940, 950 would be the next target for Hindalco. So buy and accumulate would be the strategy for this counter. On the downside, 900 needs to keep as a stop loss. Some of the banking stocks are also witnessing short covering action. So from that basket, I think RBL Bank is looking attractive as the stock has taken the support from its multiple support area on the weekly daily chart. So here one can keep a stop loss of 292 and possible pullback towards 310 to 315 we could see in the next couple of days.
Got it. Okay. All right. Thanks a lot for joining in and filling us in with your quick take, Rajesh. Wishing you a good day ahead. And as you said, closing above the 22,700 is an important mark for today's session. Well, it's a good time then to move to our special segment where we get you a few ideas for profit from Money Control Pro. Khushbu Rai of moneycontrol.com joins us to talk about a stock that she's tracking rather closely. Khushbu?
In today's idea for profit, we have Tata Capital. The company reported highest ever quarterly asset under management growth of 26% YOY, driven by festive demand and GST rate reduction. The consolidated gross loan book crossed rupees 2.5 lakh crore in the December quarter, registering a sequential growth of around 7%. Looking ahead, the productivity improvement and stronger operating leverage backed by digital transformation will aid sustained growth, in our view. We also feel that the strengthened balance sheet after the IPO will offer ample flexibility to Tata Capital to pursue future growth opportunities. The IPO has also significantly improved the leverage profile, which will support sustained growth. Improving growth momentum, margin expansion and moderating credit cost will support earnings growth and drive ROE expansion in our view. On a relative basis, the Tata Capital trades at a premium to most peers. We feel that the company is well positioned to command premium valuation on the basis of strong parentage and a market bias towards quality name in the financial services space.
All right, Khushbu, thanks a lot for that. The market's holding up right now, but marginally off highs. Nothing really to worry after the big kind of move that we've seen so far. Wouldn't hurt to take some profits off the table, but the Nifty is still holding important levels. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us. Well, a lot of stocks doing well right now. We have Bosch, which is spiked to the high point of trade, up around 7%. Following it is Hindustan Copper, up around 7% for that one as well. Emphasis, Oracle Financial. So all of these, mid-cap IT stocks doing extremely well as well. So it's Bosch, Hindustan Copper, and then for IT stocks, we have Emphasis, Tata Elxsi, Oracle Financial, and KPIT Tech. Then a couple of metal stocks. SAIL comes in on there with some gains, and then we have PNB Housing Finance as well, which is up at the high point of trade.
Well, that's right, Mangalam. A few more names just to highlight. Ganesha Ecosphere, there has been a notice coming from the government, the regulatory things with regard to the recycling, the RPET, that they have recycled material. So that's got a bit of a green signal. So a stock that's actually come down by a third of what it was from its peak. High institutional holding, so a big disappointment when that got pushed back. But the notification clearly has helped them out, and that's why that stock is up close to 13%. Another one is Rain Industries. The stock corrected 40% from the top, and it's an indirect play on aluminium. So that's another stock, in fact, that's moved up in the last few minutes. And we're talking about non-ferrous, but ferrous as well seems to be participating. So you have SAIL that's moved up. I think we should get a few of these names. SAIL, Rain Industries. A green-looking screen, at least as of now.
At least as of now, Nigel. Take that point perfectly. And one of the stocks which is doing extremely well, in fact, this has been fairly resilient ever since, the skirmish started as well. Over the last month or so, DMart has been relatively outperforming the overall market by a factor of almost 8 to 10%. And today, it's added another 8% in terms of gains coming in. And the biggest reason for that is the store count has accelerated. The store opening has accelerated. In just the last 3 trading sessions, or the 3 days, calendar days, the company has announced 20 stores being added, which takes its fourth quarter tally to be about 58 stores. And that's the highest fourth quarter tally that we've seen in the company's history. And importantly, if you look at it this year as well, FY26, they've added 85 stores. How does that compare to the last few years? It's a lot higher than that. And that was actually one of the biggest quibble of the investors, that, the company is not adding stores fast enough, and because of which the valuations were looking a lot more expensive. Earlier in the year, the company did go ahead and in its analyst meet say that they are looking to add 10 to 15% store footprint every year, and Neville Narona would be the one who would obviously lead growth in UP. Now, obviously, the company is led by Anshul Asawa. So under the new leadership, we are seeing, the fruits of the old leadership when it came to increasing store expansion space, bearing fruit. Let's see how the next year stands on the company's e-commerce front and revenue growth front as well. So of all the things that the company is fixing, this one definitely is something that the street likes. The stock over the last 5-7 sessions was up around 7%, and now add to that another 8% higher, way off its record highs. And if you look at, the valuations of DMart right now compared to a lot of the other retail players as well, it would now be comparable, because when it listed, it was the only one and was touted as one of the most expensive stocks. Now, time correction, price correction, and store acceleration has made the stock a little more favorable as compared to the others, and which is why it's higher.
All right. Thanks a lot for that, Mangalam. But let's move on then. Sources tell CNBC TV 18 that the government is exploring options to cool rising ATF prices. Shivani joins us to fill us in with all the details that she's picking up. Shivani?
Well, good morning, Nigel. Rightly put, jet fuel prices remain elevated, although, oil companies have partially shielded domestic airlines from the full global surge. The focus now is on what comes next. Sources tell CNBC TV 18 that the government is actively weighing multiple options to cool ATF prices, with VAT cuts and capping crack spreads emerging as the key levers. Now, remember, crack spreads, which is the refining margin on jet fuel, has surged sharply from typical levels of $15 to $30 dollars per barrel to around $70 per barrel. And airlines and oil companies are now working on a proposal to cap this between $10 to $22 per barrel to bring prices closer to the historical average. And at the same time, sources also tell us that the centre may engage with states to reduce VAT on ATF, a major cost component for airlines. Now, the broader aim here is to ease cost pressures, stabilize fares, and also support airline profitability, even as the global fuel prices remain volatile. Back to you.
Got it. Okay. All right. Thanks a lot for that, Shivani. By the way, just take a look at Interglobe Aviation, the top gainer on the Nifty, and it's just building on from strength to strength. We also have another gainer on the Nifty, which is Mahindra & Mahindra. The total tractor sales numbers, actually, they've come in much better than what the sheet was working with. So it's looking rock solid. Total sales number, a tad bit better, a wee bit better, but I think the tractor sales growth number is good. Remember, this is one of the high quality names that have done actually well and corrected more than 15% from the recent peak. So the street is clearly buying into that one, up close to around 3% the stock as we speak. PV sales up close to around 25%. Thumbs up on that name as well.
Thumbs up indeed, Nigel. You know, that's doing well. And the other nifty gainers right now, the ones which stand out, we just spoke about DMart. Look at the other retail player on the Nifty right now, Trent. Trent is also higher. You know, channel checks do suggest that Trent's store acceleration has also increased in terms of Zudio additions and Westside additions. That stock has been one of the worst performers in all of calendar 2025 and FY26, starting FY27 on the front foot. So that stock is up and about. Spencer's Retail, again, a beaten down name in the retail space, has also seen a big spike, up around 11%. Remember, this is a stock which is corrected over 60% from its highs at 27 rupees. You know, we've seen this stock move higher after a big cut and a lot of underperformance. And finally, Titan. This one continues to do well. There is a natural hedge in all these gold and silver players. If the gold prices are higher, their revenue is higher because gold value is higher. But if gold prices are lower, customers go and rush because obviously gold prices are lower, so that increases their volumes. And that move from unorganized to organized takes place for all these players. Titan up and about in today's trading session. Take a short break, come back any more on the markets. A lot of stock-specific action. Don't go anywhere.
Welcome back. Well, let's shift focus then to the US. Fed Chairman Jerome Powell, speaking to students at Harvard University, gave an outlook on how the conflict in West Asia could affect the Fed meeting its inflation targets. Let's listen in to what he had to say.
The tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between 0.5 and a full percentage point to inflation. But that's a much smaller thing than we saw during the pandemic inflation. And, you know, and of course now we're facing events in the Middle East, which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out. We've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while, and we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make that decision.
Take that point. They will be mindful of the broader context when they make the decision on the rates. Meanwhile, just look at a couple of these pharmaceutical stocks. They have been fairly resilient during this war period, uncertainty over the last couple of months. They've given decent returns as well, but now they're coming in for some bit of profit taking. So Lupin is currently at the low point of trade. We're seeing some sell-off in Torrent Pharma as well. Alchem Labs is the other one which has given up nearly entire gains of the today morning's trading session. And the weakest of the pack actually has been Mankind, which is now down about 11% this month and has corrected a goodish bit from its highs as well. So Mankind is the one which is at the low point of trade. But sticking with war and macros on that, we had a comment coming in from Warren Buffett too. Let's hear out what the Oracle of Omaha had to say.
The Fed can print money, and we have a President Trump, who would like to see the Fed cut rates. Would you cut rates if you were there right now?
I don't know what I'd do there. I wish they had a zero inflation target.
Right.
But, I mean, once you start saying you're going to tolerate 2%, that compounds pretty dramatically over time. And you're saying to people, if you're getting less than 2% on your money, you're going backwards. And actually, if you pay tax, you may pay tax on the 2%. I mean, I don't like that particular goal. But
so inflation is maybe what you'd be more concerned about. I mean, that's what Alan Greenspan always said.
Yeah, I would care about inflation. I would compare what I really would care about is the stability of the banks.
In fact, he says that he wishes the Federal Reserve had a zero inflation target, signaling, what his outlook was. In fact, you can get more excerpts from CNBC's conversation with Warren Buffett, the Oracle of Omaha. He says he remains closely involved in investment decisions at Berkshire Hathaway, even after stepping down as a chief executive. Let's listen in to a slice of that conversation.
3 times since I've taken over Berkshire, it's gone down more than 50%. I mean, if you look at the markets of, the worst probably was the 2007-8 period, although there was that one Monday when you had 21% in a day. I mean, this is nothing. I mean,
well, this is nothing to make you get excited and think there's huge valuation drops.
If they're 5 or 6% cheaper, that doesn't. We aren't in it to make 5 or 6%. I mean, but we aren't a big seller either. In the end, we own businesses. Sometimes they're wholly owned, sometimes they're partly owned. That's what I like to own. And 2/3 of our money or more is in our businesses. And we bought Occidental Chemical on January 3rd. That was $9.7 billion. And as far as I'm concerned, that's got some advantages, some disadvantages versus owning a stock, but it's got the same principles attached to it. It is a business, and it's a business we expect to own indefinitely. I mean,
it doesn't sound like you're necessarily finding businesses that you want to own flat out either, not just purchasing portions of them, if you've got $350 billion plus sitting around.
Yeah, and we get calls all the time, and they're silly calls, but like I say, it takes me 5 seconds to say no. Greg's a little more polite than I am, but I just as soon get the calls just to see what people are doing. But they aren't offering anything that's at an attractive price, and what they want is a trade.
Yeah. Are you waiting for the next big drop in the market to deploy that cash? And if so, do you see that coming?
Yeah, if there is a big decline, we will deploy. I mean, but we won't. We will deploy it because stocks are attractive or businesses are attractive to us, and we are not planning to sell them next week or next month. So we want to be right on them.
Right.
And we've had our American Express stock 30 years without having, Coca-Cola close to 40 years, 35 years. And on the other hand, there's things I change my mind on fairly quickly. But the goal is to own businesses.
Mm-hmm.
And when we buy Occidental Chemical, we expect to own that 50 years from now. You know, the world can change in some way, but that is, we do not buy that with the thought of resale.
You've sold a lot of a stock that's done very well for you, Apple.
Yeah, well, I sold it too soon.
Yeah.
But I bought it even sooner, so it worked out. Yeah, I think we've made over $100 billion in that pre-tax.
Yeah. But you're regretting it? You say you sold it too soon?
No. I don't have any ability to predict what stocks will do next week or next month. And I will buy them if they're cheap. I'll buy a whole lot of them if they're cheap and I think I really understand the business. And Apple is still our largest single investment.
Right, Apple is still one of their largest single investments. The market holds on to gains. The Nifty off its highs, but definitely not off color. The color is green and hard green, that too. We'll take your leave on that note on Chartbusters, but you stay tuned. The team of Trading Art comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. Joining me from the studios in Bangalore is Ritu Singh. Ritu, good morning. It's a fairly decent recovery from what we saw on Monday. And based on where the index currently is, of course, it is slightly off the highs of the day, but it has it has recovered the losses that it suffered on Monday, although still remaining significantly below where it was at the start of the year, Ritu.
Yes, it's a good start to FY27, Hormuz, and we'll take what we get. It's a massive relief rally on the after the kind of correction that we saw in the month of March. So at the moment, both the indices up by almost 2%. That's where the frontline indices are. And sectorally, almost all sectors are in the green, and leading the rally are the names of PSU banks. You have Nifty, Auto, both are up more than 3%. Of course, the geopolitical de-escalation is helping matters, and which is why if you look at the advanced decline ratio, which we'll put up for you, almost more than 17 stocks on the NSE are advancing for every one stock that is declining. So overall, it's looking good for the markets today. Crude prices, they've come down to around 104, 105. That's where they're currently trading. Keep in mind the rupee markets are closed today, so no shocks on that front on account of the money markets being closed. But Hormuz has walked over to the wall to give us a quick roundup of all the market movers today. Hormuz.
No bad news is good news, is at least that you can say from the money markets front today, considering today being a holiday for them. But the index is slightly off the highs of the day. At one point, we were well above the 22,900 mark as well. It's a bit of a 200-point cool-off from the day's high, still holding on to gains of around about 400 points is the index. And the broader markets too doing fairly well for themselves. In fact, the broader markets were fairly resilient compared to the index and the Nifty Bank in the month of March. So a 1,300 point up move on the Nifty Midcap Index, although that too has come off the highs of the day. But the one determining factor yet is the fact that oil prices continue to remain elevated. They have not cooled off significantly. Oil is still at 105. That remains the key monitorable to watch. And of course, the recovery in the Nifty has been led by the index heavyweights, be it Reliance Industries, be it HDFC Bank, be it the L&Ts and the likes. Infosys is up 3.5% as we speak. TCS is also doing well for itself. So that is one pocket that the index heavyweights are contributing to the recovery. Look at the defense names today. On signs when there are reports of de-escalation, defense stocks have shot through the roof. Garden Reach is up 16%, Cochin Shipyard is up 12%, Masgao Dock is up almost 10%. So all of them trading higher on substantially high volumes as well in today's trading session. So that's about the defense names. What are the other pockets that are doing well today? The one name that stands out is Indigo. There has been a new CEO in place. There has been a lot of flip-flop surrounding the ATF prices. There is finally some clarity that is emerging. The top gainer on the index today is Indigo, 8% higher on the stock after falling to a 52-week low as early as last month. Now, some of the other names that are doing well in today's session, the capital market names, with RBI deferring the implementation of the new norms to the 1st of July, BSC, Angel One, CDSL, all of them seeing gains of anywhere between 5 to 6%. NSDL, which slipped below its issue price on Monday, has also seeing a rebound 6% higher in today's session. Stocks that are on the radar, of course, for other news flow. DMart, of course, the store target being at 500 stores now, 7.5% higher there. Zaggle, after the FY27 guidance that the company issued, 15% higher. And RateGain, after Investec initiated coverage today, 76% upside there for the stock at 480, 10% higher on RateGain as well. And lastly, stocks that are bucking the trend in today's trading session. There are stocks that are not doing well, but of course, it's the gainers that are far outweighing the losers in today's session, Ritu.
Yes, Hormuz, the gainers far outweighing the losers in the session. One such stock that's been in focus is Sammaan Capital. It's up more than 1% today. Of course, the stock has been running up on the back of this deal, but now finally the IHC deal has been done. IHC, through its arm Aviation is acquiring a 41.5% stake through a preferential allotment, and it has come on board as a strategic promoter for Sammaan Capital. Now, the company has already got about 5,600 crores, and another nearly 3,200 crores is expected as infusion into Sammaan Capital in the next 18 months on warrants conversion. Now, once the open offer is done, which is mandatory for IHC to do, at 139 per share, their total holding in Sammaan Capital is expected to go up all the way to 63.3%. Now, in terms of the significance of this deal for Sammaan Capital, of course, it gives them that 8,800 crores of infusion, a stronger balance sheet, a stronger credit profile as well, and therefore improved access to funding. But more importantly, the plan now with this merger in place is to diversify beyond mortgages, become a more diversified company into MSME loans, personal loans, business lending, gold loans. So some of these higher yielding segments as well. Sammaan is going to be consolidated as a core investment under IHC subsidiary called Judan Financial in India, and that will co-anchor their India-focused private credit play as well. Now, once this is done, Sammaan says the target is to be among the top 3 NBFCs by AUM by FY29 in India. They also plan to have more than 15 products, 1,500 branches, and a 50 million strong customer base by the end of it all. Now, earlier today, we also caught up with Gagan Banga, who's the MD and CEO of Sammaan Capital, to give us more perspective on the deal. Hear out what he had to say.
Goal very clearly is first 18 months bump up profitability through a reduction in cost of funds. I expect about 200 basis points of stock cost of funds to play out over the next 6 to 12 months. And the 18 months after that, by which time all the new products would have been tested out and the tech play would have efficiencies would be getting witnessed. 29, I would look at a higher teen sort of an ROE. And the other important aspect would be the number of customers, because then you get the second wave positive impact of being able to cross-sell to those customers. So what we're targeting is roughly 5 crore customers by fiscal 29, and ROEs in the range of 18 to 19% by fiscal 29.
Sammaan Capital there, of course, stock that generally is in the FNO ban more often than not, as was the case all through the March series, but is out of the ban over the last couple of sessions, of course, since it is the start of a new one. It will be interesting to see how the stock moves now. 150 on Sammaan Capital. But as he just mentioned a few minutes ago, the defense stocks are on a tear in today's session, and not just the shipbuilders. There are the others also that are doing well, the likes of BEL and so on. BEL has received orders worth nearly 7,000 crore rupees in the last 2 sessions. Garden Reach, of course, giving out its FY26 updates as well. Ria is here with more details on that. Ria.
Well, yes, Thomas, BEL first up has received orders worth roughly 6,800 crores since its last disclosure, and these orders are for mountain radars from the Ministry of Defence and an avionics package for the LCA aircraft from HAL, and also a major export order for communication equipment, electronic fuses, as well as strategic components. Now, moving on to HAL, they have come out with their provisional update for FY26. The revenue has come in at roughly 32,250 crores, which is up just 4% on a year-on-year basis. And this compared to the guidance that the company had given. They had said that the revenue will grow by roughly 8 to 10%. So it is a miss on the guidance on that front. But the order book, however, remains quite strong for HAL at 2.54 lakh crores versus just about 1.9 lakh crores in FY25, and this is in line with the guidance that the company had given. Moving on to Garden Reach Shipbuilders, they've also come out with their provisional update for FY26. The revenue stands at roughly 6,400 crores, which is up 26% compared on a year-on-year basis. But again, this is also a miss on the guidance that the company had given. They had said that the revenue will increase by roughly 40% compared to the previous year. Now, there has been no update on the order book as of now, although the company had said that they are targeting a rupees 50,000 crore order book by the end of this financial year, but this hinges on the next gen Corvette order. So as of now, there has been no update on that. But overall, even after these weak updates, these stocks as well as the entire defense pack has been soaring in today's trading session. In fact, the Nifty Defense Index is up roughly by 5% at this moment.
All right, Ria, thanks very much for joining in with that. Let's slip into a short break on that note. But up next, we'll get you the big story of the day. You watch out for that one.
Welcome back. Well, just highlighted Indigo. That was the top gainer on the index today, continues to remain so. And there are multiple triggers surrounding that. Of course, there is a new CEO. There is a lot of back and forth over the ETF prices as well. How much have they been hiked and so on. The Ministry of Petroleum has also put out a release with the clarification. Sudarshan is here to summarize all of that for us on the ATF front. And then we go to Winnie for the new CEO. Sudarshan, over to you first.
So it's been an interesting last few hours as far as ATF price hike is concerned. Early in the morning when we came, we got a shocker of 115% increase in the ATF price. That was reflecting on IOC's website that ATF price is increased from rupees 96,600 per kiloliter to rupees 2.07 lakh, and that shows an increase of 115%. But after nearly 3 hours, there was a clarification from IOCs, and that was on website as well, that this increase, that 115% that you are seeing, it's not for domestic scheduled flights or domestic scheduled airlines. Following that, around 9:40 a.m., the revised prices have reflected on the website, and revised prices were 1.04 lakh, not rupees 2.07 lakh. And if you take it 1.04 lakh and compare from 96,600, that was on March 1, that shows an increase of 8.5%. So for companies like Indigo and other domestic airlines, ATF price increase from the month of March to month of April is 8.5%, not 115%. These details have reflected on IOC's website. Following that, we got a post on X from both Aviation Minister and also from Oil Ministry, and they are saying that ATF price in India have been deregulated, and that was done as early as 2001. And ATF prices are normally revised on a monthly basis, and due to West Asia war, ATF price for domestic airlines were expected to be increased by more than 100%, but government is saying ensuring domestic travel costs from substantial increase in international prices, OMCs have decided to pass on only staggered increase of 25%, only rupees 15 per litre. I'll explain it to you what exactly they mean by 25%. This information we have got from sources. They are saying in Delhi, ATF prices as of March 31, that is yesterday, was rupees 85 per litre. Now it has been increased to rupees 104. Now, if you do this calculation, this increase from rupees 85 per litre to 104, that goes to an increase of around 22 to 23%. So that tells you what exactly government means by 25% increase, or say rupees 15 per litre increase. Now, of all these factors, what exactly is the impact on Indigo? So for Indigo, 40% of total costs come from ATF, or say aviation turbine fuel. Now 8.5% hike is much below what analysts were expecting because of a sharp increase in international prices, and they were expecting an increase in the range of 50 to 100%. Now government has announced 8.5% increase, and that's reflecting in the share price. That's the reason Indigo is top Nifty gainer. At one point it was up as high as 10%.
Well, Sud, thanks for telling us about Indigo. But for the customers, just to be clear, on the domestic routes, unlikely to be any impact. But on the foreign routes, if the airlines do pass on this ATF hike, there could be some impact. Correct, Sud?
That's correct. So see, now government has gone ahead and increased ATF prices by 8.5%. So it's much below expectations. Now it tells you that airlines, they were supposed to increase airfares, but now with 8.5%, at least for domestic routes, they are not going to increase the airfares by like huge margin. But for international routes, ATF price would be as normal, I would say, increase of almost 115%.
Okay, with rupee at almost 95 as well, I guess the message is to fly local. Vinny, we also have William Walsh taking over as the new Indigo CEO.
Hi, Ritu. Good morning. So absolutely, William Walsh will be taking over as the new CEO of the company. And this has just come in 3 weeks after Peter Elbrus had actually resigned from this post as well. Walsh, now let's talk about him. 40 years of experience in aviation industry. Currently he's been with he's the Director General at IATA as well, and that's been since 2021. So he's got a lot of global expertise as well, and especially for Interglobe Aviation, they've been speaking a lot about their global expansion. So this comes in as a good strategy for them to get William Wash in place for their global expansion and growth phase as well. When you talk about it, what are the main priorities going to be for William Wash now? One, in terms of the crew issue that has been going on since December, those concerns were there. Then the increase in costs currently that we've seen in crude oil prices and fuel costs, how do they manage that? As well as anything in terms of balancing the low-cost model for the company will be key, and one of his main mandates that come in from this as well. What are analysts saying? They're saying that Interglobe Aviation's ambition to have a global airline and become a much more global airline, this William Wash as a CEO fits in the right place for them. Apart from that, overall cost management of the skills over there will be key to watch out for. But as of now, surely a bit of a positive coming in here, because the leadership gap that was there, that's filled in.
Leadership gap filled in, new CEO, ATF prices. There is a lot to track with regards to Indigo. Vinny, Sudarshan, thank you for those updates there. But shifting focus from equities to the commodity space, Manisha is here with the latest update. Manisha.
Well, thank you so much for that. I'm looking at agriculture commodities therein, and these are the agriculture commodities where we have seen an impact come in from the higher crude oil prices, which, by the way, have gained up by nearly 55% in the month of March itself. So I want to look at the palm oil prices, where the futures are trading at December 2024 highs, and that is because, one, the higher crude oil prices, which are trading above $100 a barrel, have led to a lot of edible oil prices going higher as well. So whether you have soybean or even canola or palm oil for that matter, trading quite positive on Dalian and on the Chicago exchanges as well. The major news, of course, comes in from Indonesia. Remember, they have been increasing their biofuel policy. Earlier, it was 35% blending, then it went up to 40%. And now Indonesia is mandated a 50% blending of palm as an ethanol, as biofuel from 1st of July. Now, what this has done is it's taken the prices higher. We also are looking at tightening in the international markets, and India is a largest importer of palm as well. So we could be looking at some challenges coming in there as well. When you look at the overall prices, they're up by 10% for the month of March and 14% for this year now. And then I also want to talk about sugar, because after 2 years of negative returns, sugar futures seems to be trading positive as well. It's trading at a 5-month highs. We've seen prices gain up by 13.5% in the month of March, and they are up 5.5% for 2026 as well. Now for sugar as well, with the crude oil prices rising, there is more sugar going in for ethanol rather than in sugar, and that clearly has been supportive for the prices. Also, markets seem to be getting influenced from higher crude oil prices. So both of these, in sense of biofuel and ethanol, seem to be doing quite positive.
All right, and on that sweet note, Manisha, thanks very much for joining in. With that, we have to slip into a short break. But when we return, we'll discuss the credit quality of India Inc. and the key risks that are flagged by rating agencies in just a bit. Welcome back. The market's very much in the green, but they've given up some of the gains in the last half an hour. You have the frontline index now at about 22,780. That's where it is at, up about 2%. But the advanced decline ratio tells you, I mean, we started the show with almost 18 stocks advancing for every one stock that was declining. That has come down to about 16 stocks that are advancing for one stock that is declining on the National Stock Exchange. India Wix quite high, still at about 25, but markets looking good for now. The Bank Nifty almost up more than 2%. So that's about where the markets are at. But, the retail interest, investor interest in IPOs, that has been waning a bit. And we've been talking about that here on CNBC TV 18, because after this frenzy of oversubscriptions, many investors are actually now turning a bit cautious because very many stock trades are now actually below the issue price. Now, Hormuz has compiled all of the data to look at this IPO performance, and he joins us from the wall in the studio. Hormuz.
Well, this data from Prime Database is fairly telling of what has transpired in the IPO markets in FY26. And although this has turned out to be yet another year of a record fundraise this time around, which is a 10% increase from FY25, almost 1.8 lakh crore, the other inside data does not paint a very pretty picture. Let's get to the equity fundraising first. This total public equity fundraising, which includes equities, debt, bonds, and so on, is down 18% in FY26. This is at 3.05 lakh crore rupees. That's the first bit. The average IPO deal size in itself is down over 20%. That's a 23% drop from FY25, and at almost 208 at 1598 crore compared to 2082 crore in FY25. Now take a look at the retail applications. The average retail applications in IPOs is down 40% in FY26, from almost 21 lakh to just under 13 lakh. That's the first telling bit. The second telling bit is the fact that the IPOs with the highest retail applications, let's first take a look at those. They had Bharat Coking Coal, which had the highest at almost 69 lakh applications. LG Electronics, which was of course the most bid IPO in the country, 54 lakh applications, and Meesho too at 54 lakh applications as well. Now take a look at the retail applications by value. In FY26, the total number was 57% higher than the total funds raised through the IPOs. That number is also down from the 103% figure that you saw in FY25. Now the average retail subscription as well for the IPOs is almost halved. Now it was 18x on average in FY26. It was 35x on average in FY25. Now the average, and there is a reason behind that too. The average listing gain for IPOs has come down to 8% in FY26 compared to 30% in FY25. So for those who played the IPOs as a listing game, they have not received significant returns as well. Now take a look at what the companies have used the fresh proceeds for. Most of it has been used for expansion and debt repayment, some of it for working capital, and some of it of course for general corporate purposes as well, but expansion and capex being the ones that are in priority. Now take a look at the 108 IPOs that were opened in FY26, only 37 of them are trading above their issue price. That's almost 30% ratio for all IPOs. Now take a look at issues with returns of over 10%. That number in FY25 stood at well over 71%. In FY26, that number is down to just 31%. And the average returns as well for IPOs, this is the one that sums up the state of the IPOs in the country. And FY21, the average IPO return was triple. That came down to 78 in FY22, came down to 48 in FY23, and then take a look at the last 3 years as well. It has come down to 16 in FY24, just 3% in FY25, and at the conclusion of FY26, the average IPO return is a negative 7%. That has been the state of IPOs. Of course, the last 3 months were a bit of a lull as well, but for those who were playing the IPO markets for big bang listings, they have been a disappointed lot this time around in FY26 with average negative returns.
And that is understandable, Hormuz. Staggering sharp data there. Negative returns now from triple-digit returns a few years back. Thanks very much for joining in with that. Now, two leading rating agencies have come out with their credit quality assessments, and the picture's a bit nuanced. Balance sheets are the strongest that we've been in a decade, but the West Asia conflict, the elevated oil prices, the shifting trade flows, all that is introducing risks that didn't really even exist 30 days ago. The critical question is whether India Inc.'s hard-won financial resilience is enough to hold the line. To answer that question and more, we have Sachin Gupta, Chief Rating Officer at CareEdge Ratings, and Arvind Rao, Senior Director and Head of Credit Policy at India Ratings and Research, joining us now. Sachin, Arvind, both of you, thanks very much. And Sachin, if I could start with you, your credit ratio actually has slipped from about 2.5% in the first half to about 1.9% in the second half. That's still above your 10-year average. But what is that telling us? I mean, given obviously the macro headwinds we're seeing in the second half, is there a structural shift or just a blip that could reverse come FY27?
Yeah. Thanks for having me. We have to note that this analysis that we do is for the past 6 months, and this whole event has happened about a month back. So for the first 5 months of this period, the going was reasonably good. Tariffs were kind of weighing down some of the ratings, the expected negative impact of that. But then that also kind of got cleared up, and we had a good number of upgrades. But then in the last 1 month or so, the number of upgrades have gone down because there is very lack of confidence in kind of upgrading the ratings, especially when there's a very broad-based kind of an impact. So overall, we are kind of watching the situation very closely. The thing is that while the impact is very big, but it can be undone to a large extent if this war ends. Now, that is really the $1 billion or $1 trillion question that no one knows. But we are kind of watching it very closely, and we have made some scenarios in terms of, what if the dollar is the crude is $100, $110, $120. So we are kind of analyzing in that basis, but it's really difficult to model it. But overall, last as you mentioned, the ratio was 2x, so which means there were 2 upgrades for every downgrade, and which is higher than our long-term average of 1.5. Going forward, obviously, the outlook is much more cautious. We will be monitoring the situation very closely.
Well, Arvind, your outlook at India Ratings seems a tad more optimistic than what Sachin is telling us. Your upgrade-downgrade ratio at more than 3x, for the full year is where we are seeing. Are you genuinely seeing corporate India in a better shape and a better outlook for FY27? Or, is it not fully pricing in some of the risks that have played out only in the last 30 days?
Good morning. Thank you for having me. We did see FY26 upgrades at 3 times compared to downgrades. And this was largely because of the balance sheet strengths, which we have been seeing for the last 4 years. The impact of the Middle East crisis, the Iran war, has been only in the last 1 month and has not been fully priced into the ratings. And we are in the process of assessing this particular impact. Our preliminary analysis suggests that if the war is short-lived, the impact could not be significant, given that we do have balance sheet strengths, which helps the credit profiles. And we do see that the A category and above ratings do have enough balance sheet strengths to take care of any short-term impact. Triple B is where we believe could start seeing an impact, and that too from a perspective of companies which have dependencies on energy, particularly the ceramics or to an extent logistics, glass. These are the sectors where we believe there is going to be an impact, but it all depends on how long this particular war continues.
Sachin, you mentioned briefly that you all are working with scenario analysis, and this is what may happen in a certain scenario. Let's take oil, for example. Now, there is this persistent threat of oil remaining at elevated levels even if the war comes to an end, because there is a supply problem which has been confirmed here. There has been infrastructure damage that will take months, maybe even years to repair. Oil will have that scarcity/risk premium associated with it going forward. How much do you see that to be an impact? Let's assume oil remains at around, say, about $90 a barrel for the next 6 months. What kind of an impact do you see?
Incidentally, our base case scenario is also that the oil, even if the war were to end, we are not expecting the war kind of continue for next 6 months, 1 year. But yes, still the base case for us is about $90, because even if, as you said rightly, the war may end, but the sensitivities will still remain in the supply chain. So yeah, so if we really run with the assumption of $90, then what we really believe is that the growth will come down by about 50 point. We are expecting a number of about 6.7% vis-a-vis the 7.2, which was our base case before this event happened. Inflation also we are expecting to go up by about 40 basis point or so at about 4.7%. The current account deficit is actually the one which will be impacted the most sharply. We are expecting a current account deficit of 2.1%. Vis-a-vis 1% pre-war situation. Dollar obviously will kind of be in the range of 93 up. And G6 also we are expecting to remain around 6.9 to 7% in this scenario. But the situation is kind of moving by the minute. So while right now we've taken a $90, but let me clarify this $90 view is if the average price for the crude for the whole year remains at $90. That is basis that we are kind of looking at it. And obviously there are some sectors which will be much more impacted, which are more sensitive to the crude. So airlines is one, because it gets impacted both on crude and on dollar, because their lease payments are in dollars and crude obviously is dollar denominated. So on both counts, plus traffic will also be impacted. Then petrochemicals, where feedstock is a challenge, because one additional point is that when we compare oil versus gas, oil, the supply chain can still be restored because there are these tankers, and we can maybe get from Venezuela, Russia more, and Africa, etc. But gas is a bit more lag time. We cannot generally get gases because there need to be more LNG capacities that need to be created. And if Qatar has kind of been impacted, as the news have been saying, then there could be a much more long-term impact. And therefore, the industries like petrochemicals, ceramics, fertilizers, they could have a little bit more long. The most difficult thing in terms of modeling this, price we can model, but the issue is in terms of supply. And if the supply is not sure, then the price becomes very, very difficult to predict as well. So that's really the whole problem, that it's really complicated to really analyze how it will be really the future.
And we've heard that from the horse's mouth itself, right? With Qatar Energy saying that almost 20% of its export capacity has been impacted because of this. But Arvind, oil is one aspect, gas is one aspect, but the other big aspect domestically has been the currency. And it's not as if the dollar has been strengthening significantly for the currency to depreciate the way it has. There have been multiple other factors that have been driving this currency depreciation. Do you believe that this could also, with the way the currency is depreciating, have an impact on corporate balance sheets, credit quality, especially for those that have significant dollar-denominated debt?
We did not expect the currency to move the way it has. It has depreciated significantly since the war has started. But in terms of the balance sheet, we do believe that there is adequate strength. Typically, as we said, in the A category and above, there is enough headroom for this sort of a depreciation to be priced in. However, the impact on the margins is what we are more concerned about, because margins could start seeing a bit amount of deterioration as pass-through of the higher prices could become a challenge. Overall, the amount of debt that sits, the forex debt that sits on the balance sheets are typically in the companies which are rated A and above. We don't see that kind of a pressure coming up because, don't want to jinx it, but the balance sheet strengths have been what is supporting and will continue to support even at the kind of current levels of currency what we are seeing. So we don't anticipate currency to be a major disruptor of the credit qualities going forward, unless this goes beyond as the war progress, if the war doesn't stop and the currency continues to be depreciating.
Arvind, quickly, that's about the currency, but isn't inflation the wild card here? I think even in your FY27 estimate of GDP, you're estimating a range-bound inflation. Now, if oil prices, some of this is passed on and, food inflation becomes sticky, and many in the market are now expecting a faster pivot towards a hawkish stance from RBI. How does that change your credit outlook for FY27 for corporates?
Inflation till now has been benign, and it has started inching up and is likely to inch up because of the kind of pressure we see from the energy supply and the price. However, our forecast hasn't yet factored in significant rise in the inflation as of now, because all our projections are based on the war not continuing for a long time. Our expectation is that it will end probably in the next, from the time it started, 0 to 3 months is what we have been factoring in. Based on those sort of estimates, we don't anticipate inflation to be a major pain point for credit profiles. While it will be increasing from the levels what we have seen, but we don't see that impacting.
All right, Arvind and Sachin, both of you, thanks very much for joining in with your take on that. We thank you for your time. We have to slip into a short break, but up next, we'll get Ajit Mishra, who's the Senior Vice President of Research at Religare Broking, to join in with his views on the market.
Welcome back. Still around about, 450, 500 points higher on the index, back above that 22,800 mark as of now. And the March net GST collections have increased by 8.2% from last year to around 1.78 lakh crore rupees. That's the net GST collection figure for the month of March. Of course, it's the start of the month, so plenty of updates will keep coming in on the macro front, on the auto sales as well. You keep an eye out on all of that. Good time to get in a quick chart check as well. Ajit Mishra from Religare Broking is now joining in. Ajit, good morning. Thank you for joining in. Well, the rebound that you have seen on the index, we have recovered all of Monday's losses, but do you use this as a reason to trim your positions down on the index, or do you remain in wait and watch mode? That's one. And your stock calls as well for the morning.
Yeah, good morning, Hormuz. So, Hormuz, yes, it's indeed a positive start to the series and to the month as well. As you rightly mentioned, that is just a rebound. Like, we have had these kinds of recovery phases in past also. Crude is still at 105. No doubt, India VIX has witnessed a decent decline. So we need to see whether this decline continues on both crude and India VIX, and that may result in a sustained recovery. So as of now, yes, it's prudent that you should reduce your position. Especially wherein you are stuck at the higher levels. For the index, I feel that 23,000, 23,200 will be the first area of resistance. So we are very close to that mark. So again, like for the index also, one should refrain from any overnight carry trade. In case if you are making any decent profits, you can continue to look for booking them. Now coming to the sectors, so basically metal and pharma, select energy counters is where we are seeing strength. So since the market tone is positive, one should look accordingly. So BEDL within the metal basket, wherein we see a noticeable strength, it's been continuously holding above its short-term averages also. So here one can look for long position with 665 as a stop loss and 720 as a position target. Then on the pharma basket, Oro Pharma is where we see consistency in the trend. The stock is up roughly around 3% in today's trade also, and we expect this momentum to further carry. So with stop at 1300, one can go long in Oro Pharma with 1420 as a position target.
Ajit, can you also quickly go back to which was the first recommendation that you gave?
That's Vedanta.
Vedanta. Okay. All right. Thank you, Ajit, for sparing time and joining us today with your views on the index and on specific stocks as well. From charts, we move to market fundamentals. Devang Mehta from Spark Private Wealth Management is now joining in. Devang, good morning. Thank you for joining in today. Well, there is still uncertainty, of course, around about this, despite being reports of de-escalation and so on. But the two biggest headwinds is that oil prices continue to remain elevated, and the currency, despite it being shut today, is still at record lows. Do you believe that these two continue to remain the two biggest headwinds for the market as we go into yet another earnings season?
Good morning, Hormuz. Thanks for having me on the show. A pleasure to be on CNBC TV 18, and that too on the first day of the new financial year, starting FY27. I think, yes, very clearly, it has been an extremely rough ride the last 2 years. If somebody has looked at, I think ideally zero returns from the index, and most of the portfolios, if they are mid caps and small caps, are sort of bleeding. And I think Feb was a good year, good month to be precise. But March again and again, due to the war-related tensions, has sort of seen huge corrections. So we know that Nifty corrected by 12%, and rest of a lot of indices by 15, 18, 20% as well. Now, coming back to the question, I think two things are very important here. I think, yes, of course, the headline remains crude, elevated crude levels, which comes and disturbs India's economic ecosystem. We know that, yes, we still import a lot of our crude requirements. We know that the Strait of Hormuz also contributes a large part of our requirements. I think all this news related, the flows that are right now are sort of circulating, will settle down once. But the second level impact of how much the supply chains have got disrupted, and the third level impact, which I always call about what are the companies thinking, right? So right now, I know it's 1 month elevated levels of say 70 reaching to say 110, 120, 130. But where does it settle down? Maybe if crude settles down somewhere around 80, 85, 90, I don't think it should be a larger issue because nobody else would have factored 50, 60 of crude. But yes, probably a little bit of elevated levels, a lot of companies would have the wherewithal to pass on the cost. I don't think they would face that sort of an input cost pressure. That's one part. The second on the currency, of course, it's again chicken and egg. While the FIIs you have huge outflows right now, they sell into Indian equities. I think this can continue for a while. But the larger sense is these are more, I can say, the numbers which are sentimental, which are psychological, and of course have an impact on India's current account deficit and fiscal deficit as such. But my sense that the larger part of where market will react is the earnings season that would start over the next 5-6 days. There, I think the commentaries would be very important. People would have felt a little bit of the impact in March, but how they comment, what is the vision, that's more monitorable.
Well, Devang, very happy new financial year to you. And, you in your notes say we're starting the year with 3 key positives amid all of the crisis that's around, and that is our low inflation, low fiscal deficit, and reasonable forex reserves. But even as we speak, all three are directionally pretty much under pressure. You haven't really changed your FY27 earnings outlook, but what are the levels you'll watch out for where you think you'll have to revise that outlook?
I think that's a very important caveat, and that's where we say that if this could have been negative, if we were facing an intense CAD pressure, if the inflation would have been higher, if India was not in a rate cut cycle, right, we would have had major issues. Relate to 1991, where India had just $1.8 billion of sort of foreign reserves. It was a tough situation. At that point, right now, we know that we are still a little bit under $700 billion of reserves. I think the starting point is not extremely negative. And that's why we take heart from that. If this situation is temporary, I think probably if it gets solved in the next 15 days, 1 month, 2 month period, the things would not get as extreme as market is factoring in right now. On the earnings front, the question is very relevant. What type of earnings cut would we see? Again, as I said, it is on the duration of the crisis that it's taking. Probably right now, what we see is, yes, the second level impact of crude rising, second level impact of currency impacting for certain importers would be, yes, there in 1 quarter or 2 quarters. But whether this will be long lasting for 3, 4, 5 quarters, I think that's a monitorable. And for 1 or 2 quarters, if it is going to last, I think market has factored in to a larger extent. And that's the carnage, that's the correction that we saw in March. And market is a discounting mechanism. Probably right now, they are experiencing that this correction itself is so sort of, it's such a large correction that I think most of the things are absorbed. But as I said, how much is the earnings cut? That is monitored probably in this quarterly numbers.
You know, Devang, the biggest talking point over the last couple of days has been this RBI deferment of the capital market rules that were supposed to take effect from today. They are now postponed it until July. But considering the situation that has been playing out in the market, the sell-off that you have seen, the STT hikes coming into effect today as well, how do you play this capital markets theme? Do you continue to persist with the discount brokers, the Motilal Oswals and the Grows, or you go for the asset managers, or you just play the big name that is BSE?
Ideally, this has been a segment which we sort of have liked very selectively, as I say, because most of the companies which are ex-banks in financials, right? I always tend to talk about this, be it a lot of insurance companies, be it asset management companies, be it pure play wealth management companies and exchanges, and depositories and certain financial intermediaries. Again, why this is a plethora of decent businesses, right? These are different segments of the same stream, which is called financialization of assets, which is called sort of organized wealth management. I think that is where India has been producing millionaires and billionaires by hours and days. That is one part. The second, of course, we all know that the penetration and density of equities in India had traditionally been less. Over the last 4-5 years post-COVID, this has been rising. Yes, there can be different set of data points which we'll talk about, probably some SIPs closing down, some accounts closing down or not holding larger balances. But my sense that typically if India has to grow from here on, financialization will take place. And there has been people talking on records, and these are official people talking about 20-22 crore demat accounts right now, probably reaching 40-50 crore demat accounts, as well as the financialization wave taking shape in a very, very organized way. So my sense that a lot of these companies, be it wealth management, be it depositories, be it exchanges, asset management and insurance, you have to be in certain segments of this. And there are, I can say, a lot of these companies who are seeing ROE expansion, who are seeing revenues and profitability also rising during tough times. So yes, this will offer you a bit of cyclicality, but I think most of these stocks have gone through a correction. So I think it's an opportunity in adversity during such periods.
All right, opportunity in adversity. Devang, on that note, we'll bid you goodbye and thank you for your time. We have to slip into a short break, and up next, we'll get you more on the markets after this short break.
Welcome back. There is an ever so slight cool off from the recent levels. We were just above 22,800 a while back. We are back at 22,750 currently. Still holding on to gains of around well over 400 points on the index. So still no reason to complain whatsoever. But a couple of names that are doing well. We highlighted the defense names, but look at Godrej Industries. That stock is up 15% now, among the top gainers on the Nifty 500 in today's session. So good going for Godrej Industries. That stock is near the highs of the day. Hindustan Copper is up 9%, and that's doing fairly well for itself as well after the recent sell-off that you saw in the stock. Speaking of sell-offs, Ola Electric is up 8% today, and that's after the battering that it has taken from 150, 160 rupees, the post-listing high. The stock is now down to 25 rupees. So 8.5% higher on Ola Electric as well. And a couple of names that are bucking the trend. Hyundai Motor is one of them, down 3% now, extending its losses from the IPO price. First day as an FNO stock, and not doing well for itself is Hyundai Motors. Take a short break, get more on the macros on the other side. Stay tuned.
Welcome back. It's time for our macro signal segment. Now, FY26 was a year the Indian banking sector would rather forget, but at least on the earnings front, there was quite a bit of pain. Now, the banking benchmark index will give you the picture. Nifty 50 falling more than 5%, Nifty Bank slipping 2.5%. But within all of that doom and gloom, stock pickers did have some reason to celebrate, with more than 20 banking stocks delivering returns of more than 25% in FY26. Now, start with the big picture. India's banking sector market cap has expanded from 91 lakh crores in FY25 to 108 lakh crores in FY26. That's an 18% jump in a single year. And the drivers of that expansion, it's not your, darling of the D Street large private banks, but more PSU banks, NBFCs, and even fintechs that did the heavy lifting. Now, the fintech space, interestingly, alone, that barely existed 10 years ago, listed and unlisted combined, now command a market cap of more than 13 lakh crore rupees. Now, look at who won and who lost in FY26. Names like RBL Bank up 69%, AU Small Finance Bank 59%, Indian Bank another 58%. The pattern here is very very clear. PSU banks led mid-sized private lenders dominated the space. SBI delivering more than 29% returns. This is the PSU bank decade, continuing to play out. And the laggers, on the other hand, you have SBI Card that lost 26%. Kotak Mahindra Bank was down 19%. HDFC Bank, we've been talking about 18%. ICICI Bank again down 10%. And the large private banks, the one that drove returns for most of the last decade, had a year to forget. Now, unsecured stress, margin compression, slower loan growth, all of that played on their earnings. Now, here's a critical question. Where do earnings go from here? Because FY26 was effectively, what some are calling the bottom. Sector earnings growth collapsed from a 40% CAGR between FY21 and 24 down to just 5% in FY26. But the likes of Motilal Oswal Research, for instance, are calling a recovery 16 to 17% earnings CAGR over FY27 and 28. For large private banks, they estimate 17% growth. For mid-sized private banks, which took the deepest cuts in this cycle, a sharp mean reversion is expected, a 63% CAGR over FY26 to 28. PSU banks steadier at about 11% as well. And here's one data point worth sitting with. In FY20, PSU banks were collectively loss-making, a negative 260 billion in profits, that is in loss, while private banks were at 191 billion rupees. Fast forward to FY26 and PSU banks are estimated to pip private banks on aggregate earnings for the first time in years. So nearly 2 trillion rupees each. That's, a structural turnaround of remarkable scale. And hopefully the road into FY27 looks better as well. But for FY26, banks were down, though not out. On that note, we're going to wrap up this edition of Trading Hour. From Hormuz and me, it's a goodbye, but stay with us. Halftime report will take all the action forward.
Stocks charge up after Trump says US will end the Iran war in 2 to 3 weeks. Industrials, IT and metals are the big gaining sectors, while mid-caps outperform.
Intergroup Aviation soars after the government reins in price hikes in aviation turbine fuel by getting oil marketers to pass on only a partial increase in cost. A decision to appoint Willie Walsh as Indigo CEO also gets thumbs up from investors.
Bharat Electronics bags orders worth nearly 6,800 crore rupees in a day after bagging orders worth 1,660 crores between March 17th and 30th. leading to a sharp surge in the stock and driving up all the other defense scripts as well, despite some weak business updates coming in.
Sammaan Capital aims to be the number 3 NBFC in the country, with the IHC taking control. CEO Gagan Banga says sees lower costs of funds and a wide product pool, helping the mortgage company transform into a healthy, diversified lender.
Warren Buffett tells CNBC TV 18 that the interconnected nature of the banking industry makes it fragile, and he would like the US Fed to focus on the sector. He discloses purchasing treasuries but adds that he will buy big stocks on a decline.
Hello, good afternoon. You're tuned into Halftime Report, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Mangalam Malu. Mangalam, good afternoon, and it's a good day, at least coming in for the markets. 22,800, about that level is what the Nifty is trading at as of now. All the sectors are also managing to hold on to that green. So at least the first day of April, I don't think that we're going to be complaining much, but we've seen a very sharp fall coming in the last 1 month due to the uncertainties on West Asia. At least today, some bit of a commentary coming in from Trump is keeping it on the positive side, but tomorrow is a new day and we never know where that's headed.
Yeah, but you know what's making us happier today is the fact that the Nifty Bank is outperforming. After a very long time, the Nifty Bank was underperforming. And now as we speak, the Nifty from the lows has seen a recovery, and that's because of the Nifty Bank, which has spiked to about 2.65% in terms of gains. And a large part of that, while can be attributed to some of the heavies, just look at SPI. SPI has shown a big spike in just the last few minutes. So that is another stock which we are tracking as we move forward, and no problems with the broader market. So 2-3 data points that tell you that the market's better placed today than what it was at any recovery in the last 1 week or so. Was one, that the market breadth is firmly in favor of advances. 2,800 stocks advancing, just under 160 stocks which are declining. So those lines are fair and square above each other, that distance maintained through the course of the day. The second data point is that the India VIX is lower by 10%. So now we've seen a near 10% correction on the India VIX. At any point in today's trading session, it's only been trending lower. So as we speak, holding above that 25 mark. And the third point is that we've seen a big gain across the board in the mid and small cap space. So a lot of these high beta names doing a lot better today. Typically, they do better when the mood of the market is a lot better. So we'll talk a lot about that, and let's tell you what we have on the show today. We'll put the spotlight on Indigo amid the ATF price hike and the new CEO. Take the conversation forward with Martin's Consulting, Mark Martin. We also have a discussion centered around the MSME sector and the impact that the West Asia war could have on that, for which we have Karthikeyan Murugaraswamy and Sunil Chodia who joins in. And in our special segment, Crypto Corner, we bring you a conversation that Manisha had with Trilegal's Jaideep Reddy. But before all of that, a lot of stocks buzzing. So let's go across to Vivek, who's standing with that list. Vivek.
Well, thank you so much for that. After a while, we're seeing a very strong advance decline ratio. Most stocks in the green, in fact, overwhelmingly so in favor of the advances. In terms of individual names, well, can't look beyond the capital marketplace. Remember, they've been beaten down quite a bit. BSE, Angel One, both of these stocks are recovering and seeing a relief rally after the fact that SEBI has gone ahead and ensured that RBI has given a relief in terms of capital market exposure from banks is concerned. On back of that, both of these stocks higher by over 6 and 7% respectively. The other stock on the radar is Garden Reach Shipbuilder. In fact, most of the shipbuilders' defense names are buzzed today. Garden Reach has given an update saying that FY26 revenues will be higher by 26% on a year-on-year basis. While this falls short of the management guidance, it's still quite healthy. On the back of that, that stock is seeing a bit of a relief rally, almost 19% higher. BHEL is the other stock on the radar. A very large order win coming in from NTPC, over 13,500 crore, and favorably placed in more orders as well. That particular stock doing quite well in the session. Bharat Electronics, till March 30th, that particular company was actually falling short of its order inflow guidance. In the last 2 days of the financial year, the company has managed to exceed the order inflow guidance that it had given at the start of the year. Capital Goods, as well as other defense names, a whole host of them doing quite well. Bharat Dynamics, Mascot Dock, Cochin Shipyard, all of these names above in the session, all up over 10% and very healthy volumes as well. The other set of stocks doing quite well, the entire IT pack. Have a look at most of the IT names, a couple of upgrades coming in, some approvals coming in. So L&T Tech, Birla Soft, Coforge, all of these names up anywhere between 4.5% to 7%. And Keep an eye out on DMart as well. The sole outperformer, especially in the consumption space, is concerned. Strong store openings is something that the company has shared. That particular stock high by over 8%. Don't recall the last time seeing such a sharp move over here. On the other hand, quite a few laggards as well. The entire OMC pack, opened sharply higher, has cooled off a little bit. They will bear the brunt of most of the discounts being passed on to the aviation names as well. Keep an eye out on Hyundai. It's one of the biggest laggards as far as the auto space is concerned, and the entire pharma pack, a bit of an underperformance, a relative underperformance compared to the rest of the market names like Dr. Reddy Supla underperforming today.
Okay, thank you so much for that, Vivek, for highlighting those important stocks that are moving around in the trading session. But let's move on and put the spotlight on Interglobe Aviation. The stock has jumped up in trade, and this came in after there was a jet fuel price clarity that came in. There is an increase in cost over there, but not as much as one was fearing it to be. The Ministry of Petroleum also said that only passes on a partial as well as staggered hike in the jet fuel prices as well. We have Mark Martin, who's the founder and CEO at Martin Consulting, joining us right now to talk to about aviation space, ATF prices, as well as Interglobe Aviation's new CEO coming in as well. Mark, good afternoon. Thank you so much for joining us on the show. Let's start by first talking about the ATF prices, right? There was a lot of confusion that happened this morning, but finally the ATF prices that have come in, which will be impacting aviation companies, would be at around 1 lakh. Is what the price is for ATF prices. So that's around an 8.5% increase when you compare it. What's your thought on ATF prices? And given that aviation companies have already passed on some bit of it, is there any possibility of rollback? Is it already higher than what one is anticipating? What's your view here?
Good afternoon, CNBC. I think what we have to understand is that airlines were pretty trigger happy, and they chose to raise their fuel surcharges 2 weeks ago, which is more of a panic move as opposed to a calculated move. Obviously, we still had a significant stockpile of jet fuel from January and February, which were post winter. That's when airlines really stock up on a whole lot of jet fuel. Coming March is when all hell broke loose with the US-Iran war. But from what we have now, I think I think it was very clear that the revision in fuel prices would only happen after 1st April. Yet airlines chose to increase the fuel surcharge. I'm surprised why the government did not really correct them at that stage. Anyway, now with the way that airlines have raised fuel surcharges, this is Indigo, Air India, Akasa, and SpiceJet, the surcharge that they've raised doesn't reflect on the actual price of 8% on jet fuel escalation. So we have to understand that 80% or 70% of a typical airline's operation is within India. It's the domestic aviation market, and 20% is international, right? So I'll justify the international surcharge that airlines have raised because those prices are fairly expensive in Europe and most parts of the world. But I will not justify the escalations that they raised for jet fuel pricing surcharge in India. And airlines will have to, announce a rollback or figure out some way to refund that rise back to the traveler.
All right, we take that point as we speak. The stock's doing well, though it has. It's been one of the worst hit ever since there was a lot of conversation around it. There were the leadership changes that took place, and speaking about leadership changes, Willie Walsh, what do you make of him? I mean, one part of the street was anticipating maybe, someone local joins, runs the company. But on the other, Willie Walsh is known for running, a business through crisis. In fact, he turned British Airways around through the global financial crisis when that happened. So with all of these, the credentials that he brings and, where Indigo is at its stage in life, what do you make of this appointment?
Wiley Wash's appointment is the most ridiculous I've ever heard or seen ever in my career. You're getting somebody who runs full-service airlines which are union-laden. And he comes from IATA, and we must understand there's a very common bond that all IATA airlines share, and that is they're extremely heavy, they're monolith, and they're all loss-making. Okay, so you brought somebody from IAG and then British Airways, and then for the only way to get their point across is to push as a lobby group, and then guess what? He goes over to IATA, which is nothing but a lobby group and a monopolistic, an airline that promotes monopolies in the world. And let me be clear, IATA has been very, very open in its views when they've gone against low-cost carriers, and IATA is vehemently against low-cost carriers in the market because they pose the biggest threat to their members. In the European Union, the EU has actually taken IATA to court for cartelization and creating monopolies. So now you bring in, Wiley Walsh into a low-cost airline, an airline with insanely high agility, efficiency, 350, 400 plus aircraft, one of the largest airlines in the world, somebody who's never worked on low-cost carriers or LCCs, you're bringing him here to get him to fix the house. I mean, that's the most ridiculous thing. It's like taking, the chief chef from the Taj or the Morris Sheraton and asking him to open a vada pav shop outside, Bandra Kurla station. It doesn't make sense at all. The ideal CEO for somebody for Indigo should have been somebody who understands consumers better, someone who's far younger, somebody from telecom, maybe Coca-Cola or something like that, where you reach out to a mass audience and you're able to sell at price point rather than luxury. And Indigo is not a luxury. Indigo is a low-cost carrier, at best a hybrid airline. So bad choice over there. And I agree with you. I think it's absolutely ridiculous and appalling that we can't find ourselves a reasonably good, decent Indian CEO. This is something which is shameful. And I'll be very clear, investors are not stupid. When they put their life savings in stock, their research is far better than yours and mine. And they will research Wiley Walsh's background, everything prior to investing in Indigo stock now. And I think, Wiley Walsh coming in from, I think, August 1st is going to send, shudders down anyone's spine, because you're getting somebody who's got no experience and zero understanding of the low-cost carrier airline industry. And you're getting him from an organization that's always talked negative of India, has lobbied against India and lobbied against LCCs. And now you want him to run a low-cost carrier in India, which is the fastest growing market in the world? It's not going to happen. So, the bigger issue I have, guys, is that there's a message here. If Rahul Bhatia chose him, it just means that Rahul does not want this airline to be a low-cost carrier anymore.
Yes. Maybe that's the change in strategy. Maybe that's something we'll keep an eye out on. But Mark, thank you so much for joining us for the conversation as well today, and helping us understand ETF price changes as well as the new CEO for Indigo, what it means as well. So thank you so much for joining in. But on that note, we're actually going to slip into a very short break. And after the break, we'll be putting the spotlight on the MSME sector and how the ongoing conflict in West Asia is affecting it. Stay tuned.
Great going for the market. That explains why we are seeing an extended piece of gain in the market from the lows. 100-point up move is what we've seen from lows 15 minutes ago, and the biggest reason could be attributed to Brent. This morning when we started trade, it was about $105 per barrel. When we ended trade on Monday, it was $115, so $10, and now it's on the verge of breaking $100 a barrel mark as well. So that's something that we will be monitoring. Important, data point coming in. Brent is something that we will track, and the market continues to do well. But the impact of all of this, has it had a toll on India Inc. so far? Yes, indeed. That's the word coming in from the CII President Rajiv Mani while speaking at the CNBC TV18 CEO Centimeter, who also added that inflation is set to remain elevated over the next 6 months.
I think inflation will be high in the next 6 months. For sure, GDP growth will get impacted, even if it was to end in a very, very short time frame. And I think the CA and all the others have already suggested some numbers. And I think the impact on currency will not, even if it ends, it's unlikely to unwind at a pace for the reasons that were mentioned earlier. There are lots of other factors at play.
Meanwhile, CII's Director General Chandrajit Banerjee spoke about the possible relief measures for MSMEs and what will ease this immediate pressure. Listen in.
We are really looking at which doesn't really stress the fiscal. Say, for instance, very simply, a moratorium, say, for instance, for our small, mid-sized companies, which faces many challenges at this point in time. Second, of course, easier way when we look at this, if we can work in partnership, when we look at transition, say, which is for ethanol blending, say, for instance, that's something that we could work together in a very strong way.
All right, so to take this conversation forward, we do have with us Sunil Chodia, who's Chairman of CII International MSME Council, and also the CMD at Rajarathan Global Wire, Karthikeyan, who is the President at Coimbatore District Small Industries Association, who joins us as well. Thanks a lot, gentlemen, for joining in. Coming to you, Mr. Chodia, first, as the leader for MSMEs or the representative for MSMEs, what's the kind of impact, the MSME sector in the country has had so far because of the war? Importantly, how is this likely to pan out even if the war, say, ends in the very near future, as the market moves are telling you so?
Thank you for this opportunity to talk about MSME and how they have affected. So let me tell you that MSME constitutes about 31% of total GDP in the country. And it is about 35% of manufacturing output and 48% of exports. So MSME is the second largest employment generator after agriculture. So, and the effect of this war and the disruption in supply chain, disruption in logistics, and also availability of fuel and energy has become very crucial for MSME to continue production and continue operations. Okay, and it has a disproportionate effect on the MSME because of this, disruptions. And particularly in some clusters where their dependence is more on LPG, we see the effect is very high because LPG, India imports 50% of its LPG. And there is a shortage of LPG. However, government is taking enough steps to ensure that MSMEs continue to get supplies of LPG. But currently, when we are talking, things are still very volatile and very fragile.
Absolutely, sir. Point taken there. Karthikeyan, good afternoon. Your thoughts coming in here as well. And obviously, in the recent news flow, also we're seeing that LPG prices, they have also seen a hike. The 19 kg commercial LPG, those prices have also come in as an increase. I think your last comment came in was around 30% of these MSMEs have already shut down. This was somewhere around mid-March. As of date, what is the number here? Are we seeing further closures for MSME, the pain? And what will this LPG increase in price mean for them as well?
Yeah, I'll just give you an update. From 9th of March, the LPG supply has been completely stopped. The commercial LPG has been stopped to the MSMEs. So what happens is, the MSME, it's a supply chain. You have to understand if an end processor powder coating unit shuts down, the manufacturer of, steel fabricator will stop his production because ultimately the production is not going out. It's a cascading effect, I would say. So what happened is, even though powder coating is 5 to 10% of the value in the supply chain, but what happens is they are the finishers of the product. So the product doesn't go out. So if LPG was shut down without prior notice, they have they zero down the supply to us. You know, we have asked for at least 40 to 50% of LPG supply, because there are units which 100% depend on LPG supply. You know, there is no alternate, like electric ovens can be used, no other, you know, you cannot use furnace oil, you cannot have any other alternate fuel to substitute the finishing process, or in production for foundries, we need to, the LPG is used in core manufacture. So this is the basic raw material required for any foundry to start. You know, they require this LPG to the maximum, because everything is a continuous process. You know, in foundries, most of the foundries are continuously working. Then if you see in garment finishing also, you have LPG fully getting utilized.
Right.
So what happened is, from 9th of March, cascading effect has started. Initially, we predicted only 10% of MSMEs to shut down. So in mid of March, we were expecting 10 to 15% shutdown. But what happened is, as we got the information that LPG is not going to come for the next 2 to 4 weeks, what we decided is we cut down our production by 40% in the mid of March. So we were able to sustain till now. The production has not completely shut down for a lot of industries. We are running it. We are keeping the employees, you know, Coimbatore employees, more than 4 lakh migrant employees.
Right.
Here.
No,
So
we take that point. We take that point that the situation has had a bit of a bearing on businesses across the board, and of which MSMEs have been fairly worse hit as well. Mr. Chodia, you also had a listed company, Rajratan Global Wire. So let me ask you from that perspective, what has been the production loss for you in the fourth quarter, and what is the kind of sales and cost impact that you expect in FY27 when it comes to volumes?
So, there is no production loss, because we continued operating, even buying the gas. We use LNG for our furnaces. We continued buying on a spot, which was available from GAIL, and we produced the desired quantity, and we could honor our commitments to our customers. But there is definitely a dent on the profitability, because we paid a huge price for fuel, and that will affect our bottom line. But going forward, there is a cut in the production, because gas is not available, including a lot of packing material. Other components have become very expensive, and passing on all the cost to customer is very, very difficult. Yeah.
So what kind of impact do you expect on your margins in the fourth quarter and in the first couple of quarters?
No, I cannot comment right now on the margins in the fourth quarter, but definitely there is a big impact on the fourth quarter profitability. But now in the first quarter, there will be an effect on the total production also.
Mm-hmm. Karthikeyan, a quick one. So 30% of MSMEs in Coimbatore, that shutdown, that number is right, or is there an increase in that number?
It is. We are trying to maintain the production. We are not trying to completely shut down. We have reduced the production for the last 15 days. So that has helped us. You know, the migrant laborers have gone for the Holi and the Ramzan. So we were saved because of the manpower shortage. Our production was, we were able to reduce the production. But we had already reached a stage where LPG is completely exhausted. We normally, MSME have 15 days stock of LPG. That is the average stock we maintain. So this 15 days, we are trying to utilize it for 20 to 25 days because of our 40% cut.
If this war continues, if this war continues, would this number become worse? Even if it continues maybe for a week more, then where do we see this number? Is this going to become
actually, yeah, there's going to be effect. But what we are also looking at, a few have switched over to alternate, like electric ovens. They have started using. We have requested them to run the industry in electric oven rather than depending on LPG. So a lot of industries, but they were like 10 to 15% only of the industries who had electric as a substitute. They were not running, but they had a substitute as well. Or if they are having 10 machines, 3 machines are in electric, 7 machines are depending on LPG. So they were able to run the 3 machines or the 15 to 20% of the equipments in electric. So that is saved as of now. But the things to improve, yesterday we had a meeting with the district collector saying that piped natural gas is being pushed in and faster implementation is going to happen. The PNG had taken 4 years in Coimbatore to, pipelines have been laid, but it's an 8-year project. So what they said is, sir, now every road can be dug. It is a in principle approval given by the government of India and the state government. You can dig the roads if you wanted to lay the pipelines. So we expect this to improve drastically, but it is going to, they still project 4 months minimum time for minimum of the industries to get. As of now, only 10% to 20% of the industries can only get PNG lines. But within 1.5 months, they said another 30% can be improved. And in the next 4 months, another 30% can be improved. But for few industrial areas, lines are not there. PNG line, laying down the manpower also is very less. And it's it is high time we move on to
focus
PNG.
on PNG as well. That's what you're talking about. And that is what is something that will support even the growth coming back from here on as well. Okay, Karthikeyan as well as Mr. Chodia, thank you so much for joining us on the show, helping us understand this as well. Thank you so much for joining in and explaining us the impact that comes in for MSME and maybe solutions that come in there as well. But a quick update in terms of Brent crude oil prices, below $99 per barrel as of now. That's a Brent crude oil, dropped over 4%. And obviously, this is tracking the updates that we've seen coming in from the West Asia war side as well. Any update that comes in on that front. But as of now, a sharp correction in Brent crude oil prices. Morning, it was around that 105 and above that mark. So we've seen a bit of a decline coming in and now below $99 per barrel. It's interesting to keep an eye out on this one today in the trading session. But on that note, we're going to sip into a very short break. We'll come back and we'll have Sachidanand Utekar of Trade Bulls joining us to talk about trading strategies. Stay tuned in. Welcome back to Halftime Report in CNBC TV 18. While crude obviously has seen a sharp drop, Nifty managing to hold on to 22,800 above that mark. But what are the important cues that you should keep an eye out on in the world of F&O? Mangalam is at the F&O desk now to take us through that update. Mangalam, over to you.
Well, it's the start of a new series, and the Bulls would be very happy at the start of the April series. Perhaps it's the Bears who may turn into the all days, all Fool's Day. But importantly, the Nifty Bank and the mid-cap index, all of them doing extremely well in trade. And that's, supported by a few important data points. The first one, which is a positive, is that we've seen fear subsiding. India VIX is down by almost 11%. So that's a positive. We have the market breadth, which has maintained its gap through the course of day. In fact, if anything, it's only adding on to that. So 150 stocks declining for almost 2850 stocks which are advancing. So all these factors working well. And all of this is backed by the other important data point, which is an important sentiment of how the war is going, and that's Brent. Brent prices have cooled off as well. Now, as we speak, just around that $100 per barrel mark, briefly went below 99 as well. And we are seeing the nature of stocks which are buzzing as well. They're very high beta. So we have Mazagon Dock, Bharat Dynamics, Hind Copper, all of them, the ones which were gaining before this skirmish started and now continue to gain. Avenue Supermarts, a beaten down name as well, doing well in today's trading session. The only couple of stocks that we need to monitor from here on would be something like a Blue Star and Voltas. They're underperforming in an otherwise buoyant market because ahead of summer, there are reports of, rains across parts of the country. If that were to happen, then this summer demand could be washed away as well. So which is why these stocks are a little on the tenter hooks. But for the market, a large part of the up move has been led by the 22,500 call, 22,600 call. All those guys who had written calls at the start of the series, them having been caught on the wrong side, so they are taking the market higher. But alongside that, as the markets moved higher, the 22,800 put writers have seen a lot of action as well. So these are options that expire next Tuesday. Obviously, between next Tuesday and now, we have just two trading sessions. That's tomorrow. Friday is a trading holiday. Then you have Monday. So we'll monitor how the premiums out there pan out. But for now, the 22,800 put writers are hoping for some support to come by at around that 22,550 thereabouts. The 23,000 call writers are also very active. Today's high on the Nifty is a little over 22,900. Whether that sustains and crosses or not is something that's very important because 23,000 call, which has a premium of almost 230 rupees, telling you that around 23,200 to 23,250, there would be important resistance coming in for the frontline index. But amidst all of this, a lot of stocks are seeing long positions being added. Bosch is one of them. Nuvama Wealth is the other one. CAMS also is seeing a lot of long positions being added.
Okay, Mangalam, thank you so much for the roundup there in the world of F&O. But let's also bring on board Sachitana Dutekar, VP Research Derivatives and Technicals at Trade Bulls, to take us through some bit more in terms of markets as well as individual bets that he's looking at. Sachitanand, good afternoon. Thank you so much for joining on the show. Today surely is a better day coming in. Any levels that you're keeping an eye out on? Mangalam did take us through some of them. What are you watching out for?
Good afternoon, Vinny. Good afternoon, Mangalam. I think the key levels have already been discussed, 23,000 being one of them. And it is very significant because if you look at the last sequence of 7 trading sessions, we have seen the Nifty still continuing its low top, low bottom, formation. But if you look at the placement of its RSI, this is where, there is hope that a positive 3-point divergence may trigger that particular upside of 23,000. And we may see further, unwinding, which may push the indices higher. So if you look at the Nifty sequence, we are having some evidence of a base somewhere close to around 22,700, 22,800. The Nifty has been trending confidently above its 5-day exponential moving average. Probably in a day or so, we may see this level of 23,000 getting breached, and we may see the rally extending towards 23,000, 245, 300 kind of a zone. So I think it's better to be on the long side when it comes to Nifty. When we look at Nifty IT, I think significant development has occurred on this particular index. Now, since February 2026, we have already seen a very sharp decline in this particular index, and the prices were failing to sustain above its 20-day exponential moving average. Now, this is the first trading session wherein the prices are sustaining above the same, and that's why we believe that there is some hope from Nifty IT as well. So we may see a good support from banks and IT contributing towards this particular push. and we may see the Nifty, surpassing that 23,000 hurdle as well.
Right. You do expect it to surpass the 23,000 hurdle, but Sachi, individual stocks, what are you backing?
Good afternoon, Mangalam. Persistent systems is something that we have recommended to our clients. If you look at the overall setup, even here, the stock is sustaining well above its 20-day exponential moving average. And plus, if you look at the placement of the RSI, it has already given a breakout above that 50 mark. So we are expecting a good turnaround. We've already seen a good price action unfolding here, but we expect this particular rally to continue towards 5,200. And that's why we are, continuously building long positions. Recommending fresh long positions with a stop loss at 49.60 on closing basis. One can still, play for a move towards 5,200. On the short side, there is Bharti Airtel, which is still in a low top, low bottom sequence. We have already seen development of a bearish pennant formation. Even today, we have an open high formation on the daily scale. So we are expecting that 1800 support may not hold and we may see some decline here. So keeping a long short ratio, one can go long in persistent systems for a target of around 5,200 and short Bharti Airtel close to around 1810 levels, keeping a stop loss at 1825. We may see a drop towards 1740 soon.
Okay. Sachi, thank you so much for joining us on the show, taking us through important market levels as well as individual stock names. But on that note, we're going to slip into a very short break. On the other side, Manisha Gupta will be in conversation with Surendra Mehta of India Bulls and Bullions as well as Jewelers Association. So stay tuned for that conversation.
Welcome back. 22,850 and counting for the Nifty and Eternal doing well in today's trading session. These platform companies typically do well when the market feels a lot better. And the incremental update is that Blinkit is now operational at the Terminal 2 of the Mumbai airport as part of their expansion plan. So obviously, if you're waiting for your flight to board, feel like ordering something on Blinkit, go ahead and do that. But let's go across to Manisha now, who is in conversation with a commodities expert. Manisha.
Thank you so much for that. Well, joining me on the show is Surendra Mehta. He's Secretary at the India Bullion and Jewelers Association. Mr. Mehta, I thank you so much for joining in. And what a turnaround is what we are looking at in case of gold and silver prices. Overnight has been nearly 3% of jump in gold and almost 5 to 6% of a gain coming in for silver as well. I'll start with gold first. And we have an understanding that a lot of funds have been buying gold on many of those dips that we've seen in the month of March. And now the news also seems to be quite supportive. What's your sense on where is the buying coming in from and what targets are you working with?
See, Manisha, if you remember my last conversation with you, I had stated that if the even if the war doesn't end, but the ships are being allowed, oil ships are being allowed to move from Strait of Hormuz, then the oil prices will go down and finally the gold prices will start moving up. And this is what exactly happening. I think we are all awaiting very positive news, probably tomorrow evening or night, India time from President Trump. And I think the market is already giving an indication. It is true that Turkey and Russia and some few other countries like Poland probably have sold gold, about 70, 80 tons of gold. But we have to remember one thing, that if somebody has sold, then somebody has purchased also. So these gold have been purchased at on the dips. And as I always say, there is a lot of upside pending in the gold. One should not get carried away and worried with the fall in the gold prices. Always remember, war is not permanent, but US debt is permanent. They have no escape to US debt.
Well, as you said as well, 9 p.m. today is when the US has a media briefing as well. So clearly some details would emerge from that as well. That point is well taken. Mr. Mehta, how are you looking at the gold prices from here? You're quite bullish on that, as you said, war or no war. So what are you looking at? What are your targets?
Manisha, I personally feel that in the next 1 year or so, if the US is not able to generate any funds to reduce their debt, which is almost crossed now $39 trillion, and I think they with this war end of war, they should be moving to almost 40 or 42 trillion by the end of 2026. In that case, the gold prices may show as high as $5,900 or $6,000 in 2026.
Silver has been yet another one. While we did see $60 an ounce of a low in the month of March in the thick of war there, but that's rebounded quite strongly to 75 currently. How are you looking at prices on those?
Silver, according to me, will follow the path of the gold, but will move much faster than what gold will move. My target for silver for 2026 would be about $160. But remember one thing, when I give my target, be prepared for sharp correction and sharp profit taking in between. In case of gold, that may be 12 to 15%. In case of silver, between 22 to 30%. So that is always a possibility, because profit booking will come in between, because I personally feel this rally is going to be massive.
How are you looking at the Indian demand in that sense? Because the first quarter of this calendar year hasn't ended so well, whether it has been about the investment demand or the jewelry demand for that matter. So with the kind of volatility in prices that you seem to be talking about and the higher prices as well, is it going to hit the Indian demand much harder?
See, I tell you, currently, if you look for the last 2 or 3 months, the demand has been very weak. Now, basically due to a war situation, and people have been sitting on cash, saving money for their daily essentials, gases, and probably in the fear of war. But as we move on, the gold prices recovers and moves faster. I think some demand is expected post maybe tomorrow's announcement. But I still feel that there would be a lot of bullion demand and not the jewelry demand. We already seen a shift of bullion demand going up by almost 17 to 20%, and jewelry demand going down by the same percentage. So I personally feel that though the overall gold demand will remain consistent in 2026 also, there would be a lot of more shift from jewelry to gold.
Okay, that's the word coming in on the bullion side. Demand still expected. Manisha as well as Mr. Mehta, thank you so much for joining us on the show as well. Manisha, thank you so much for taking us through that conversation. Tomorrow's commentary from Trump will be key to see where overall equity markets move, as well as the commodity front as well. Will be key to watch out for. But on that note, we're going to slip into a very short break. After the break, we'll come back with more on stock-specific action, more on the markets. Stay tuned.
Presents Crypto Corner, powered by Binance. Joining us on the show today is Jaideep Reddy. He's partner at Trilegal. Mr. Reddy, hi, thank you so much for joining in. And the first one that I want to ask you is about the recent revision that India has done in its income tax rules to broaden the scope of financial account reporting. And within this now, the broadened framework that is, there also is an inclusion of crypto assets, CBDCs, and specific electronic money products as well. How would you look at this move?
Sure, Manisha. Thanks for having me. Pleasure to be on the show. I see this as part of a broader global trend where India is joining a multilateral movement to bring crypto assets within a common reporting standard. This has been driven by the OECD. And this is part of a move towards crypto assets coming within a multilateral information sharing framework, such that persons carrying out transactions in crypto assets will need to declare those, and then information will be shared between different jurisdictions, so that essentially there is no arbitrage where a person's try to conceal their crypto assets and carry out tax evasion. So overall, it's a positive trend. And hopefully it's the first of such multilateral steps. This is, of course, in the taxation realm, but hopefully it will move towards the regulatory realm as well.
Mr. Reddy, also, as I look at the numbers of crypto industry within India, that really seems to be growing. Of course, we don't have the 25-26 numbers yet, but 24-25 shows transaction volumes exceeding 50,000 crores therein. And there is strong retail adoption, even as there are the stringent of tax laws with 30% tax on gains, 1% TDS. How would you look at India's adoption of overall crypto as a segment?
Sure, Manisha. I think it's definitely grown over the years, ever since the Supreme Court judgment of 2020, which set aside the RBI banking restriction, and I was fortunate to be involved in that. The market, coincidentally, has grown globally as well. But in India, since the Supreme Court mentioned that there is a fundamental right to carry on this business, and it cannot be restricted unreasonably. Of course, entrepreneurs began building startups, and those startups have now grown to be unicorns as well. And some of the brightest minds work in those startups from the IITs and IIMs. The market has definitely grown. Of course, the taxation regime is no doubt very restrictive compared to the global norms. This 1% withholding tax is one of its kind in India, where it sort of impinges on the volumes that can be done in trading. But nonetheless, because of the promise of blockchain technology, there is a lot of grassroots adoption. I think there's one of the reports by an organization called Chainalysis, which says India is among the leading adopters at the grassroots level. And there's a huge amount of software developers, in fact, because crypto is often equated with just trading and speculation. But there is a huge amount of software developers programming on this technology, and it's called, of course, the Web 3.0 movement. And one of the biggest conferences called ETH DevCon is going to be happening in Mumbai in November. So it could be seen as the next wave of, in fact, the IT boom that we had back in the early 2000s. But of course, the technology is in its early stages, but the signs are quite promising.
Oh, they sure are, Mr. Reddy, and that does show, by the way, because we've seen the Asset Tokenization Bill 2026 introduced in Rajya Sabha in March on 14th, 2026. Now, apart from various things that it does talk about, it also talks about a novel multi-regulatory model. How would you see that work out in India in current scenario?
Sure, Manisha, that's definitely an interesting development. The only caveat I would add there is it's a private member's bill. So it does get the conversation going, but whether it will actually have the traction to go through remains to be seen. But it definitely is something that is following from the global trend, because when one looks abroad to see what the largest financial institutions are doing in the world, they're all making pro-tokenization statements and adopting tokenization initiatives. the US securities regulator has announced that it will try to see how tokenization can improve the securities market infrastructure. The EU is, of course, passed the Markets in Crypto Assets Act. So globally, there is a wave towards seeing whether financial assets and other real-world assets can be tokenized to leverage the potential of blockchain networks, which will make transactions seamless and create some disintermediation as well. Now, of course, it is natural that being part of the globalized environment, there is an interest to do this in India as well. In fact, in India, the International Financial Services Center Authority in Gift City, it released a consultation paper on tokenization. So there is interest among Indian regulators as well to see what is the potential of tokenization. And of course, this asset tokenization bill by the private member moves that conversation forward.
CNBC TV 18 presents Crypto Corner, powered by Binance.
$500 points and counting for the Nifty, 530 points to be precise. 22,864 is where we are, making a dash once again towards the higher end of today's trading range. It's been a good trading session so far if you're a bull, and that continues. But what doesn't is this show. We take your leave on halftime report, take a short break. Market action, however, continues with the team of Business Lunch after this break.
Stocks charge up after Donald Trump says that US will end the Iran war in 2 to 3 weeks. Industrials, IT and metals are the big sectoral gainers while mid-caps are outperforming.
Indigo soars after the government reins in a price hike in aviation turbine fuel by getting oil marketers to pass on only a partial increase in cost. A decision to appoint Wally Walsh as Indigo's CEO also gets a thumbs up from investors.
Bharat Electronics has bagged orders worth nearly 6,800 crore rupees in a day after bagging orders worth 1,660 crores between the 17th and the 30th of March, leading to a sharp surge in the stock and driving up other defense names as well, despite some weak business updates.
Sammaan Capital aims to be the number 3 NBFC in the country, with IHC taking control. CEO Gagan Banga sees lower cost of funds and a wide product pool helping the mortgage company transform into a healthy, diversified lender.
And Warren Buffett tells CNBC that the interconnected nature of the banking industry makes it fragile and he would like the US Fed to focus on the sector. He discloses purchasing treasuries but adds that he will buy stocks on a big decline. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Raman and Arundhati. Good afternoon.
Good afternoon, Hormuz. It's a great day for the markets, right? I mean, reversing all of those losses that we saw. Some green on the screen everywhere today, so it's good for the bulls.
It's a positive start to the financial year, the quarter, to the month, call it what you like. But yes, it's green, and that's the most important thing. Recovering everything that we lost on a Monday. So we are back close to that 22,900 mark as we speak currently. Of course, today being one and tomorrow being the final trading day of the week and Friday being a holiday. So it's a truncated week. And of course, the big determinant of the recent up move that you have seen is the sharp fall in oil prices that you have seen over the last 30-40 odd minutes, because until then Brent continued to hover around that $105-106 a barrel mark. But since then there has been a very sharp reversal in oil. Brent is now below $100, as is WTI. Brent is now down 4% and NYMEX too down around 3.5 to 4% as well. So there is a very sharp reversal from the highs, and that is also contributing to the sentiments. Of course, make no mistake, they still remain at very elevated levels, but compared to 105, 106, the bulls will take 99. That's one. The currency markets, of course, are shut, so no cues from there. The Dow futures are up almost 250 to 300 points as well, so that's good going. Of course, they have reversed some of the earlier losses and are now trading higher. All eyes will, of course, be on Donald Trump's address to the nation tomorrow morning at 6:30. But based on what it appears to be, it seems as if the market is pricing in yet another taco.
Absolutely. And, you know, if you take a look at the sectors, right, all of the sectoral indices are in the green today, which is great. We're seeing that outperformance in Nifty Bank, which we've not seen in a while. So the PSU Bank Index doing really well, up over 4% in trade. PNB, Indian Bank, SBI, all of them up between 3 and 4%. The metal pack, that's also doing well. We've got Vedanta, which is up over 4%. Hindalco, that's up over 3%. And Tata Steel gaining about 2% in trade. All of the other indices, IT names also holding up well. Persistent, Coforge gaining over 4% in trade, and Infosys and TCS up over 3%. We've got those defense names that are also doing really well. Cochin Shipyard, Mazgaon Dock, all of them over 10% in the green. But our top focus this afternoon is Interglobe Aviation, which is the top gainer on the Nifty. The company has a new CEO, but the other news point is the hike in ATF fuel prices, which was lower than anticipated. After some early confusion over the quantum of the hike, the Ministry of Petroleum has put out a release with a clarification. Sudarshan Kumar is here with all of those details. Sudarshan?
So first up, early in the morning, we got to know that ATF price has seen a sharp increase of 115% to rupees 2.07 lakh per kiloliter in Delhi. But after few hours, IOC has put out the notification that this increase of 115% is not for domestic airlines. And following that, around 9:40 a.m., it has put out the correct price of 1.04 lakh. And that tells you the increase of 8.5%, not 115% that company had put out early in the morning. And also post that there was a tweet from Oil Ministry as well as Aviation Minister, and they have said that they have tried to insulate on monthly basis. Basically, those prices, ATF prices, have been revised on a regular basis, on a monthly basis, and they have been deregulated in 2001. And they have tried to insulate domestic travel costs from substantial increase that we have seen in international prices. And because of that, domestic ATF prices were supposed to increase by more than 100% in April, or say April 1. But they have decided not to do so, and OMCs have only passed on staggered increase of 25%, or say rupees 15 per litre. So what is the math behind 25% increase? The information we have got from sources that as of yesterday, ATF price in Delhi was rupees 85 per litre, which has been increased to rupees 104. And if you do the calculation, that increase comes in the range of 20 to 23%, or say rupees 15 per litre. That's where this 25% math comes from. And what's the impact on Indigo? So for Indigo, 40% of the total cost are found by ATF. And now this 8.5% increase is much below the expectations that analysts had. They were expecting an increase in the range of 50 to 100%. And because of this positive development, you are seeing a big move in Indigo. At one point, the stock was up 10%.
Still up 8%, the top gainer on the index. Sudarshan, thank you for that update. Now, sources are telling CNBC TV 18 that the government is exploring options to cool the rising ATF prices. Shivani is here with more details on this. Shivani.
Well, absolutely. Jet fuel prices remain elevated, although oil companies have partially shielded domestic airlines from the full global surge. Now, the focus is now on what comes next. Sources tell CNBC TV 18 that the government is actively weighing multiple options to cool ATF prices, with VAT cuts and capping crack spreads emerging as key levers. Crack spread, which is the refining margin on jet fuel, has surged sharply from typical levels of $15 to $30 per barrel to over $70 per barrel. Now, airlines and oil companies are now working on a proposal to cap this between $10 to $22 per barrel to bring prices closer to historical norms. At the same time, the centre may engage with the states to reduce VAT on ATF, a major cost component for airlines. The broader aim is to ease cost pressure, stabilize fares and support airline profitability even as global fuel prices remain volatile. Back to you.
All right, Shivani, many thanks for taking us through those details. Now, auto stock surge as sales data for March trickles in. Sudarshan is back with us to take us through the details. Sudarshan?
So three major companies which have reported sales or say registrations for the month of March 2026. First on the top of the list is Hyundai. That reported sales, total sales have come in around 69,000 units, slightly above our expectation of 67,000 units. We were expecting around flat month for Hyundai, but they have reported a minor increase or say minor growth. And they have also reported a highest ever domestic for any March month, where the growth was 6.3%. But despite a healthy set of numbers, stock is in the red, and might be the reason is the stock today has entered into F&O segment. That can be one of the reasons. Second company that which has released numbers was Mahindra, and Mahindra, both auto and tractor segments continue to see a double-digit growth. And for auto segment, sales are being led by SUV segment, and there the growth is more than 20%, and also total auto sales have seen an increase of 21%. As far as tractor segment is concerned, there also sales have come in much higher than expectations, and the growth is 29%. Last is Ola Electric, for which in the month of March, registrations have increased sharply, and increases of 150%. They have reported registration of more than 10,000 units against around 4,000 units that they had seen in the month of February. That's the reason M&M and Ola Electric are sharply higher, while Hyundai is trading in the red.
Hyundai in the red, the biggest IPO, but the returns not quite big. Still below its IPO price now is Hyundai, as Sudarshan highlighted, first day as an F&O stock and continues to extend those losses, now almost 4% lower is Hyundai. On the flip side, Ola Electric is up almost 9%, but of course not to forget the fact that the stock from 150 odd is now down to 25 rupees. On to an exclusive now. Sources are telling CNBC TV 18 that the Finance Ministry has cleared allocation of over 1 lakh crore rupees for India's Semiconductor Mission 2.0. Ashmit is joining in with the latest on this. Ashmit.
Well, this is clearly something that the government has been very keen on. We've heard from everyone, from the Prime Minister to the IT Minister as well, that this is something that the government is keen on progressing with, giving continued support as far as the semiconductor program is concerned. And to that end, what we're given to understand is that the Finance Ministry has cleared the budget for ISM 2.0. That's phase 2 of support programs that the government is keen on launching. As far as the budget itself is concerned, we're hearing the figures are higher than is over 1 lakh crore rupees. Just to put things in perspective, the allocation under phase 1 was 76,000 crore rupees, so a substantial rise as far as the government budgetary allocation is concerned. I beg your pardon. As far as the contents of the program is concerned, what we're given to understand is that there will be a heightened focus as far as design, R&D, innovation locally in India is concerned. There will also be a focus towards high-end, cutting-edge chips, smaller chips, 3 nanometers, 2 nanometers is something that will be in focus. And also importantly, we're given to understand that after the Finance Ministry nod, the matter will now travel to the Cabinet. The Cabinet is likely to clear before the end of April.
All right, Ashmit, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. But up next, we will get you the latest updates on the ongoing tensions in West Asia. Stay tuned. President Donald Trump says U.S. could leave Iran in 2 or 3 weeks, stating that his goal of eliminating the country's nuclear threat has been achieved. Iran's Finance Minister Abbas Araghchi says he has no faith in talks with the U.S. and no negotiations are underway. Meanwhile, the Wall Street Journal is reporting that the UAE is willing to join the fight to force open the Strait of Hormuz. CNBC's Dan Murphy joins us now with the latest updates. Dan?
We are seeking clarity on the UAE position now, but it is reported that the UAE is preparing to join this military coalition to reopen the Strait of Hormuz by force. And of course, markets are watching this very closely. Arab officials tell the Wall Street Journal that Abu Dhabi is lobbying for a UN Security Council resolution to authorize this action, and a vote is expected as soon as Thursday. Of course, if this is correct, the move would make the UAE the first Gulf state to become an active combatant combatant in this war. But of course, the Gulf views on how it should end are divided here. Saudi Arabia, Kuwait and Bahrain want Washington to press ahead in a similar vein as the UAE. One senior official telling the Journal they want Trump to, quote, finish the job. But of course, Qatar and Oman want diplomacy. Either way, it seems as if the view from the Gulf here from all sides is that they are concerned that Israel may not stop bombing even if Washington does. And then meanwhile, on the diplomatic front as well, China and Pakistan have proposed this 5-point peace plan calling for an immediate ceasefire and the reopening of the Strait. It is hard to see this getting off the ground for now, given the US is firmly in control of the narrative. And of course, for the markets, the Strait remains the only theatre that matters. We see 20% of global oil still shut out, and analysts also warning that if the Strait of Hormuz stays shut for another 6 weeks or so, we could see oil prices hitting $200 a barrel. So what we're seeing right now is markets really rallying on hopes of a Trump exit, but it doesn't necessarily mean that the Strait is going to automatically reopen when the bombs stop flying as well. So the situation here on the ground pretty volatile at the moment as we seek further clarity on the UAE position and of course exactly what President Trump is going to say in this primetime address, which will take place at 5 a.m. Gulf time tomorrow morning. Will he signal a diplomatic off-ramp here or a military escalation? You get the sense that this could go either way.
Within 2 weeks, maybe 3. We're negotiating with them right now. They've been, again, we have had regime change. Now, regime change was not one of the things I had as a goal. I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job. But we want to knock out every single thing they have. Now, it's possible that we'll make a deal before that, because we'll hit bridges, and we've hit some. We'll hit some bridges. We've got a couple of nice bridges in mind. But if they come to the table, that'll be good. Iran doesn't have to make a deal. No. Yeah, I've spoken to a lot of people. It's a new regime. They are much more accessible. They are right. You know, they said we have a present for you.
And all eyes will also be on President Trump's address to the nation on the war tomorrow morning at 6:30 a.m. India time. You can tune in to CNBC TV 18 to catch the live address at that time tomorrow morning. Now, Fed Chairman Jerome Powell, speaking to students at Harvard University, gave an outlook as to how the conflict in West Asia could affect the Fed meeting and its inflation targets. Listen.
The tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between a half and a full percentage point to inflation, but that's a much smaller thing than we saw during the pandemic inflation. And and of course now we're facing events in the Middle East which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out. We've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while, and we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make that decision.
In fact, Warren Buffett, chairman of Berkshire Hathaway, says he wishes the Federal Reserve had a zero inflation target, signaling his concern over rising prices and the impact on the economy. Take a look.
The Fed can print money, and we have a President Trump, who would like to see the Fed cut rates. Would you cut rates if you were there right now?
I don't know what I'd do there. I wish they had a zero inflation target.
Right.
But, I mean, once you start saying you're going to tolerate 2%, that compounds pretty dramatically over time. And you're saying to people, if you're getting less than 2% on your money, you're going backwards. And actually, if you pay tax, you may pay tax on the 2%. I mean, I don't like that particular goal. But
so inflation is maybe what you'd be more concerned about. I mean, that's what Alan Greenspan always said.
Yeah, I would care about inflation. I would compare what I really would care about is the stability of the banks.
We're going to take a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Now, 12 days after abruptly resigning as chairman of HDFC Bank, Atanu Chakraborty has broken his silence. Now, in an exclusive interview with CNBC TV 18, Chakraborty raised concerns over governance at the bank and the underperformance of the stock. He questioned the characterization of the mis-selling of the 81 bonds in Dubai as a technical lapse, saying that the issues persisted for 8 years before action was taken. Atanu Chakraborty also said that he does not regret his resignation.
I feel if large number of customers are hurt, some amount of regulatory, or rather large amount of regulatory focus has come on the bank. It also brings reputational risk. Something goes on for 8 years and suddenly we take an action. People will say, those are concerns addressed, go home. I feel that these conduct issues should not arise at the first. However, if they are termed as technical, it leaves a little bit of a leeway. That is where the incongruence took place. There are many other matters, and apart from that, underperformance with respect to the share value not performing up to the mark, which meant that shareholders' wealth was not getting maximized. Also, CASA was low, and cost-to-income ratio was high.
Did you regret having written this letter?
No. Why should I? I guess materiality or issues, they are subordinate to the larger matter that I mentioned. And what I mentioned was internal to me. As I had told you, that it caused dilemma for me. Whether it causes for the bank, its board has to address that. If it causes dilemma to me and I find it difficult to live with, I should move on. They feel it's okay, let it be done. So I guess for me, that's where the entire thing ends, because I've got over with my dilemma.
Did you have run-ins, differences of opinion with the management over some of these issues?
So during that course, differences would be there, not only with, would be expressed, people would express a different view, vice versa. With everybody else, it could be there. And as a chairperson, it's also my role to bring all the differences as much as possible within a certain boundary. Therefore, I don't think personality differences are generally played up as a causing factor, because people feel that...
It wasn't the determining factor for your resignation?
No, no, not at all, not at all.
The reappointment of Mr. Jagdishan as CEO, were you opposed to the reappointment?
The matter of his reappointment, ideally, the process is it should be first discussed in the NRC, that's a Nomination and Remuneration Committee of the board, and then comes to the board, in which both the chairperson is just a member. It hadn't even come there along with the full documentation. So something which was not even discussed, how could differences be there?
Well, the index is still around about 470 points higher. It's trying to hold on to that 22,800 mark. There was a bit of a surge that you saw over the last few minutes that has cooled off slightly. But that does not take away from the fact that the oil prices still are down from the highs. The Dow futures still are up over 300 points. And of course, there are stocks that are extending losses. Hyundai is now down 4%. And sales numbers from Tata Motors CV flashing at the bottom of your screen, 17% jump in sales to 47,976 units, higher than the CNBC TV 18 poll of 46,000 as well. And doing fairly okay for itself. The stock was down around 7.5% on Monday, was Tata Motors CV. So that's one. Hyundai is down 4%, and Blue Star too is down around 4%. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. With Cap Radar on the other side. Good afternoon. You're with us here on Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia, with me Vivek Iyer. It's a good day for the markets, a good start to the new financial year, to the new series and to the new month as well, although there is a slight cool off from the highs of the day, but the index is still held on to gains of around 450 points as we head into the final 120 minutes of today's trading session. But here are some of the major headlines that we are tracking at 1:30 this afternoon. Stocks have charged up in today's session after Donald Trump said that the US will end the Iran war in 2 to 3 weeks. Industrials, IT and metals are the big sector gainers, while mid-caps are outperforming.
RBI defers the implementation of its amendment directions on capital market exposures by 3 months from April 1st to July 1st. Angel One and BSE rise in trade.
A strong surge in defense stocks today, with BEL rallies that it has received orders worth nearly 7,000 crore rupees over the last 2 sessions. Garden Reach has rallied as well. Despite the annual revenue growth failing to meet expectations, stocks across the sector have seen very strong gains today.
And in March auto sales, Hyundai sees a minor beat while also reporting its highest ever March month sales. M&M reports inline growth in auto and tractor segments, and Ola Electric sees March registrations at over 10,000 compared to 3,900 in February. Welcome to Midcap Radar. What a recovery it's been, especially as far as the broader end of the markets are concerned. Advanced decline ratio is extremely strong. In fact, at one point of time, it was almost 19 stock advancing for every stock that was declining in the session. What we are dealing with today is a whole host of quarterly updates. A lot of updates coming in, especially from names like IEX, etc., that are given quarterly updates, pre-quarterly updates, and a whole host of news flow, especially from the defense and shipbuilding pack as far as the pre-quarterly or the guidance update for FY26 is concerned. Hormuz, market's doing very well. Almost a 17 or 15:1 advanced decline ratio.
We have not heard of that advanced decline ratio for a while now, at least on the positive side. So it's good going for the markets. But just flashes at the bottom of your screen, the APL Apollo's volume growth for the fourth quarter only at 8.7% compared to their 20% guidance that they had given. So business updates are trickling in thick and fast. And this one is the first one that appears to have disappointed the street. There have been others that have missed estimates, but the stocks are doing really well, Garden Reach being a case in point. But APL Apollo is significantly off the highs of the day, just 8.7% in terms of volume growth for the year compared to 20% growth that was guided for earlier. But there are a lot of movers in the broader markets today. Everything that you may see is possibly in the green, and Upasana is here to tell us just that with her top movers. Upasana.
Well, indeed, it's a sharp recovery, and market is surging today in the hopes of potential de-escalation in the West Asia war. Now, if we look at the mid-cap index, it's up nearly about 3%. So first, let us focus on the top gainers in today's trading session. Zaggle Prepared remains in focus after the company has given its strong FY27 revenue guidance of 40% YoY growth. Next up is Lloyd Metals. It's up nearly about 4%. Petronet LNG has also updated us that the expansion of its Dahej LPG terminal is started. Next up is Godrej Industries. It's seen an uptick of as sharp as more than 12%. And lastly, coming to Ircon International, even that is buzzing in trade today, up nearly about 9%. Now, auto stocks also remain in focus on the back of the auto sales. It's the first of the month, so certainly these stocks remain in focus. Hyundai Motors, total sales up just about 8.7% on year-on-year basis. So sharp downtick is what we are seeing. Ola Electric and VST Tillers remain in focus. I have seen continued positive momentum since the start of the trade, since the update has come on the back of the auto sales. Now, also let us focus on the capital market stocks, as RBI has deferred the capital market exposure rules. Angel One surging, BSE surging nearly about 8%, and also Grow surging as high as 7% in today's trading session. Now, let us move towards the defense stocks that remain in focus since the start of the trading session. GRSE is one of the key volume buzzer. The volumes are up nearly about 4 times as compared to the 1-week average. This is on the back of their FY26 revenue update, although it's a disappointment here as the FY26 revenue is up just about 26% versus the 40% guidance given by the company. Cochin Shipyard and Masgao Dock also surged sharply more than 12% in today's trading session. Now, on the flip side, let us look at the top losers in today's trading session. Voltas, Blue Star,
Westlife Food, Supreme Industries, and even Ipca Labs, all of these seeing sharp cuts. So all in all, these are the stocks we are watching out for.
Watch out for some names that are bucking the trend, and Voltas and Blue Star, the surprise standouts in today's session that are not doing very well. Sharp losses seen in both of these names. Let's also welcome in Hemen Kapadia from DR Choksi Finserv for a quick chart check. Hemen, good afternoon. Thank you for joining in. The screen is a complete mirror image of what we last spoke, or a complete opposite if you could call it so. But do you use this bounce to reduce your positions, be light because we are heading into another long weekend, because there are still uncertainties that are there? Your call on the index and your stock recommendations for the afternoon.
A very good afternoon, Hormuz. Thank you for having me on the show. It's always a pleasure. I'll start with the index, Hormuz. Deeply oversold, bounce was coming sometime. But like you said, I think I would prefer to go slightly light, only because there's a long weekend, nothing otherwise. Because a short-term bottom is around the corner if it hasn't happened on the last trading session itself. The VIX is coming down. Hopefully it comes down some more. Crude is come off a bit. So everything seems to indicate or support a slightly positive view. So I would be slightly more positive than negative, notwithstanding the long weekend. 22,300 is where support comes in. And if we sustain above 868 or so, I think we should see further upside coming into 23,400, but this will probably a week's time or so. In terms of stock picks, Hormuz, two stocks, I still feel IT set for a bounce, and it's not yet over. There is decent, I won't say decent, but some headroom there. So I have a buy call on TCS at 2420, stop loss 2380, target 2500. Oversold, positive divergences, crossover buys, volume spikes. And in the last 3 weeks, despite multiple efforts and the market going completely haywire, it's held on to 2350, relative strength coming in there. Secondly, the contra buy call on Asian Paints. I know crude and everything, but Asian Paints has fallen off a cliff, Hormuz, come off from 3,000 to almost 2125. Same logic applies, deeply oversold, positive divergences, crossover buys. Short-term bottom is in place. So we're playing for a bounce, a recovery, not a rally. So buy on Asian Paints at 2230, stop loss of 2180, target of 2330. Hormuz.
Okay, Hemen, good afternoon, and thank you so much for joining us. Your view on the index levels as well as the individual calls are taken. But Hemen, what I want to ask you is, especially if you're looking at the capital goods and defense pack, some of the names today are up almost 5-6%. The shipbuilders today are up in double digits after a while. Do you see the strength sustaining, especially in some of the shipbuilding names? I don't know how much you track them. A name like a Garden Reach or a Cochin Shipyard up with significant strength today.
Yeah, I do track them, not that closely, Vivek, I do. But having said that, most of these, I don't want to generalize too much, specifically Cochin Shipyard and Garden Reach. I mean, the defense pack, any stock which has gone up 8 to 10 times in the last few years, or last 4 or 5 years, Vivek, they are in for a major, I would say, it's like you run a marathon. You're not going to run 2 in a row. So they're recovering, they're taking rest. So coming back to your main question, there's a major volume spike. I believe a short-term bounce is underway, or maybe this converts into a medium-term bounce. But if you take a longer-term point of view, whether it's Cochin or GRSE, they both look good if you have a 2.5-3 year point of view. Like I said, 8 to 10 times, give it a couple of years to consolidate, and that's what is happening. The overall trend is still bullish. We are in 26, Vivek. If you're looking at 28, they would probably be at new highs. So from a longer term point of view, they look great. And many of the railway stocks, including these defense ones that you mentioned. So short term bounce, medium term positivity, long term even more. But I don't believe we are out of the woods yet.
Not out of the woods yet. That is the main takeaway from that. Hemen, thank you for sparing time and joining us today. Views on the index, specific stocks, and of course defense, particularly the shipbuilders that have seen a very, very sharp surge in today's trading session. Of course, Today being the start of the series, there have been a lot of inclusions in the F&O space, 8 of them. And one standout name, Vivek, is Hyundai. That's not doing very well, but what about the rest?
Well, standout, on the downside is actually Hyundai, down almost 3.5%. But have a look at Cochin Shipyard. While, Garden Reach has actually come out with a business update talking about the kind of revenue growth they're forecasting for FY26. Cochin Shipyard, the only news flow about in this particular name appears to be the fact that it's been added to the F&O list. Now, the other name that clearly stands out, of course, has to be Force Motors. That particular stock was down and out, especially in the last couple of weeks. There was some negative news flow to, that particular name. But have a look at Force Motors, up 6%. And these names are up simply on the back of the fact that they've been added to the F&O space. What does it mean? Higher liquidity, hopefully more coverage, from the sell side community. And on the back of that, some optimism seen there. Hyundai Motors already well covered, that particular stock, despite the fact that, the monthly auto sales numbers is not bad at all. That particular stock has seen a bit of a downtick, but most of the other names doing quite well.
Not bad at all, but well, 28.90 was the high for Hyundai. It's now down to 17.10. More importantly, below its IPO price, which was around 1960. So another 4% knocked off on Hyundai today on a day when the markets have done fairly well for themselves. Speaking of the market, though, there has been a very sharp reversal from the highs. Now that we speak, from around 22,800, 22,850 levels, we are down to 22,650 levels. So that is now 200-point cool off in just a matter of minutes is what we've seen. So it's still a 340-point gain, but at one point where the index was up 600, 650, we are now up only 350. Just pull up the wicks just to see if there has been a bit of a recovery. At one point the wicks was down 10% at above levels, and there you can see there is a slight bit of move higher for the wicks as well. Still around 9% lower, but more importantly still above levels of 25. Take a short break. Back with more on the markets and specific stocks on the other side. Stay tuned.
Welcome back to Mid-Cap Radar. Well, our research team is standing by to highlight a list of stocks that are doing or seeing very sharp moves in the markets today, and we cannot look past the defense names today. BL rallied as it has received orders worth nearly 6,800 crores over the last 2 days. Important to see whether it's managed to go ahead and exceed the order inflow guidance. Garden Reach Shipbuilders rallied despite annual revenue failing to meet its own guidance. But let's go across to Ria. Ria has been working out all the numbers. Ria, the entire pack is uppers today.
Well, yes, let's start off with BEL. They have come out with their provisional update for FY26. Now, the revenue has come in at roughly 26,750 crores, which is up over 16% on a year-on-year basis. And this is versus the guidance of 15% revenue growth that the company had given. And the order book of the company also stands very strong at 74,000 crores. And in fact, the order inflow for FY26 is at 30,000 crores, above the guidance of 27,000 crores that the company had given. So a strong provisional update for BEL, and this along with the order win of nearly 7,000 crores that the company had announced yesterday, that has been leading to the rally in the stock today. Now moving on to HAL for their provisional update for FY26, they've announced revenues at roughly 32,250 crores for the year, which is up just 4% compared on a year-on-year basis, and this compared to the guidance of around 8 to 10% that the company had given earlier. So that has been a miss for HAL, but the order book for them remains quite strong at rupees 2.54 lakh crores, in line with the guidance that the company had given. For Garden Reach as well, a weak provisional update here as well. The FY26 revenue has gone up by roughly 26% versus the company's guidance of 40% growth. So again, a miss on the revenue front for them. They haven't given an update on the order book yet, but the company had targeted an order book of over 50,000 crores by the end of FY26. But nonetheless, these stocks as well as the entire defense pack has been soaring away in today's trading session.
Soaring away indeed. And Ria, thank you for that update there. And over to Sudarshan now, who's here with an update on car trade tech. That stock has had a wild ride of its own, from 300 to 3,300, from 3,300 back to 1,700, Sudarshan.
So today we have two positive brokerage notes post company held the analyst call, and those brokerage notes have come in from Axis Capital and Citi, and both these brokerages maintained a positive stance on the stock. So first one, talking about the Axis Capital, has an ad call and says company expects minimal disruption from AI platforms, and two things that they have mentioned. First one is AI models themselves rely on car trades data, and second, company remains among top 2 search rank platforms as far as on Google it's concerned. And beyond AI, it's expanding used car business by launching C2B and C2C platform. Also, it has mentioned few USPs for car trade. First, it's market leader in new car and used car marketplace for auto segment. Second, it has solid database of 150 million customers in India, and pan-India presence opens up market opportunity across all markets. And on the valuations front also, it finds very reasonable. Now talking about Citi, it maintains buy call on the stock. It says new products aim to leverage dealer integrations, proprietary data and strategic partnerships, and AI-driven initiatives present an opportunity to monetize its large base of 150 million that Axis Capital also has talked about. And new offerings focus on enhancing trust, improving match quality, and enabling ecosystem partnership and strategic partnerships that company has been announcing over the last few months would attract OEMs directly with buyers and sellers. That can also be very positive for car trade.
Well, thank you so much, Sudarshan. Earlier, AI was being looked as a disruptor, especially for the business model of car trade. But the company has given an update to the sell-side community, talking about how they're planning to leverage it. But a whole host of other stocks in focus, names like Hutco, Zaggle, as well as IREDA. All of these stocks doing quite well in the session on the back of business updates as well as corporate developments. Upansat joins in with more details.
Well, first up, let me start with Zaggle. The company has given a strong FY27 guidance of nearly about 25 to 30% on a standalone basis and 40% growth on consolidated basis is what they are eyeing on. Now, this is the first explicit FY27 guidance given by the company after the company has given a strong run rate in terms of its 9-month FY26 performance is concerned. If we look at the 9-month numbers for FY26, they stand nearly around, the revenue stands nearly around 1,260 crores versus a level of nearly 1,300 crore, which is seen on a full year basis, that is in FY25. Now, management is also guiding for working capital to break even in FY26 and also is guiding to turn positive in FY27. So certainly a strong update, strong continuous
to see strong gains since the morning of the trading session. Next up is Hoodco. The stock is up more than 5% after the company has shared its FY26 business update. The company has reported a loan sanction of nearly about 1.6 lakh crores with an uptick of nearly about 29% on year-on-year basis. Now, the loan disbursements came in after rising growth that is of 28% seen from FY25. And lastly, coming to IRDA, the FY26 provisional business performance remains strong. Company's loan sanction has seen an uptick of 9% on year-on-year basis. Loan disbursements have also remained strong with a double-digit uptick of nearly about 16% on year-on-year basis. And company's loan book outstanding also grew to 93,000 crores from 76,000 crores with an uptick of nearly about 22%. So all around, we are seeing strong business updates coming in from the companies.
Upasana, thank you for those updates there. Hudco, Zaggle, IREDA, all doing very well in today's trading session. Hudco now up 6%, Zaggle 16% up move in today's session, and IREDA, after being beaten out of shape, the record highs are 310 and now it's down to 110. There's still 4% higher on the stock. Take a short break, more on the markets on the other side. Stay tuned. Welcome back. Now, putting the focus on the pharma space, Novo Nordisk has launched discounted subscription programs for Wegovy obesity drugs. We caught up with the managing director of Novo Nordisk India on the extent of the price cuts and the margin impact. Listen into what he had to say.
When it comes to starting of the doses for semaglutide for diabetes and semaglutide for obesity, we are taking a price cut which is 36% and 48% when it comes to obesity. So on an average, now the therapy cost in diabetes is reduced to the tune of 24% and for obesity, 27%. And that's a substantial cut which we are taking just to make sure that the pricing continues to remain more and more patient-centric to increase the accessibility across India. I think what is important is what is the right price, what is India-centric price, because of which the deserving patient can get the access to start the therapy and also the compliance to stay on the therapy. And I think when those patients get this kind of an access, the byproduct when it comes to the volume or value will also be very, very good. And I don't think so I can really look into any kind of a prism and say that when is the next price cut. But I can tell you that these two price cuts are very well thought through. These are the work of, you can say, months of planning. When we did in November, we saw that the number of patients who could able to come on semaglutide increased. And that was a huge motivation for us to go for another India-centric pricing. And I'm really, really happy that now we are bringing the pricing, which is quite a range in terms of making the therapy accessible to Indian patients.
Well, that's right. You know, the drug's gone off patent, whole slew of launches, and on the back of that, you've seen pricing cuts across. Well, a couple of stocks that we could quickly highlight. You know, the first one has to be APL Apollo Tubes. Our colleague Sudarshan helpfully pointed out that the company has reached its volume guidance for Q4. And, you know, the Q4 volume growth has come in at little close to 9% versus the guidance of 20%. That stock has cooled off quite significantly off the day's high. The other set of stocks not doing so well is the entire power pack. Remember, power demand in FY26 has been very muted. And we've had very muted demand even in the month of March, you know, just around 1% growth as far as entire demand for the country is concerned. Back of that, have a look at some of the thermal names, have a look at NTPC. That stock has cooled off quite significantly. Power Grid too has cooled off. The other set of stocks that's seeing a bit of profit booking after being relative outperformers due to safety haven buying is the pharma pack. Have a look at names like Dr. Reddy, have a look at a name like Cipla, and Torrent Pharma today, you know, amongst the top underperformers, down almost 2.5% to 3%. And along with that, the insurance pack, names like HDFC Life are amongst the top laggards today, and even Max Financial near the day's lowest points, Hormuz.
You know, adding to that list of the pharma names, Ipca Labs has now moved to the lows of the day. That has sprung up among the list of the top losers on the Nifty 500. So 5.5% lower now on Ipca Laboratories. It's a bit of a sharp fall that you have seen over the last few minutes. And just before we leave, Acutaas Chemicals, you could pull that up. That stock is now down 10%. In a market like this, doing fairly okay for itself, but 9.5% lower on Acutaas Chemicals. So take a leave on this edition of Midcap Radar from Vivek and me. Thank you for watching. The markets are slightly off the high, still holding on to gains. Your stocks on the other side.
Hello, good afternoon. You tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Mangalam Malu as well. Mangalam, from the time we anchored HDR to now, we're seeing a bit of a fall coming in the markets. Around 100 point more than that of a decline from the day's highest point, at least, for the Nifty 50. And banks still managing to hold on to some bit of a gain over there.
Banks are managing to hold on to some of the gains. The interesting part, however, is that during halftime report, we had pointed out that there has been a lot of call writing at that 23,000 mark. So crossing today's high would be extremely crucial for the frontline index. That hasn't been the case right now. And we do have, a couple of these pharmaceutical stocks which are coming in for some profit booking. IT stocks, they do not, add much to the bulls right now. In fact, through the course of today's trading session, they were doing well up until the last half an hour. And now from the highs, the IT index is actually down by about 2%, 1.8% to be precise. And that explains why the frontline index is off highs, even as there is some outperformance coming in from the banks. But let's get to answering your stock investment and, trade-related queries. We have Chandan Thaparia, who's the head derivatives and technicals wealth management at Motilal Oswal Financial Services, joining in. Lancelot Decuna, the chief executive officer at ValueX Wealth Connect LLP, also joins us later on the show. Chandan, before we get to answering the queries, if you could give us a general trend of the mood of the market right now. People are thinking that, yes, there will be some truce, which is why, we've seen decline in crude prices, we've seen a recovery in the markets. But at higher levels, there is some supply coming in, which tells you that we're not necessarily out of the woods, even though there is a relief rally. Is the chart suggesting that?
Yeah, good afternoon, Mangalam. Thanks for having me. So, yes, market witnessed some recovery from lower levels, but failed to move beyond 22,950. The good part is some stability is getting sense, but again, the follow-up is required in the market. I believe if Nifty manages to move beyond 23,000, then only we'll get the confirmation for bottom-out approach. But till then, I believe volatility needs to cool down. We are likely to be in a range where weekly chart is making lower top, lower bottom, but daily is giving a early sign of bullish divergence. So I believe we have to be in a broader trading range with support near 22,300, hurdle at 23,000. And if you ask me when we will get the confirmation that overall negative pattern is getting negated, I believe India VIX will give the first clue. As of now, it's down by around 10% at 25. If VIX goes below 21 or 20, then market will give the clarity about the bottom out approach. Till that, some volatile cues could be there. So for me, need to closely watch these important level to get the more conviction about the market bottom out approach. But yes, one key things we need to keep in mind that in this scenario, selective sectors may bottom early than the bottom out approach of the index itself.
Chandan, point taken there. Thanks for that. But let's keep it going now and get started with those stock-related queries. The first query for today is coming from Rajesh Kumar, who's writing to us from Patna. He's holding some shares of, he's not mentioned the amount, but he's holding shares of Indocount Industries, and he's bought it at an average price of 296 rupees per share. He's saying that he's bought these shares for short term. So should they continue to hold or sell at current levels? We have Lancelot also now with us. Lancelot, textiles, what's your view coming in here? And specifically Indocount Industries, while we were just getting eased up with the tariff issues, you have the West Asia war that started. So concerns again come back. What should they be doing with the Indocount Industries? Should they sell or continue to hold?
So I think, the tariff issues haven't yet gone away completely. There was news that we would sign a trade agreement and then the tariffs would be reduced, but it's still not yet completed. So that factor is still an overhang over the company. Plus, if you see the margin, it's a low margin business. Margins have got impacted over the last couple of years. Sales have also remained relatively flat. And added to that, now you have this issue about the Middle East also going to impact them. So it's better to, exit in the short term, because it may be difficult for companies like this to bear losses with thin margins.
Right. So that's the word coming in on Indocount. Chandan, do you have a chart call on Indocount, or is there any, textile pick that looks good on the charts according to you?
Yeah, so if I talk about Indocount, the counter has multiple support near 215. And in fact, 5 to 6 times in last 30 months, it exactly took support near 215 and turned higher. In fact, just 6 days back, it made low near 216. So I believe 215 is major support. If I just look at the technical, if someone is holding the position, it's suggested to follow the support of 215. If it bounces, then it can go towards 275 to 280. But yes, 215 is major support for the new buy or if someone is holding the position.
Okay, let's move on then to the next query for today. We have this query coming from K. Padma, who is writing to us from New Delhi. It's an investment query, and she's asking if it's the right time to look at HDFC Bank as well as Eternal. Lancelot, both these names, HDFC as well as Eternal, what's your view on the fundamentals? HDFC Bank, obviously, we had seen some bit of an uncertainty come around it. Investors were worried about it as well. But is it the right time to look at this one?
Well, I think, while there was a concern from investors about, corporate governance issues at HDFC Bank, I think the board and as well as the management had come out and said, look, there is, as far as the bank working is concerned, things are really doing well, and you would probably see the impact of the merger actually kick in over the next 12 to 24 months. So I think given that, RBI as well as, SEBI are looking at all the issues in close, with a close eye, I don't think there should be any impact on, on the corporate governance issues that will play out. And hence one can look at investing in HDFC Bank because it's trading at about 2 times its book value, which is probably at the lower end of its range. So one should really look at buying HDFC Bank. As far as Eternal is concerned, the stock has corrected quite a bit, and we have seen the stock generate profits in recent quarters. Additionally, very recently the stock has increased, the company has increased its platform charges, to 12 rupees 50 paise, and that should add some amount of revenue to their business. However, given the current short-term crisis, there could be an impact of the lack of LPG, shutting down of restaurants on their businesses, and that could have an impact over the shorter term. So maybe one can look at buying on declines rather than trying to jump in when the markets are still expensive.
All right, Lancelot, let's move on and let's get another query in. We do have with us a query coming in from Kolkata. Kabiri Basu writes to us. She holds 4,500 shares of IRB Infra at a little under 50 rupees a piece. Also holds about 250 shares of Niva Bupa at a little over 76 rupees. She's a long-term investor. On IRB, she's losing a little over a lakh and about 1,000 rupees. I'm pretty much break even on Niva Bupa. Before we go to you, Lancelot, Chandan, on IRB Infra as well as Niva Bupa, do you have a chart call?
Yeah, so first, if I reply on IRB Infra, the counter is under pressure because on monthly chart, it was making lower top, lower bottom, but now it's gone in a consolidation phase with multiple support near 19 levels. We have seen some buying interest in last 2-3 weeks. And if manages to move beyond 23, I believe some good recovery can be seen in the counter. But we need to keep in mind that major trend is in pressure. So don't average, but try to exit on bounce near 30 to 35 marks.
The other stock?
Yeah, so talking about other name, I believe here, so Nova Bupa, I think here the trend is mixed. And if I look at the price behavior, some support-based buying is visible. But if I look at the bigger time frame, then consolidation is clearly seen in the counter. Right now, it took support near 68 marks, the same support respected in the last year. So 68 is major support, but if I look at the limited price history, it would be tough to move beyond 82 to 85. So suggestion is, if someone is holding, better to hold, wait for market to recover. In that scenario, it can recover, but don't suggest to average out or look for any kind of other activity in the counter.
Lancelot, IRB Infra Niva Bupa, should the viewer continue to hold or sell?
I think if you look at IRB Infra, it still trades at a very high valuation despite the fall. It trades at almost 33 times EPS. And if you look at the company, it offers a very low return on equity, just 5%. So given that, you are likely to see some more challenges in terms of higher cost inputs for the company, it may be advisable to exit and look for redeploying that money into better stocks. As far as Niva Bupa is concerned, I think the health insurance business is a growing business. Removal of GST on insurance premium would be beneficial, and the competitive intensity due to strong competitors has sort of eased up a bit. So it may be a hold, and over the long term, one can benefit from this stock.
Okay, surely that's a view coming in on the fundamentals also for Niva Bupa and IRB Infra. But on that note, we're going to actually slip into a very short break. We'll come back with more of your stock-related queries. Stay tuned.
Welcome back, Winnie. We can take some credit for the market recovering from lows, because during halftime report as well from the lows, we saw a bit of a recovery. Right now, as we speak, when we started the show, the Nifty was below that 22,700 mark, and now it's above that 22,700 mark. So a 50, 60 point recovery is what we've seen. And nearly all of that has been led by the Nifty Bank. Every time other sectors have underperformed, the Nifty Bank has stood up, and that's exactly what took place today as well. And this is X of the decline, the underperformance that we saw in the Nifty Bank during the skirmish, that as we speak is among the best performing large sectors right now. The Nifty Bank up 2.8%. The IT index obviously has become an underperformer, which is why it's not finding any place on that screen right now. HDFC Bank continues to do well. So HDFC Bank from the trenches has seen a recovery, and from the lows has seen an even more formidable recovery. Individual line chart of HDFC Bank comes up, and that tells you that it's at the higher end of today's trading range. We still have Chandan Thaparia and Lancelot Dacuna, the experts, joining in to answer all your stock and investment related queries. Raghu writes to us from New Delhi. He holds about 300 shares of MRPL at 185 rupees, wants to know the outlook for the next 3 months. Lancelot, obviously 3 months is too short a long-term horizon, but again, for companies that are so sensitive to commodity prices, maybe it's a good way to look at investing. The next 3 months, how do you see the prospects of MRPL?
So I think, if you look at it from a 3-month perspective, a lot will depend on how the crude prices go. But I think more than the prices, it's also the availability of crude that's going to become and that's going to continue to be an issue. And having said that, I don't think that risk is priced into the into the entire setup. So maybe one should wait for a while or maybe even exit the stock at this point in time if you do not want to face volatility going forward.
Okay. Chandan, what's your view on MRPL 3 months? Any target over there that you should keep an eye out on?
Yeah, so I'm slightly positive on the counter. In fact, the stock like MRPL and Chennai Petro has really witnessed buying interest at lower levels. In fact, multiple time it has shown buying interest near 170, 175, headed to 200 plus. I believe this time also same kind of price behavior is likely to repeat, and resilience at the time of market corrective move, holding well above 50 DMA after the volatile swings in that broader range. So I believe buying interest could be seen on immediate basis. It has support near 165. With that support, it can head towards 215 if someone is looking for 1 to 3 months, and 235 looking for 3 months and beyond.
Okay.
All right.
That's the view there on MRPL. Keep an eye out on those targets over there. Next query then. We have Tejas, who's writing to us from Mumbai, holding 5,000 shares of South Indian Bank. Price is 40 rupees per share. Future outlook and future prospects, long-term, short-term, both views. Lancelot, your view for South Indian Bank. They bought it at 40. They're making some bit of a loss. But is this a bank that you would hold, or might as well book out the loss that they're making, the minimal loss, and then move on to some other stock?
I think, if you look at South Indian Bank, it's a fairly small bank, market cap of just about 9,500 crores or thereabouts. Now, small banks are, while it may be well run, smaller banks are likely to get impacted given the fact that the macro environment is becoming difficult for banks. We saw RBI introducing a cap on foreign exchange exposures, and you could see, money market situation also becoming a little bit tight given the volatility in the market. And that it'll be much more difficult for smaller banks to weather this kind of volatility. So my view is that one can look at, maybe moving to banks which are more stronger or larger and be able to ride out this volatility given their size. So maybe SBI would be a good option to look at.
All right. South Indian Bank should be divested away from, and maybe a large bet on SBI could be made. Chandan, you have a call on this one?
Yeah, so it's better to be with heavyweights name, whether we talk about SBI or Indian Bank. But yes, if particular South Bank is concerned, I believe 32 is major support. However, it may see some more decline, but 32 is an important level for the counter. And near to that, if it turns, it can go back to the recent high of 42.45.
Okay. Thanks for the levels over there, Chandan. Let's move on then. Next query. Manju Khanna is writing to us from Indore. Holding 200 shares of NTPC, 100 rupees per share. Should they stay invested in this one? Lansot, NTPC, what's your view here? They bought it at 100, so they're making a profit on this one. Good time to maybe book out profits or maybe continue to stay invested.
I think if one has a little bit of a longer term perspective or in this investment, then over the long term, the demand for power is just going to continuously grow. And being a power generator, you will see higher demand as well as better operating margins coming in. Currently, the operating margins are around 30%, and that is very positive for a company like NTPC. So if you have an horizon of more than a year or two, then one should stay invested in this stock.
Right. Stay invested in NTPC if you have a horizon of higher time. As we speak, there are some fourth quarter updates coming in. Those would be the triggers for the next few days for individual stocks. Karur Vysya Bank, their current savings account book is up 12%, and it's down a bit quarter on quarter. Year on year, there's a spike, and the advances number also comes up for you. As of now, the increase in CASA means it's better for their low-cost deposits, which implies better NIMs going forward. But will that be passed on? Are there enough advances? Total business up 15%. So all of that points in decent direction, and that explains why the stock is higher by about 2.8% as well. Let's move on. Karthik writes to us from Bengaluru, holds about 60 shares of KCP at 199, has been holding these shares for the last 2 to 3 years. So basically sitting on a bit of a opportunity lost, capital lost not so much, more opportunity lost than everything else. Chandan, KCP, if I remember correctly, it's a sugar company. A lot of the sugar stocks have been doing well right now, given the ethanol play and the higher crude prices. Anything particular about KCP on the charts that signifies this underperformance as against the others?
So as of now, the structure of the counter is weak. It has been making lower top, lower bottom on the monthly chart from almost 22 months. Even it broken key support of 155 and drifting lower. However, today it recovered in line with the market recovery, but structure is weak. As of now, I believe some more profit booking could be seen in the counter. It can go down. Let's wait for more stability near 110 to 150. And I believe then it can recover to 170. So if someone has patience, wait for more dip and then buy with support of 110, 115 for the upside target towards 170.
Okay, let's move on then to the next query. We have Mustaq, who's writing to us from Noida. He's holding 699 shares. This is a Bajaj Housing Finance, 131 rupees per share. Should they continue to hold, buy, sell? What's the view at current levels for this one? Lancelot, your view on the fundamentals, Bajaj Housing Finance right now?
Well, I think the fundamentals are good for Bajaj Housing Finance, and we expect to see the housing finance should pick up, over the next 2-3 quarters. But the stock has corrected a lot and is probably trading at around 3 times its book value. So one can accumulate this stock on declines for the long-term outlook.
Right. Bajaj Housing Finance, Chandan, you have a view? Because it was one of the touted IPOs, right?
Yeah, so here the trend is clearly negative. If I look at the price history of last 20 months, it has been making lower top, lower bottom. It made the all-time high at 188, now quoting nearly at 77. So trend is negative and counter is trading at all-time low levels. So no suggestion if the technical is concerned. If it witnesses any buying and then reverse, then only we can see. Otherwise, as of now, there is no respite. So better to avoid as of now if technical is concerned.
Okay, better to avoid as of now on the technical front. That's a view there for Bajaj Housing Finance. That was the last query for today. So, Chandan as well as Lancelot, thank you so much for joining us on the show. And viewers, thank you so much for sending us your queries. Keep sending them in and we'll get them answered with our experts on Monday, Wednesdays, Fridays for stocks, as well as mutual fund queries on Tuesdays and Thursdays at 2 p.m. But a quick look in terms of what the market is doing, about 22,700 level as of now. And just in the last half an hour, if you look at it, what's done well? Vedant Fashions, that picked up a bit of pace, a % more uptick in the last 1 hour as well. Motilal Oswal, something that has also picked up pace in the last 30-odd minutes that we're talking about. But with that, we're absolutely out of time. So thank you so much for tuning in. Up next, you have Closing Bell to take you to the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index, that's up more than 4%. We have Hang Seng that's holding on to gains of almost 2% that we could say around that mark.
Their sole function was to make sure that they don't have a nuclear weapon. They're not going to have a nuclear weapon. When we leave, the strait will automatically open.
We have had regime change. Now, regime change was not one of the things I had as a goal.
I would be very reluctant to assume anything at this point. I would assume that there will be more war fighting.
2.5% higher on the Nifty, 22,871. That's about 2.33% in the green.
Nifty below 20,000, roughly in the 19-20,000 range. I'll probably say those are the levels which would probably characterize as worst case.
We are fairly confident that with this capital infusion, and more importantly, to have such a large promoter as IHC, we will be participating and be significant players in that.
Almost all sectors are in the green, and leading the rally are the names of PSU banks. You have Nifty, Auto, both are up more than 3%.
Major export order for communication equipment, electronic fuses, as well as strategic components.
Well, Brent is now below $100, as is WTI. Brent is now down 4%. And NYMEX too, down around 3.5 to 4% as well.
IOC has put out the notification that this increase of 115% is not for domestic airlines. We were expecting around flat month for Hyundai, but they have reported a minor increase, or say minor growth.
Advanced decline ratio is extremely strong. In fact, at one point of time, it was almost 19 stock advancing for every stock that was declining in the session.
400 points on the Nifty is what we have at this point in time, and things are looking pretty solid. The high, by the way, was made early on in the open at about 10 o'clock. From there, the market meandered quite a bit. Another high was made at about 115, a sharp sell-off, and then a bit of a recovery. So, I mean, not all of the points that the Nifty had managed to accumulate at the day's highest point, but bulk of it very much still there on the board. We are coming to you from the CNBC TV 18 Motilal Oswal studios. This is closing bell, last hour coming up. I'm Prashant. Nigel with me. Nigel, hi.
Well, hi Prashant. Good to see you, right? I mean, when we had only 200 stocks declining, the ratio actually was inverse.
Yeah.
So good to see that bit of green. So we go maybe into the end of today with some green, and hopefully Mr. Trump is in in a better mood, and the comments that come in for tomorrow, getting into the long Easter weekend, should be favorable for global equity markets.
Yeah. I mean, absolutely, and I think that's what markets are kind of sort of betting on as well. But that momentum is building, right? I mean, I think over the last 24 hours or so, really kicked off with that Wall Street Journal story that Trump is ready to walk away even if the strait is closed. He was asked about that Wall Street Journal story last evening at a press conference, and on camera he said, well, our aim was never that. Our aim was not regime change. Our aim was that Iran should not have a nuclear weapon, and that aim has been achieved. So indicative that perhaps there is de-escalation, not escalation. Markets, and I guess in terms of end of war timelines have been all messed up over the last 1 month or so, but fingers crossed this is the final one. Let's just quickly run you through what's coming up here on the program. Just to give you a sort of tease out of what's lined up. Markets, of course, is the focal point, and we're at about 22,700, 400 points higher. Broader markets are doing well. PSU banks are leading the way. Pharma is underperforming a little bit. ATF prices have been hiked. Indigo is up sharply. Of course, the hike is much lower than what the actual hike in jet fuel prices is, and I guess markets taking note of it. Avenue Supermarts, new stores, and I think D-Mart, Zudio has opened new stores as well, and those are the two stocks which are up, jumping about. So more details with Mangalam on it. Some fourth quarter updates from companies like APL, Apollo, etc., which are reacting to numbers. So more details on that one. Defense is a very strong space. Shipping companies, right? Garden Reach and Mazgaon, etc., are doing very well, but so are BEL and HAL. So it's a packed next 1 hour coming up here on the show. How should you position yourself in the last hour? That's the question. Nagaraj Sethi of HDFC Securities is with us. Nagaraj, what's your sense? I mean, good to go. How would you trade with the 400 points on the Nifty?
Hi, good afternoon, Prashant. Yes, Nifty has bounced back very well from the low levels. It seems like the low of around 22,300 to 22,000 seems to be formed a bottom reversal. But market is still not out of woods in the near term. What we have seen over the last 1 month, the lower tops and bottoms is indicating on every rise, market witnessed a steep fall and eventually made a new swing lows below the previous bottoms. So the currently showing selling pressure around 23,000 levels, and I'm expecting some more consolidation, but at the lower levels, 22,300, 22,000 is going to be a strong support for the market this time at the lower levels.
Okay, got that. What about individual stocks?
I have two stocks from mid-cap segments. First one is NoSil. Chartically, NoSil has witnessed a tremendous up move from the lower levels. Higher tops and bottoms on the chart is indicating a new upside momentum is building up from here onwards. Currently trading around 163.80, 164 levels. One can look to buy at this point of time. Immediate target would be around 174 and one can place a stop loss at 158. Second one is PTC. PTC India Limited has been in a consolidation phase below the 200-day EMA, witnessed a breakout. The higher tops and bottoms is on the chart. The overall chart pattern is indicating a larger consolidation pattern. There is the more probability of decisive upside breakout in the near term. Currently trading around 167.40. One can look to buy at this point of time. At CMP, immediate target would be around 177, and one can place a stop loss at 162.
Okay, all right. A quick word on the Nifty Bank. What is the level that you're tracking? Because that's the one that got hardest hit.
Yeah, Nifty Bank has witnessed a good up move. It has been since it is outperforming the benchmark Nifty in today so far today. But there is a higher possibility that it could find some resistance around 52,500, 52,700 level, where I'm expecting some consolidation taking place at the higher levels.
Got it. Okay, all right. Thanks a lot for that, Nagraj. We'll keep coming back to you. Well, let's move on and discuss a couple of stocks that are gaining. Avenue Supermarts, that's getting in trade. The company's total store count has crossed 500. While Trent is also in focus, well, Mangalam joins us to tell us why these two that have seen a sharp correction from the recent top, they are bouncing back in trade. Mangalam, take it away.
Well, part of the answer to your question, Nigel, is part of your question itself. The fact that they had seen a sharp correction from the top and we're starting a new financial year. So maybe, the street is a little happy about betting on some of these beaten down names where prospects seem to be improving. For Trent in particular, we've been talking about how it has been one of those weak performing stocks in all of last year and all of FY26 as well. The belief is that maybe now store growth acceleration and same store sales growth will come by for Zudio as well as Westside. For DMart, what was interesting is that the last 3 trading days, every day there was an exchange update that came in. On 29th, they opened 3 stores. On 30th, they opened 7 stores. And on 31st March, they opened 12 stores. So in just 3 trading sessions, they opened about 20 stores, taking this quarter's store addition to 58, which is the highest that the company has added in a quarter ever since they've, started. So as a result of which, store acceleration, which was one of the key themes or one of the key quibbles of investors, is now playing out. And, 500 stores is what DMart stands at right now, taking this financial year's store opening count to 85. Remember, sometime in the middle of the year when they first entered UP, the belief was that this is the first of many stores in UP, and a large part of North India is open for them to expand. An expansion coming in their existing areas and new geographies should work for them, along with some aggression in quick commerce. That's what the street is betting on. And after years of underperformance, both Trent as well as DMart, on a valuation parameter as well, look a lot more palatable than what they were at the peak when growth wasn't coming, as compared to now where they're not at their peak and growth seems to be returning.
Okay, got it. All right, Mangalam, thanks a lot for that. Sudeep Bandupadhyay joins us on the show. Hi, Sudeep, good afternoon. Better times from a bullish perspective after the slam dunk that we've seen, and you're wearing a tinge of green as well. Good to see that as well. What about Trent and Avenue Supermarts? 2 well-run companies which have seen a sharp correction from the top. They got too expensive and business as well slowed down. Now there is some glimmer of hope. Please go ahead, Sudeep.
As far as Avenue Supermarts is concerned, I think definitely the number of store addition has been very, very impressive. As far as March itself, they have added 22 stores. Overall store count has gone up. The expansion in North is happening. And this was one of the points which we all had that the store expansion had slowed down. So I think with the store expansion picking up, the scope for growth and scope for better numbers is definitely there. They also have been getting their act together as far as quick commerce is concerned, e-commerce is concerned. And we will hope that the new financial year will see a lot more activity in both store count increase as well as the quick commerce and e-commerce area. Valuation, of course, is reasonable. So, comparatively reasonable. So, Avenue Supermarts definitely merits a look. As far as trend is concerned, I think I'm still cautious. Last year, the management had given a growth estimate of 25%. They are nowhere near that. Store growth has slowed down. They have opened some Zudio stores, but I think, even now, considering the valuation at which it is trading and considering the growth they are talking about, I think there is still a gap, and I will still continue to watch trend and not start getting involved with as far as buying or recommendation is concerned.
All right, Sudeep, let's cover a couple of names then that have come up with their quarterly update. Lloyds Metal as well as APL Apollo Tubes. Let's start off with Lloyds Metal. They delivered a very strong quarterly update. Production number at around 9.1 million tons. That's nearly the entire annual run rate that they used to do earlier, roughly around 10 million tons or thereabouts on the iron ore business. The management has said that the slurry pipe as well as the swift execution of mining, that's what has aided into a very, very robust performance. For FY26, they have clocked close to around 22 million tons, which is more than double the previous fiscal. The management has also said that they're anchored to produce close to around 22 million tons of iron ore in FY27. Additionally, they have also commissioned their 4 million ton pellet plant during the course of the year. And they've achieved a production number of approximately 3 million tons in FY26. That translates into an annualized capacity utilization of around 100%. In fact, for March, they've already done close to around 4 lakh tons. So pretty healthy out there, both on the iron ore part of the business as well as on the pellet business. And the stock saw a sharp correction because one of the funds were selling. It appears most of that is absorbed. That stock is up in trade. On the flip side, APL Apollo Tubes actually has come off the highs of the day. They missed their guidance for Q4 FY26, though they had sounded off the analyst community in March itself. The company faced basically two problems. One is on the availability of natural gas, which is an issue for making galvanized steel pipes. That's roughly around 21% of the volumes. The other problem is they have a facility in Dubai, which would not have functioned at optimal levels. So for Q4 FY26, they have delivered a volume growth of close to 9%. That's a far cry away from the 20% that they earlier guided. And since operating leverage will not play out, that EBITDA per ton of around 5,500 rupees, that will come in doubt as well. For FY26, they have ended the year with a volume growth of just around 11%, which is again lower than what the street was working with. So for the Q4, the street was extrapolating close to around 1 million tons to get to that guidance of 20% or thereabouts. That's not happened, and that's why the stock has come off the top. Sudeep, what do you make of this one? APL Apollo Tubes, the street had already sniffed it. They have a unit in Dubai. They have some requirement with regard to natural gas, which became an issue as well. So in the last 1 month or so, you're already factoring this in. Your view on this name, and the other one is Lloyd Metals. The stock has come off drastically from the recent top, but the FY27 could look very good. What's your view?
Well, APL Apollo, I think it's unfortunate. The performance and the company was doing all right. I think this West Asia war has derailed a lot of their predictions and projections. Natural gas shortage has been affecting them. And of course, the West Asia operations have got severely affected. So the March numbers were significantly lower than what we were expecting and what the market was expecting. And that had led to an underperformance overall on an annualized basis. I will wait for things to settle down as far as the war front is concerned before I take a view on APL Apollo. Otherwise, I think there are a lot of things going for these tube companies, particularly some of the government initiatives taken in the recent months should help APL Apollo. But I think the war has to stop, and only then things can start looking up. So I'll wait and watch. Look, valuation also is not cheap, so there's no hurry to get into it. As far as Lloyds is concerned, it's a pleasant surprise. Overall, the metals and mining sector has been doing well during the last fiscal. I think their production has significantly gone up as far as mining is concerned, as well as pellets are concerned. So it's a pleasant surprise. And, the stock also had corrected quite a bit. So if you are a bit aggressive investor, it may be worthwhile to bite into Lloyds Metals even at this stage. Upside definitely is there, assuming world becomes normal in FY27.
By the way, the markets come off, and I think we've got about 300 points left now, 330 odd points left on the index. We're at the day's low, so from 230, I think we've come 22. We started about 22,730, and we've given about 65 odd points from that level. And of course, from the highs of the day, we're down about 250, 300 points or so. Nifty Bank, of course, also has come off a little bit from the day's high, 1%, but still, these are decent gains. Well, defense is a space which is doing very well. Shipbuilding companies, I mean, there's Cochin Shipyard, Mazgaon, and Garden Reach, and of course, the other side of the equation, the HALs of the world, BELs, etc., are doing well. Ria is here with a quick update on what's happening. Ria.
Well, yes, a lot of defense companies have come out with their provisional updates for FY26. Starting off with BEL first, the revenue has come in at roughly 26,750 crores, which is up more than 16% on a year-on-year basis. And the guidance that the company had given was of 15% revenue growth. The order book of the company also remains quite strong at 74,000 crores, and the order inflows for the year have crossed 30,000 crores, well above the guidance of 27,000 crores that the company had given earlier. So strong update for BEL, and this along with the new order win of nearly 7,000 crores that the company had announced yesterday, that has been leading to the surge in the stock today. Moving on to HAL though, the provisional update has been quite weak on the revenue front. The revenue has come in at roughly 32,250 crores, which is up only 4% on a year-on-year basis compared to the guidance that the company had given of 8 to 10% growth. So that has been a miss for HAL. The order book, however, is quite strong at 2.54 lakh crores versus just about 1.9 lakh crores compared on a year-on-year basis, and this is in line with the guidance that the company had given. Garden Reach as well has seen a miss on the revenue guidance for FY26. As per the provisional update, the revenue has come in at roughly 6,400 crores, which is an increase of around 26%, but the guidance that the company had given was of 40% revenue growth, so sharp miss on that front. And there has been no update on the order book as of now, but the company had said that they are targeting an order book of roughly 50,000 crores by the end of this financial year, but contingent on the next-gen Corvette order, but there have been no updates on that front. But overall, even after these weak updates for some of these stocks, all of these defense stocks have been surging in trade today. In fact, the entire defense index is up nearly 4 to 5% today.
Got it. All right. Thanks a lot for that, Ria. Sudeep, what do you make of these names?
I think overall there is definitely a lot of traction as far as defense is concerned. The order book is overflowing, and the way the world is, I think the order book will continue to attract more and more orders for all these defense companies. I have been liking BEL for the last 2 years, and I continue to like BEL even at current levels. Look, this is one defense stock which hasn't corrected significantly even during the carnage of last financial year. But in spite of that, not correcting heavily, I think even at these levels, from a long-term investor's point of view, this is a fantastic stock. They cater to Air Force, Army, Navy, all the three segments of defense. And, electronic warfare, electronics is becoming more and more important. So BEL have a exceedingly important role to play. Also, the company has been executing projects efficiently, which cannot be said about many other defense peers. So I do like BEL. BHEL, a lot of orders are coming in, though it's not strictly a defense company, but execution is still not up to the mark, so I'll wait. As far as the shipyards are concerned, they are all expected to do well, but valuation is not really cheap, and I think I will be a little cautious buying in at these valuations.
I think we got a bit of a patchy line there as well, Sudeep, but got the most of it. Thank you very much for joining us. Good speaking with you, and appreciate your time here, Sudeep. So that's the conversation on markets as things stand. Well, I think 300 points, which basically means that we've lost some steam. And is it because of tomorrow? Of course, we're trading. The holidays on Friday. But tomorrow morning, before markets open, there is President Trump who's going to be speaking. It's a kind of a sort of address to the nation. And that's 6:30 a.m. our time, IST. So what will he say? Will he say, I'm winding this war down, he's going to double down, etc.? I mean, generally the expectation is the former, which is that he's going to wind things down. Yeah, but it's all going to happen between when we are shut and when we open. So a bit of a blind spot in that sense. 22,640 on the index. We'll take a quick break. We're back. Atul Mehra with us on the other side. He's our Alpha manager.
Welcome back. Markets still holding in the green, though we have come off the top. 300 points on the Nifty, you'll still take that, and more than 1,000-point gain on the Nifty Bank. But let's go across to Hormuz. He's joining in to tell us a very interesting piece. Remember, retail investor interest in IPOs That's waning a little bit after a frenzy of oversubscription. Many investors are now turning cautious as numerous stocks trade below their IPO price. Harma joins us to fill us in with all the data he's broken down. Harma, take it away.
Well, this data from Prime database, as staggering as it is, the IPOs, which have been the buzzword over the last couple of years, have only flattered to deceive. And this first plate will tell you exactly why. Now, the average IPO return in FY21, which stood at over 200%, has now become a negative 7% at the end of FY26. That's the biggest takeaway from the IPOs of the financial year gone by. Now let's take a look at the numbers. Again, it was a record year of issuances. FY25 was a record year. FY26 was an even bigger year. A 10% jump in the total number of funds raised in through the IPOs. Now take a look at the public equity fundraising. Now here's where things start to get a little wobbly. The total public equity fundraise, which is inclusive of equity and debt, is down 18% from FY25, just managing to hold above the 3 lakh crore mark. The average deal size of an IPO has come down by 23%, or has gone down by a quarter, from around well over 2100 crores to just under 1600 crore rupees. Now look at the average retail applications. The average retail applications in FY26 are down 40%, from 21 lakh to just under 13 lakh. Now look at the biggest issues as well, where the retail applications were the highest. Bharat Coking Coal saw the biggest. Almost 69 lakh applications came in from the retail investors. LG, which was the most bid Indian IPO in history, that's 55 lakh applications. Meesho had 54 lakh applications as well. But take a look at the numbers by value. Now in this year, the value of retail applications was 57% higher than the total number of total amount that was raised via the IPOs. That is still lower than the 103% figure that you saw in FY25. Now the average retail subscription of IPOs has also halved in FY26. It was 18 times. In FY25, that was almost 35 times. The same is the case for the average listing gains as well. The average listing gain in FY25 was 30%. Now for those who are playing the IPOs for the listing pop, they have been disappointed, because the average listing gain in FY26 is only 8%. Now take a look at the fresh issue proceeds as well. Companies have mainly utilized the fresh issue proceeds for expansion or for capex, around about 41%. Majority of the rest has come for debt repayment, working capital, and of course for other corporate purposes as well. The reason behind this flattered to deceive number is that out of the 108 IPOs that you saw in FY26, only 37 of those are trading above their issue price. That has been the kind of returns that these IPOs have had. Now even for those that have had more than 10% returns, that figure is only 31%. That compares to the 71% returns that you had in FY25. That's the kind of IPO performance that you have had. But the most telling stat remains the first one, that the average IPO return, which at one point was well over 200%, has now slipped into negative territory.
All right. Well, Harma's interesting data, and maybe we can go into and maybe out of this data set, right, where stocks, many are below IPO price, around IPO price, will come opportunities as well that we'll talk about with Hormuz as we go along. Thanks very much for that data, Hormuz. Appreciate it. We have Atul Mehra, who's with us. He's a fund manager at Motilal Oswal Asset Management Company. Atul, good to have you with us here on the program. Thanks for joining in. So, what's the, I don't know if there's a house call on these things. I guess not. But everyone has a view whether the war is winding down, because everything pretty much depends on it, right? At least in the near term, Atul. What is your sense?
Yeah, hi Prashant. Hi, good afternoon, and thanks for having me on the show. So yes, so like in the last few years, we've had many of these very extreme events, right from COVID to more recently, like a few months back, the dominant theme was around the trade war, and now it's this Iraq war. So as such, if you look at it, like the way we are basically positioning portfolios is, much part of the damage in terms of anything linked to the war is it's very much in the price in many of the names. And as we all know, like we've seen even the Trump administration now for almost like a year and a half. So things, get to very, very, very extreme levels, and then they flip, right? So incrementally, the thought process is to position towards more from the perspective that sooner or later sanity will prevail and things will get back to normalcy. And as the markets kind of bounce back, your portfolios should be positioned in a way that you participate in the bounce back. So incrementally, the thought process is more towards that than turning defensive or worrying too much about how bad this can really get.
Hi, Atul. Good to see you. And as always, Atul, give us a couple of details then. Which would be those sectors that you think in the post-war will actually do well? They could be beneficiaries because there will be some winners that will come out. Yes, the economy will get hit because of relatively higher crude oil prices, but there will be some sectors that will stand out. So if you want to name a few, and also what cash levels are you all sitting on? Are you all fully deployed?
Sure. Thanks, Nigel. So firstly, in terms of sectors that look well positioned for a bounce back as things kind of take normalcy. So one is, I think, more to do with, say, names like in the construction capital goods space, like L&T, for example, where business was doing fairly well. It got hit by a jolt which was out of their control at the company specific level. But as things kind of normalize, we think that can be one zone where things can be looking up quite well. Similarly, even like oil sensitives, not necessarily the PSU names, but like aviation, for an example, as a theme. Like today, we've kind of seen the impact of partial revision of fuel price in the ATF and so on. But the business is very strong. The market share is like in the mid 60s. Management change has already been taken into account. So as things kind of normalize, we believe that some of these businesses which are well run, which were doing very well in the absence of the war, but which were just impacted because of the war, they would stand to benefit the most. Additionally, I think also one other impact that I think we need to see now is with the currency at 95 to the dollar. So if you look at many of the IT names now, just because of currency translation, you will see that there will be earnings upgrades in some of these names which have been, obviously they haven't done, like they've been amongst the worst performers because of the AI narrative. But technically, if you look at just the earnings model for these companies now, you will see many of them going through earnings upgrade cycle because of just the currency factor to begin with. So again, that is one zone to in terms of it's a bargain area at this point in time and should do well in our opinion as the companies announced with us. At a house level, in terms of cash, I think we have very moderate cash at this point in time. Most of our funds are fully deployed in terms of cash.
All right. So, aviation stocks, well-run companies with good market share is something that you like. And tech would be your contra bet?
Absolutely.
All right.
Because many of these valuations for the names are like in the mid-teens range at this point in time. And like we were saying, like one is to look at the narrative, the other is to look at the numbers. Now, if you look at the real numbers, you will see earnings upgrade in the range of about 10 to 15% for many of these names.
And that will start, Atul, you reckon, as we start to get numbers in about 10 days from IT companies, that repricing of expectations will start to happen? Or this is a slightly long-drawn process and one does not know. We just know that maybe, we had Venugopal Garre of Bernstein in the morning and he was kind of making something similar point. He said stock prices are generally implying about a 5.5% earnings growth for the next 10, 15 years, which is unlikely, and it should be higher. So, no, I'm just saying in terms of timing, is there any way to tell that it'll start to look a little better immediately post numbers, or what's your sense?
Right. So I think what has really happened here is we've seen kind of a little bit of a peak of fear that has really played out in some of these names because the narrative on AI is anyways a long-term narrative. Like the next quarter or the next year is not going to be materially impacted because of the fear of AI. So anyways, the numbers for many of these companies in the near term were not going to be in terms of significantly impacted because of the AI narrative. Now, add to that now with what we've seen in terms of the currency itself at 95, so that in terms of translates into a much kind of earnings upgrades. Secondly, I think the point you're making around 5% implied growth. If you look at the long term, like rupee depreciation is about close to 3%. So effectively, what you're saying is these companies will be like 0 to 2% growth in terms of dollar. So anyways, the expectation levels are in terms of they're not building in for any kind of growth to begin with. So in that sense, the room for disappointment is not there because you're anyways not building in the growth in the first place. So with that thought process, incrementally at the margin, things are looking quite reasonable in IT as a sector. And
I was trying to understand, it won't be, I mean, if you buy there's attractive levels to buy, but it won't be dead money, right? That you sit on for the next 1 year and nothing happens. That's all I was trying to get at.
Absolutely. So Prashant, I think, with IT, what we've seen over the last many years is because like on any kind of, if you have near-term growth come about as a catalyst, even to some extent, the sensitivity on prices in terms of some of these names can be very high. So if you have, say, the quarterly earnings season and commentary and order books being quite okay, you might see in terms of a quick repricing in many of these names in the near term as well, right? So what I'm saying is whenever we look at names, we look at the risk reward, right? So if you look at the downside here, it's fairly limited. And incrementally, if things were like even with the currency and even with the commentary, if things are on the positive side, you might see a very quick repricing in terms of positive come about in some of these names in the medium term.
Atul, talk about a few ideas here.
Ideas
for educational purposes.
So I can just say the only education I've had over the years is you have to buy the best management teams. In the long term, this is how you make money. Irrespective of the sector, irrespective of the space, the real good management teams and the founders, they make you all the money in life. So that's been my only learning. Because of SEBI restrictions, I can't talk any particular name, but that's the overarching theme, I think. Like we've seen as a house over the years, like it is end of the day, like a lot of day-to-day is about noise, but end of the day, what really makes you money is great founders and management teams.
Let me ask you, Indigo is an example. As an example, essentially, right? I mean, oil sensitives is a... So if again, this is short-term, but this is also consequential, right? The damage has been consequential, so because of the Iran war. Now the war winds down, oil falls. Indigo at about it's a dominant business by far, about 4,200 now. These are the kind of ideas, and of course, I mean, in terms of management, they got a new guy at the top now.
Yes, so Prashant, just to reiterate that point. So if you look at this is like as a business, it is an extremely execution-intensive business, right? So we've seen Indigo for the last 20 years now being a success story, right? But if you look at who has been able to come even close to Indigo, there's absolutely been nobody in terms of execution prowess, right? So, and over the years, we've seen them just gain market share year over year over year, right? They had a crisis last year as well, which was like the pilot crisis and staff crisis, etc., which was a one-off, right? And but what I'm saying is, some of these companies, as they go through this crisis, their competitors will get even weaker because they are the most efficient run and they can survive a crisis. But when it comes to competition is so weak and fragile that they might get impacted even more. So the market share gain for them would be eventually even higher, right? So, so these are the times when you get these companies at reasonable prices, and as things in terms of normalize, then you will see that repricing come about in Indigo as a name. So basically, yeah, it's just coming back to basics in terms of what are the key themes with which you'll make money. Like same thing with L&T, like I said, right? There's nothing wrong. They've even had a communication going that most of the projects on the ground in the Middle East are not impacted, right? So in the near term, everybody gets painted with the same kind of brush, but as the fear element goes away and you look at the quarterly numbers, you look at the order books, etc., execution, you will kind of get repriced very quickly again. So that's the recurring theme in a way, Prashant.
Got it. All right, Atul. Thanks a lot for joining in and hinting us at least sectors and themes that you like. Good to hear you're fully invested. And as you say, sometimes crisis like this gives you an opportunity to buy well-run companies with good management pedigree as well. Have a good remainder of the day, and we'll catch up soon.
Thank you. Thank you.
All right, let's do a quick check of the markets then and see what's going on in the F&O basket. Today, it's good news because both the batsmen are doing well. That is the Nifty IT Index as well as the Nifty Bank. Both of them are putting on good weight. So both cylinders are firing out there, with both of them up close to around 2% apiece. As I mentioned earlier today, the rolls were indicating that, extreme pessimism with the kind of rolls that we saw, just around 40 bips or thereabouts. Reliance Industries, that's the one I think that holds the key from here on. It needs to get past the 20 DMA and then go to around the 200 DMA, because, that's up only around 1.8%. If it can get its act together, remember the bad times, it actually relatively outperformed the market when the markets were cracking. Moving to the options data, PCR at around 0.9 or thereabouts, that's somewhere in the middle, between that range of around 0.6 to around 1.5. Couple of strikes that are active. The 22,700 put premium, well, that's come down a little bit. 22,700, yeah, it's come to roughly around 300 rupees. At the start of today, it was 550 rupees. So there is clear writing that we're seeing at that particular level. But there is some out of the money action as well. The 23,000 call, that's seeing a mix of activity. The premium at the start of today was 140 rupees. That's gone to around 180 rupees or thereabouts. There is some signs of writing out there, because some believe that 23,200 mark will not get breached. But out of the money put buying is evident, and out of the money call buying as well is evident in case we get a big move. So, keep that in mind. Individual stocks, some stocks are getting shorted actually very aggressively. Case in point being an eternal sharp correction being seen out there, but today some of those shorts are getting squeezed out. So there's clearly a short covering bounce that's playing out there. Yes Bank is another stock that's coming for a bit of a short covering bounce in today's trading session. Stock popping up and in fact open interest lower. While on Ashok Leyland, they just came out with their numbers, and in an otherwise strong market, that's actually seeing shorts piling onto the system out there. So that's one seeing fresh shorting. Finally, Sammaan Capital, it's the first day of a new series, but if you had to look at a couple of stocks that could actually make its way into the F&O ban, this is a strong contender actually. Maybe by the file by the end of today or maybe tomorrow, this should probably go on the F&O ban. So keep an eye out on Sammaan Capital. As we've seen in the past, at the start of the series, some of these stocks, they're most likely to go into the ban. And mathematically, it appears that this one could be them either today or tomorrow. Well, time to slip into a short break. But on the other side, we get a quick check into dealing rooms. Nimesh is waiting for us. We'll also get you a couple of technical calls. Don't go anywhere.
Okay, welcome back. I think we have the market, which of course has continued to come off a little bit more. Okay, 350 points, so right about there, about 1.25% off the day's highest level. Well, let's get the D Street. Let's get insights from what Nimesh is picking up from dealing rooms that he's been speaking with on D Street chat. And Nimesh, take it away.
Hi, Prashant. So a decent recovery from an extremely oversold levels. Yes, we are off the day's high, but nevertheless, it's a decent recovery. And largely looks like it's a part of short covering rally across many sectors. I'll talk about the sectors, but looks like it's large part of the rally seems to be a short covering rally. Having said that, maybe you'll see a bit of a positive in terms of the FI flows. May not be net positive, but if not net positive, a very small negative number is my sense, because there is a small MOC buy basket as well at a leading FI desk in today's trade. So today's institutional data will be quite interesting, but more so from an FI perspective on whether they are net buyers. If not, not big selling as well. Sectors which stands out for short covering, defense stands out, tech and financial are the other sectors which stands out in terms of short covering in today's market. Defense, of course, the index has rallied 5%, and a lot of stocks are buzzing in trade today. Even the broader market has seen a good recovery in today's market, largely because, on Friday we saw massive selling because of the year-end. There was a lot of unwinding which took place, and now fresh, new year, and you're seeing a bit of pullback into many of those, broader market names in today's trade. The only sector which stands out for a bit of profit booking is the healthcare index. The pharma index is on 1%, and that's the only index which actually stood out in this volatility. And now you're seeing a bit of churn from pharma to other sectors. So that plays out. But my sense is today the sell number, if it is, will be very small from the FIs.
Okay. In terms of individual stocks, Nimesh, what are you picking up?
So the first name that stands out for me is HDFC Bank. Amidst all this controversy and there is aggressive selling from the FI desk of late, HDFC stands out today because I understand there's a bit of buying interest back. And interestingly, there is a small MOC buy as well within the MOC buy basket names in HDFC Bank today. So that stands out. Given the aggressive selling from the FIs, a small buying has emerged at these levels from the FIs. So that's the first name. The second name is Bajaj Finance. Again, part of the financial basket is recovered in today's trade. But at least in Bajaj Finance, my sense is there is selling pressure. So a lot of the funds are looking to lighten the position in Bajaj Finance further into today's rally. So that's the second name. The third, couple of stocks where there is selling, REC and IOC both stands out within the PSU basket. There is still aggressive selling from FIs into both those names. And the last is Interglobe Aviation. It's been the big talking point stock throughout the day. Big mover as well, up 6-7% in today's market. But I understand post this recent correction and some clarity, a couple of HNIs are aggressive buyers into Interglobe at current levels.
Nimesh, somebody who owned the stock in a big way in the last cycle as well?
I'm not too sure whether he's still big aggressive buyer, but at least a couple of larger HNIs seems to be taking fresh positions in Interglobe after whatever has been seen and whatever been. The stock is also corrected sharply, and the feedback is you get these kind of leadership companies only in the worst of times. So that's the rationale on why they've looked at adding into Indigo at current levels.
A few. Okay.
A few of these HNIs, yeah.
Got that. Nimesh, thanks very much. So that is an interesting list and some color on what's going on. 350 on the Nifty still, so not big change. Nagaraj Sethi is with us with a quick run through of what short-term trading ideas look like. Nagaraj, take it away.
Hi, yes, Nifty has not done anything the last half an hour, just slightly shown some recovery, but still 23,000 is market facing strong resistance, and the way previously it has declined from the lower highs is indicating that more weakness is likely, at least for the shorter term. At the lower levels, 22,300, 22,000 is going to be a strong support for the market. I think this time I'm reiterating that if Nifty anyway it comes down to that level, there is a higher possibility of decisive bounce back again from the lower levels. I'm continuing with the two stocks, the PTC India Limited, which is currently trading around 167, made an upside breakout of the consolidation phase. Now it places the edge of moving above 200 EMA. I'm continuing with the same target of around 167 for the short term. Second one is NOSIL, currently trading around 163.75 after a stellar move, declined a bit and moved up again after forming a higher bottom, placed near the upside breakout of 200 EMA. I'm continuing with the 174 target for the stock price in the near term.
Yeah. NOSIL has had a move and how, right? I mean, very, very sharp. Recent low 126 went up to 180 in about 6 or 7 trading sessions. Cooled off day before yesterday to about 150 and back at 164 at this point in time. So, I mean, from 125 level, still, of course, has done very, very well, while the rest of the market, of course, is there or even slightly lower. Auto sales numbers have been coming through, and Ashok Leyland reported numbers. Stocks actually fallen sharply. Maruti also reported in the last 30 minutes or so. Sur is here to detail those out for us. Sur.
So Ashok Leyland, so majority of the companies have reported numbers that were largely in line. One company that is likely to have disappointed is Ashok Leyland. Sales have come below estimates. We were expecting growth of around 15%. Company has reported growth number of just 5%. And if you take a look, 3-month average of majority of the segments, and those growth was in the range of 30 to 40%. And for this month, basically month of March, there's a sharp decline in the growth number. So for truck segment, company has reported growth of 10% versus last 3-month average of 37%. LCV segment, growth at 17% versus 3-month average of 25%. Bus segment continues to see a decline. Last month decline was just 5%. This month decline is at 34%. It's the biggest decline that company has seen in several months. And these things have resulted in company reporting growth number of just 5% versus our expectation of 15%. And total sales are up 5% versus 3-month average of 26%. And in the last few trading sessions, the stock also has come off highs from the recent high of 210. It's now hovering around the level of 150. But Maruti has reported numbers that are looking very good, both on domestic as well as on the export front. And on the domestic front, the sales have been led by compact as well as SUV segment, and export continues to see a healthy growth. So March growth has come at 17%. We were expecting 11% growth. Domestic sales have increased 11%. And export too, while base is very low, there also growth has come at 43%. And many, or say entry-level segment, there also growth, but it's a very minor growth. So Maruti, good numbers. Ashok, disappointing.
Got it. All right, sir. Thanks a lot for that, Sudarshan. What about Interglobe Aviation? A little bit of a flip-flop in the morning. But there is some relief that's come in there because they will not be bearing the full brunt of this higher ATF prices. Run us through the data points.
So it was interesting last few hours in the morning. When we came in the morning, we got a shocking news of 115% increase in the ATF price from the last price that we had in the month of March of 96,600 rupees per kiloliter. And from there, it was increased to rupees 2.07 lakh. But within few hours, we got a clarification from IOC that that increase is not for our domestic flights or say domestic airlines. And following that, around 9:40 a.m., company has put out the new price, and that was 1.04 lakh. So that tells you the increase of 8.5%, not 150% that company had announced early in the morning. And following that, we also had clarification coming in from both Aviation Minister as well as Oil Ministry, saying that despite the sharp increase in the international crude price or ATF price, we have made sure that it's not passed on to the customers. And domestic ATF was expected to be increased by more than 100% in the month of April, but they have increased, and this is Oil Ministry's statement, that they have done a staggered increase, or OMCs have passed on a staggered increase of 25%, or say rupees 15 per litre. But what is the reason behind this, or where exactly this math of 25% come? So now sources say that as of March 31, ATF price in Delhi was rupees 85 per litre, which has been increased to rupees 104 per litre. And if you do the calculation, that increase comes in the range of 22 to 25%. And in the rupees, it comes around 15 to 17 rupees per litre. Now, what's the impact on Indigo? So total ATF forms around 40% of total cost for Indigo. And now this 8.5% increase is much below what analysts were expecting. They were expecting an increase in the range of 50 to 100%, and because of that, you have seen a sharp uptick in the stock price. At one point, the stock was up as much as 10%.
Got it. All right. Thanks a lot for that, sir. Well, let's welcome Mayuresh Joshi, who joins in on the show. Hi, Mayuresh. Good to have you on the show. Mayuresh, a couple of stocks are pulling back after getting clobbered in the last few sessions. One such stock is Ola Electric. It's become a trading stock now. After the promoter actually sold at around that 30-35 rupees, all the street got very, very nervous. Now, this morning, they put out a release that, in fact, they've seen a bit of a bounce back in March, and towards the end, they believe demand has come back. At 25 rupees, would you look at the stock or avoid it?
So, Nigel, I think it's an avoid at our end, at markets mid end. I think two things. One, I think the fall has been tremendous in terms of price. So I think at some point of time, looking at updates, the expectation is that from a price perspective, it will bounce. But consistency in numbers is something that we strongly believe in through our EPS rating methodology. And therefore, I think this stock clearly lacks that. Obviously, competition, after sales, and a lot of other issues are plaguing their balance sheet as we speak. Therefore, I think within auto, I think better to look at the leadership two-wheeler stocks as we speak.
Okay, leadership two-wheeler stocks. Got that. What about Sammaan Capital? We had Mr. Gagan Baga, who joined us earlier today. And he was very optimistic on the prospects. He's talking about the ROE is going to high teens. He's saying the credit cost will stabilize at lower levels. They're looking at growing the book big time as well. And the cost of funds, because of the money that's come in, it will fall by around 200 basis points. And I think cost of funds is going to be very important because central banks across the globe will have very limited ammunition now to cut rates. What's your view on the stock, Sammaan Capital, from the highs of the day it's come off?
No, absolutely agreed. I think all these factors put into account might mean that there will be a stronger recovery as far as earnings is concerned. But our sense with the NBFC space is still to probably continue if you're holding positions for a stock like Shriram Finance, as an example, compared to a Sammaan at this point of time. Again, I think the expectations in terms of the deal that Shriram has got through, I think there's going to be a huge capital infusion to their balance sheet, Nigel. And therefore, I think both from a balance sheet expansion perspective, in terms of their overall cost of funds, which is going to be paramount for NBFCs as we head into the next few quarters, as well as the diversified nature in terms of their overall book, makes us believe that there are strong triggers in place for Shriram Finance, both in terms of balance sheet expansion, in terms of having a better say in terms of the funds that they've probably got, both to utilize and expand their balance sheet as well as their business operations are concerned as well. As far as tighter control from a risk management perspective, both in terms of asset quality issues, as well as expectations in terms of the NIMs, which should remain stable, along with stronger capital adequacy, which will aid to better ROEs and ROEs going forward. So as a comparison and within NBFCs, I think if you're holding Shriram, I think it's a much better and a bigger bet compared to a Sammaan at this point of time.
Yeah. Okay, got that. You know, what we're going to do is just play out some sound bites of our conversation, slice the conversation with Venugopal Garre of Bernstein. We had him on in the morning. Venugopal, not exactly, not bearish actually, but not bullish either. Somewhere in between on macros and, of course, micros as well. Listen in.
Current account deficit impact, a fiscal deficit impact, and we're also heading into a year where monsoons are not expected to be that great. Putting all this together, the reality is that there is going to be pressure on macro growth. So if macro growth pressure is there, there's going to be an impact on earnings growth as well. Now, at this juncture, consensus is building in close to a 12% odd earnings CAGR over 2 years. Now, historic measures do suggest that you'll see earnings cuts as well as a valuation getting trimmed down when a worst case scenario is built. GFC was about 12-13 times earnings. At this juncture, after the rebound today, we're probably closer to 16 times 2 year forward on the index, on, of course, numbers which are not cut yet. So if you assume a 10% cut, that's not a worst case scenario, and assume multiples to probably remain at the current levels, so slightly moderate to 15x perhaps, not even 12-13x, you're looking at Nifty below 20,000, roughly in the 19-20,000 range. I'll probably say those are the levels which would probably characterize as worst case. If you were to take the 2021 sort of a measure, very clearly thereafter India went into a couple of years of very strong earnings growth. You can say it was probably after years of general weakness in earnings. There's so many things that worked well in post 2021 for a couple of years before things faded off. Now, if you were to look at the growth cycle today, we are not really in a very hefty growth cycle. It's been almost 18 months with meager earnings growth. The next 12 months as well, while there's an expectation of earnings recovery, and this has nothing to do with war. Even when the war was not there, we were not really looking at consensus building in a very large earnings growth for the next 12 months. Any growth that was being built was for the year after, not necessarily the next 12 months. So from that construct, valuations, while have corrected, and maybe even fair, but are not cheap relative to the past. That's the only argument I would probably make.
Welcome back. Well, the markets continue to hold in the green as we speak. We're up close to around 400 points or thereabouts. We're still in conversation with Mayuresh Joshi. Mayuresh, give us your top pick from the defense pack. Many of the stocks have come down to more palatable levels. Case in point being an HAL, you're not finding alpha. I had Vikas of ICICI Securities. He said HAL at the peak was around 45 times. Now on a trailing basis, it's around 25 times. Would you buy into that argument?
Absolutely. I think it's absolutely valid. But from a rating ranking perspective, as we see in markets with India, I think Bharat Electronics probably looks more resilient as we speak. Again, I think the basic argument is very, very common. Order book looks extremely strong. What they've probably achieved over the past few months in terms of past few quarters in terms of execution has been extremely robust. And therefore, I think with new orders coming at better margins and with better execution, the expectations in terms of better numbers flowing through on a consistent basis probably remains key. With better margins, I think the expectation that we are now probably getting out is that the management is probably looking at orders with better margins rather than just pursuing orders for the heck of creating an order book in terms of revenue visibility, which already exists. So in our opinion, I think BEL with the strong rating and ranking that it possessed probably remains one of the stronger defense stocks as we see it.
Got it. Thanks a lot for that, Mayuresh. Well, time to wind down the markets. It's been a while since we had 2,800 stocks that were ending in the green with around 240 stocks in the red. 10:1 in favor of the number of stocks advancing. Sectors that did do well today. You had both the backbones of the market actually did well. Tech as well as the Nifty Bank. Both of them were up close to around 2%. Remember, the rolls from last series into this one were on the short side. So any kind of positive trigger is going to send these stocks up. And that's precisely what happened. From the Nifty pack itself, what did very, very well in today's trading session was Interglobe Aviation. A new boss at the helm, as well as, lower than expected ATF price hit. That's what led that stock up. Trent as well bounced back in trade, and Adani Ports did pretty well. The defense pack, well, the sector itself was up and about in today's trading session. Individual stocks that did do well, stocks that have actually fallen off the cliff did bounce back. You had Vascon Engineering that was up close to around 15%, one of the top volume movers. HCC as well was up close to 10%, but it's only a 15 rupee stock right now. IDBI Bank, a stock that had got slammed, that was up close to around 10% in trade today. KNR Constructions up 8.5%. And Ganesha Ecosphere, that one in fact was up close to around 20%. It went to circuit, I think, in the first couple of hours of trade itself. Got a bit of a relief with regard to the notification. So that was one of the stocks that were up. On the flip side, there are a few losers otherwise in an otherwise strong market. So you had Dr. Reddy's that was down, HDFC Life that was lower, and Cipla as well that was lower in today's trading session. In fact, today you had the auto sales numbers as well, and Ashok Leyland was one of the top losers that was down close to 3.5%, while Sammaan Capital from the highs of the day, in spite of the positive news flow and the management commentary as well being fairly positive, the stock actually did come off close to around 7% from the day's high. The bulls will take this as a good start to the fiscal year and a good start to the series as well after the recent sharp pullback. They'll want some continuity and hopefully some pleasant news coming in from President Trump when he addressed the press tomorrow morning. So we'll wait by for that. For the time being, curtain down on the market. That's the end on closing bell as well. But stay tuned. Markets Forward comes up next.
The market snap a two-day losing streak but end off the highs of the day. The Nifty ends near the 22,700 mark. The Sensex jumps close to 1,200 points. The broader markets, though, outperform.
Shares of Indigo rise after the airline names former British Airways chief Willie Walsh as the CEO effective August 3. Lower than expected rise in ATF prices also support the stock.
Defence stocks rally led by BEL on order wins worth nearly 7,000 crore rupees. Garden Reed Shipbuilders gains despite a weak revenue report. Meanwhile, the Reserve Bank of India's deferment of capital market norms to the 1st of July triggers a rally in Angel One, BSE and other capital market names. You're with us here on Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Hormuz Fatakia, with me Manglam Malu. Manglam, good afternoon. A good day for the bulls, a good start to the financial year, but again, not managing to sustain at those higher levels.
Well, you know, the fact that we snapped a two-day losing streak would be positive. At the same time, crude prices tell you a story. And we've started a new series along with the new financial year as well. So all these factors, along with the decline that we've already seen in the markets already, should give bulls some sort of support. Yes, there is a concern that we're not sustaining at higher levels, but that's also because the environment right now, even though pointing towards truce, is not entirely hunky-dory. 3 data points that stand out and that tell you that maybe bulls feel a lot better today than they've been feeling earlier in the earlier recoveries. The one part is the advanced decline ratio. We ended the day with nearly 2,800 stocks in the green for just about 200 in the red. So in the last many trading sessions, this has been the best advanced decline that we've seen. The second part is the India VIX, which fell in double digits today. So that's a positive as well. Fear is somewhat subsiding. And the third part is that the Nifty Bank outperformed. So, you know, these three factors should do well, should make bulls feel a lot better today than what they've been feeling in the earlier recoveries as well. But then again, that's hope. We'll tell you what we've lined up on the show for you today. Top movers and shakers of the day. Sudarshan joins in. Then we'll discuss obviously why Indigo, BEL and Avenue Supermarts were in focus today. And last but not the least, we delve into the key market events that you need to watch out for in tomorrow's trading session. With that, the first segment of the day, all the movers and shakers. Sudarshan.
Same time on Monday, or say 48 hours ago, the entire screen was red, and we were talking about the broad market sell-off. And this is how things have changed overnight, or say in the last 24 hours, thanks to the commentary you have got from Iran as well as the US. And because of that, today we have seen a broad-based gains. And top Nifty gainers you talk about, Trent up more than 7%. Similar move was seen for Interglobe Aviation because of tariff price hike, and that was much lower than expectations. All the defense names have been buzzing ahead of the CCS meet, and BL also has bagged an order. That's the reason this stock was up almost 5%, and Adani names were higher too. But AC and plastic companies have seen a drop. For AC company, there are demand concerns, while crude prices have come off recent highs. That's the reason Astral and Supreme Industries have slipped in the trade. Both stocks are down more than 2%, while AC companies Blue Star and Voltas down 2 to 3%. What about new F&O inclusions? So apart from Hyundai, all the names were in the green, but Hyundai, despite reporting a healthy set of numbers for the month of March, the stock has closed in the red, while all the other names you can see on your screen up in the range of 4 to 12%. Lastly, some of the big mid-cap movers, Avenue Supermart, continue to see the news of new store additions, and recently also they have added new stores, and because of this stock has been moving higher for the last few trading sessions, and today also this stock was up 8%. Dixon Tech, on Monday we saw the news of PLI getting approved, and today because of semiconductor news this stock has moved higher 6%. BSE, all the capital market names were higher. BSE closed with a gain of 7%. Hudco after quarterly update moved higher 5%. Ashok Leyland, amongst all the auto companies, this was one company which is disappointed as far as March month sales were concerned, and that's the reason at the end the stock was down more than 3%.
Sudarshan, thank you for that update there. To take the conversation forward, we're joined by Mayuresh Joshi of MarketSmith and Shrikant Chauhan of Kotak Securities. Gentlemen, good afternoon. Thank you for joining in. Shrikant, to you first. Your call on the index now. We've seen a bit of a bounce from lower levels, but again, the higher levels are proving to be a bit of a concern. What are the levels that you're watching out for now on the index and your call for it?
Yeah, good afternoon. So while looking at the index, see, like most of the time, whenever there is a recovery in the market, the Nifty has managed to surpass the level of 22,800 or 22,900, but it is failing to cross the level of 23,000 and sustaining about the same. So I think 23,000 is certainly which is going to act as major resistance for the market. And till the market is not crossing this level, it is going to remain in a broader range of maybe, again, we can say 22,000 on the downside and 23,000 on the higher side. So in the near term, if it breaks the level of 22,500, then we can expect further more weakness. But while looking at the today's breadth of the market, I'm of the view that 22,500 should act as major support for the market. And if we consider the breadth of last, let's say 10 days, most of the time, the breadth was down more than 90-95%. So we can say that the market has already seen its worst, but we need some more clarity. We need some more supporting factors to take some concrete call on the market. But till then, I think market is going to spend time within the broader range of 23,000 and 22,000 on the downside.
All right, take that point on the levels, but let's talk about the story that was the big one of the day, and that was the big move that we saw in Interglobe Aviations, and that's because jet fuel prices moved higher on account of the higher crude prices, but the government's actually passed on that hike by a much smaller amount to keep consumer interests at the forefront. This hike has been shared among the government, oil marketing companies and the aviation companies, and as a result of which some of the players like Interglobe Aviation benefited. Sudarshan joins in back off the big movers wall to the Interglobe Aviation story.
So today early in the morning at 6 a.m. on IOC's website, it reflected that ATF price has been increased by 115%. New price would be rupees 2.07 lakh per kiloliter. It came as a shocker. But within few hours, there was a clarification from IOC, and on the website, they have put out that this price hike is not for domestic flights or say domestic scheduled airlines. And around 9:40 a.m., they have put out a price increase, actual price. So the actual price was rupees 1.04 lakh per kiloliter in Delhi, and that amounts to an increase of 8.5% from the March 1 price that we had of rupees 96,600 per kiloliter. Now, after that, we had statement coming in from Aviation Minister and Oil Ministry. They have said that PSU OMCs, oil marketing companies of HPCL, IOC and BPCL have passed on staggered increase of ATF increase of 25% and in absolute terms rupees 15 per litre. But where is this math of 25% come from? Now we have got the information from sources that as of March 31, ATF price in Delhi was rupees 85 per litre, which has been increased to rupees 104 per litre. And if you do the calculation, the hike comes in the range of 15 to 17% or say rupees 22 to 23 per litre. And this has positively impacted the stock of Indigo. At one point, that stock was up 10% because 40% of total costs are contributed by ATF. Now, analysts believe that this 8.5% increase is much below what they had expected, and their expectation was in the range of 50 to 100%.
Sudarshan, thank you for that update. But staying with Indigo, the airline also announced the appointment of William Walsh as its new CEO. Now, this comes after the departure of Peter Elbers, who stepped down following mass cancellations in December. Vinny is here with more on that. Vinny.
Hi, so absolutely, this is coming just around 3 weeks after Peter Elbers had resigned from this position. Now we have seen that the new CEO is William Walsh. He'll be taking the reins over there. He's got more than 40 years of experience in the aviation industry. Yeah, and his last stint was as the Director General of IATA, and that was since 2021. Now, what does this mean? Interglobe Aviation has already been focusing a lot more in terms of when you look at it, the global front. They want to expand their international front of the aviation side as well. They want to focus on that. So with that strategy, some analysts have highlighted that this could be a bit of a positive that comes in for Interglobe Aviation, given that William has a big, scenario or a big backup in terms of what is coming from his previous stints on the global front. what is the main mandate that's going to be? One, obviously, crew issues, resolve that. Reliability is something that everyone requires, as well as balancing that low-cost model, low-cost carrier. That's the format here. So how is he going to be balancing that? That will be key to watch out for. And the recent cost headwinds will be his key mandate to adjust or handle all of that, will be the key issues that everyone will keep an eye out on.
Right. Thanks a lot for that. Vinny, let's talk about Indigo itself. Mayuresh, the stock had seen much higher levels ever since the December crisis. It's seen a correction. Then there was that leadership, resignation that came in. Afterwards, we had crude oil prices rise, travel disruption. Now we have a new leadership coming in as well. Some part of the street likes it. Some part of the street says that they would be happier if it was a local leader that joined and, ran the company. What are your thoughts on Interglobe Aviation as an investable idea now with this new change that has come about?
I think we'll still wait. I think two broad reasons. One, I think all the positives have played out on the stock. I think the expectations in terms of all the regulatory concerns have largely been gestated in the price. The leadership change will get accepted at some point of time. So I don't see leadership to be a big issue for the stock. Again, the price hikes which have happened but not completely passed through to airlines because that becomes extremely critical as 45% of input costs, the ATF prices become their input costs. And therefore, any substantial rise would have been a hit on their EBIT or EBITDA margins as we see it. However, in our opinion, I think how the crude situation lasts over the next few months is going to be extremely critical because you are entering a very busy summer season. Which is expected to be one of the best seasons for aviation companies. And if the Middle East crisis does not resolve itself, we're probably going to see some element of intermittent disruptions playing onto aviation and airline stocks. The second assumption, obviously, is that if crude prices remain higher, because again, production is going to take some element of time. And even if they come down with de-escalation expected to come through, I think does that significantly change the outlook in terms of new fleet additions, which are still going to take time, not just for Interglobe, but for the industry as a whole. I think it might not create a significant impact in terms of accelerated numbers, at least for the next few quarters. And therefore, our sense is that it's better to wait and watch how macros and micros both evolve for the aviation industry and Interglobe in particular.
We'll keep an eye out on how the micros and the macros evolve for both Indigo and the entire aviation sector as well. But the one pocket that did well today, though, was the defense space. And almost every single defense name was surging in today's session, be it the shipbuilders, be it BEL, be it HAL. And this is despite some not so convincing business updates. Ria is here with more on that. Ria.
Well, yes, Thomas, the defense pack was definitely surging in trade today. Let's start off with the provisional update for BEL. The revenue came in at roughly 26,750 crores, which was up more than 16% on a year-on-year basis versus the guidance of 15% revenue growth. The order book of the company also stands quite strong at 74,000 crores, and the order inflow for the year is at 30,000 crores versus the company's guidance of 27,000 crores. So the order inflow has been well above the guidance of the company, and this along with the order that BEL had announced yesterday of nearly 7,000 crores, that has led to the big gain in today's stock. Apart from this, HAL has also come out with its provision for FY26, but the numbers have been quite weak on the revenue front. Revenue has come in at roughly 32,250 crores, which is up just 4% on a year-on-year basis compared to the company's guidance of 8 to 10% revenue growth. The order book, however, stands strong at 2.54 lakh crores for the company, which is in line with the guidance that the company had given. Garden Reach as well has come out with its provisional update, and they have also missed their revenue growth targets. The revenue has increased by roughly 26% compared to the previous year versus the company's guidance of 40% revenue growth. And there has been no update on the order book yet, but the company had said that they are targeting an order book of around 50,000 crores at the end of the financial year, hinging on the next-gen corporate order, but there have been no updates on this front yet.
All right, Ria, thanks a lot for that. So that's about Garden Reach Shipbuilders and Bharat Electronics. Let's talk about Avenue Supermarts. That stock as well did extremely well in today's trading session. It saw its biggest single-day jump since 2020. The stock was up nearly 7, closer to 8%, and that's largely because the pace at which they have been expanding stores is something that the street really likes. 3 trading sessions and 3 disclosures coming to the exchanges. They've opened 20 stores in the last 3 days, and that's more than a lot of the quarterly openings as well. In fact, the fourth quarter store additions stands at 58, which is the fastest that we've seen in the history of DMart. And with that, they've reached 500 stores as a milestone. This entire year, they've opened 85 stores, which has been one of the highest, in fact, the highest year in which they've opened the number of stores. So all these factors working well for the stock, along with the correction that we've seen in the stock price and prospects of better growth. But, you know, beyond all of this, there's an interesting story that I want to tell you, Hormuz. You know, this store was actually inaugurated by Neville Noronha, who was basically, he was at his last day yesterday at DMart. He joined the company when it was 5 stores. And then the 50th store, the owners asked him to get his parents to inaugurate that. So his parents inaugurated the 50th store. And last working day, he opens the 500th store with his wife. So some scripts, you know, humans can't write. They are written from up above. That's about DMart. But let's go back to Mayuresh and Shrikant. Shrikant, DMart has been fairly, resilient in the wake of this skirmish that we've seen between Iran and the US. DMart actually as a stock was an outperformer and today gained about 8% as well. From a chart check standpoint, how do you like this?
So for DMart, what I can say is that it has been consolidating since 2021. And whenever there is a fall, there was fall in the stock. We saw 3,500 acted as major support for it, and 5,000, 5,500 acted as major resistance. But while looking at its time-based correction, I think the stock has completed its time-based correction, and now the price retracement is more likely in the near future. So from here, the stock can move towards the levels of maybe 5,000 or 5,500. That's the overall view. And downside looks quite limited. So in case if there is any correction, it will be an opportunity for look for adding this particular stock with a long-term view. But even at this level also, the risk-reward ratio is quite favorable for investing at current levels and holding for at least next 3 to 6 months. So certainly it's a buy at current level.
Mayuresh, do you agree to that? The correction from the highs, is the risk reward attractive now, even though it is still trading close to 100 PE?
Valuations are very expensive, so anybody holding can hold on, Hormuz. I think what Mangalam was trying to put forth is absolutely valid. The business model remains very, very resilient, and we all know the sourcing model of DMart and then their inherent strength in that, which gives them that better ability in terms of reporting not just a better sales per square feet, but a better operating metric of EBITDA per square feet. The business mix is nicely laid out as well in terms of apparels as well as groceries. And therefore, I think the new store openings that are expected to come through will incrementally add to volumes and numbers going forward. Valuations has always been a sticky issue. It's always that kal aaj aur kal wali story. Jab valuations महंगे थे, महंगे रहेंगे और महंगे रहेंगे.
That's some dialogue that you've given us here. Take that point. Speaking about this kal aaj aur kal, what are your thoughts on Trent, Mayuresh?
I think it's a decent story, Mangalam. And again, I think the store expansions that are probably happening in terms of Zudio, I think, which obviously has been, as you point out, Mangalam, the Zudioization of Trent. I think that will very well continue. Westside obviously has its own inherent strength in terms of the brands that they operate out of. And therefore, I think the expectations in terms of volumes coming back, specifically in terms of the domestic consumption story, will remain strong. And therefore, anybody holding Trent should continue.
From 8,500 to 3,500, that's the kal aaj. We'll see where the kal goes for Trent as well. But Mayuresh and Shrikant, thank you for sparing time and joining us today on the show. Take a short break, bring you the top corporate voices and some key events to watch on the other side.
Welcome back. You're watching us here on Markets Forward. We prep you up for trade tomorrow while telling you about what took place today. A lot of the corporate voices that joined us today, Sammaan Capital, they're estimating a 200 basis points reduction in its cost of funds over the next 6 to 12 months. Speaking to CNBC TV18, the company's management, Gagan Banga, actually said that the capital adequacy of the company is expected to remain around this 20% mark, with credit costs projected at 150 basis points by FY29, 1.3 lakh crore in their AUM target, with 18 to 20% ROEs. So that was one of the stocks of the day.
And Rajratan Global Wires also said that MSMEs are being hit by energy shortages and higher input costs with disruptions across the entire supply chain due to the West Asia war. Speaking to CNBC TV18, the company's management added that Gujarat has seen a sharp LNG supply cut, leaving companies to either switch to alternatives or pay 2 to 3 times more.
And then we had Piramal Finance, which said that it will closely watch July and August quarter to assess whether asset quality holds up for the industry or not. In fact, they also added that NPAs are likely to rise around that August level. In fact, the management who joined us here on CNBC TV18 noted that credit growth did pick up sharply in the last 10 weeks of FY26, but they see no material impact on unsecured lending so far due to the West Asia war.
And before we wrap, we bring you the key events to watch for the next day. Ria is here with all of that. Ria.
Well, first up, in the US, we will watch out for the initial jobless claims as well as the balance of trade data. But the most important event to watch out for will be President Trump's speech. He will be delivering an address to the nation to provide an important update on the ongoing war in Iran. But back in India, we will be watching out for the PMI data as well as the conclusion of the parliament budget session. And lastly, in other events, the NATO foreign ministers meeting will also be closely tracked.
All right, Ria, thanks a lot for that. Those are a bunch of events that we will be tracking along with all the updates on the war front. But you stay tuned to CNBC TV18. We take your leave on this edition of Markets Forward with more news and updates promised on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan and these are the headlines that we're tracking for you this evening. US President Trump claims the war with Iran could be over in 2 or 3 weeks, signals military action could end without a deal on Hormuz and tells other nations to go get your own oil. Iran's foreign minister says trust level is at zero and insists no negotiations are taking place, adds Iran is not afraid of a potential US ground invasion. Crude oil prices decline after President Trump signals willingness to exit the Iran conflict within weeks, but Brent crude continues to hover above the $100 mark as Iran targets an oil tanker in Qatar and fuel depots in Kuwait. Jet fuel prices in India more than doubles to a record high after a surge in global prices, but government shields domestic routes with a smaller hike of 25%. Sources say airlines and oil marketing companies are working to impose a cap on refining margins to combat the volatility. The price of commercial LPG cylinders rise by over 10% across major cities. Government says oil marketing companies are currently incurring an under-recovery of 380 rupees per cylinder, pegs cumulative LPG losses for oil marketing companies to cross over 40,000 crore rupees by the end of May. Sensex and Nifty regain more lost ground. Nifty moves closer to 22,700 mark. Broader markets outperform. Warren Buffett says he bought U.S. government bonds worth $17 billion in 1 week, adds he will buy stocks only on a big decline, also warns the banking system is fragile and calls for action from the U.S. Fed. That's a CNBC exclusive. Oracle announces 30,000 layoffs across the world as it invests heavily on artificial intelligence. 12,000 employees sacked in India through an email at 6 in the morning. Oracle is also planning another round of mass layoffs within a month. Finance Ministry clears an allocation of 1 lakh crore rupees for the second phase of the semiconductor mission as per sources. Proposal likely to come up for cabinet approval this month. The second phase of the program is likely to provide incentives for local design and advanced chips. ChatGPT maker OpenAI completes the largest funding round in Silicon Valley's history, raising $122 billion. The deal values the company at $852 billion, ahead of a blockbuster IPO expected by the end of this year. Those were the headlines that we're tracking for you this evening. But first up, all of the market action. The Lal Street snapped its 2-day losing streak, but ended off the highs of the day. Sensex and Nifty rose over 1.5%. Nifty gained nearly 350 points, while Sensex clocked gains of nearly 1,200 points. The broader markets outperformed the blue chips. The Nifty Bank soared over 2%. Defense, PSU banks and metal stocks batted for the bulls. Prashant Nair is here to decode the day on the Lal Street. Prashant, it was clearly a green day for the markets.
A good session, but could have been better because the Nifty by close had sold off about 250 odd points from the day's high, and so was the case with most other indices, sectoral and otherwise as well. News flow over the last 24 hours or so, and yesterday, of course, was a market holiday here, but global markets were trading, and the news cycle never stops. And news flow has been one of pointing to directionally de-escalation. President Trump saying that he is ready to leave and wind down the operation in Iran, to a question regarding the Wall Street Journal report, which essentially said that opening the Strait of Hormuz is not a precondition for the U.S. to actually wind down the operation. President Trump essentially answering that question in the affirmative, that yes, that is indeed true. So, I mean, that's what the market dealt with this morning. Oil prices lower, U.S. equity indices having the best one-day session on the S&P, on the NASDAQ, etc., since the May of 2025. Yields down. I mean, the U.S. 10-year is down about 20 basis points from the highs on last Friday. So things looking much better. And we started on the front foot, played on the front foot through the course of the day, but there was some profit booking which happened nevertheless. The India week cooled off about 10% or so. Defense as a space was the top performing index, about 5.5% gains. Capital markets was up about 4.5%. And you had the PSU Bank index, which was up about 3.7% as well. I'll come to the Nifty stocks. Trent, Indigo, Adani Ports, Adani Enterprises, BEL and State Bank of India were the top gainers, anything between 3.5 to 6.5, 7%. in terms of what we saw. On the downside, Dr. Reddy's was down 3, HDFC Life was down 3, Cipla, NTPC and Sun Pharma were some of the other names which actually were down and out. This is, of course, just the Nifty part of things. Market breadth was pretty positive. Actually, I mean, almost, 10:1, 11:1 in favor of what was up. Garden Reach, Mazgaon Dock, Cochin Shipyard, the shipping defense company is doing very well. RPG Ventures, another 17% on top of what is already done. JBM Auto, a big gain. Other defense names like BDL, that is Bharat Dynamics, HAL, Bharat Electronics, all doing very well today. You had HPL Engine, Wockhardt Pharma, Nippon India, Deepak Fertilizer, Mastech, Yatharth Hospitals. Actually, a pretty long list of solid volume-led gainers is what you had in terms of the broader space. Hyundai was a top loser on the other side, which was down 3%. HDFC Life, I think I mentioned this earlier, but Acuitas Finance was down 10%. Lockdown, Voltas has been an underperformer last 1 month, down 2%. And there were a few other names as well. But as I said, almost 11:1 in favor of advances. Tomorrow morning, of course, President Trump is going to make a speech. That's going to be 6:30 a.m. our time. And we'll have headlines out of it. Him perhaps confirming that he's indeed looking at getting out of Iran, which should be helpful. But you never know. It's a bit of a binary event, which markets will be glued on to. Back to you.
All right, Prashant, many thanks for taking us through those details. Now, the top story this evening, the war in West Asia has entered day 33. President Trump is signaling the war could end within weeks, but missile and drone attacks continue unabated. Here are the key developments. U.S. President Donald Trump says the war could end in 2 to 3 weeks and that Iran would not have to make a deal for him to end the war. The president is scheduled to address the nation later tonight, which will be 6:30 a.m. tomorrow morning in India. Speaking to reporters at the White House, the president also said that U.S. will not have anything to do with what happens in the Strait of Hormuz. Trump said nations who need the Strait of Hormuz must keep it open effectively, saying, and I quote, "Go get your own oil," end of quote. Meanwhile, the prices of crude oil declined but remains above $100 a barrel. Oil prices have rallied over 60% last month. On the other hand, Iranian officials say Strait of Hormuz remains closed to enemy ships and not to others. Countries like India, Pakistan, China and Malaysia have seen some of their ships pass through the strait, even as hundreds of ships still remain stranded. Oil tankers in the Gulf region continue to see Iranian drone attacks. A Kuwait crude oil tanker at the Dubai port caught fire due to the drone attack overnight. Separately, a Qatari fuel oil tanker was also hit with a missile attack in the early morning hours of today. No casualties have been reported on both incidents. Missile attacks by Iran and militant group Houthis also struck several parts of central Israel. The Israeli military has said that it intercepted the attacks. However, 25 people have been injured across 20 sites in the country due to missile debris. The Houthis have said that attacks will escalate in southern Israel against Tel Aviv's aggression in the region. The Iranian Revolutionary Guards have also warned American tech giants like Apple, Google, IBM, Intel and Microsoft, among others, of attacks across their offices in the region. It has warned that U.S. firms to evacuate and urged civilians in the region to stay away from the office buildings. Explosions continue to rock the Lebanese capital of Beirut as well. Israel claimed that it has eliminated IRGC's key force officials, Mahdi Wafai, who was head of engineering for the Lebanon Corps in the military arm. Israel's strikes in Lebanon has killed 1,200 people and displaced 1.2 million. Iranian Foreign Minister Abbas Araghchi has confirmed that U.S. and Iran have exchanged messages either directly or through other countries. In an interview to Al Jazeera, Araghchi also said that contacts with the U.S. did not mean Tehran was in negotiations with Washington. This, as the Iranian leader also posted a video on his social media marking celebrations of the Islamic Republic Day yesterday on the streets of Tehran.
Within 2 weeks, maybe 3. We're negotiating with them right now. They've been, again, we have had regime change. Now, regime change was not one of the things I had as a goal. I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job. But we want to knock out every single thing they have. Now, it's possible that we'll make a deal before that because we'll hit bridges, and we've hit some. We'll hit some bridges. We've got a couple of nice bridges in mind. But If they come to the table, that'll be good. Iran doesn't have to make a deal. No. Yeah, I've spoken to a lot of people. It's a new regime. They are much more accessible. They are right. You know, they said, we have a present for you.
The conflict in the Middle East has now entered a second month. And while we're working at pace for de-escalation and peace, it is now clear that the impact of this war will affect the future of our country. So today I want to reassure the British people that no matter how fierce this storm, we are well placed to weather it.
The cost of jet fuel has more than doubled in India, mirroring the surge in global prices since the start of the war. However, the government has moved to shield domestic routes by limiting the increase to 25%. There was widespread confusion in the morning on the quantum of the hike, with Indian Oil Corporation issuing 3 notifications in 3 hours. Sudarshan Kumar is here to explain all of those details. Sudarshan?
So it was interesting last few hours in the morning. When we came in the morning, we got a shocking news of 115% increase in the ATF price from the last price that we had in the month of March of 96,600 rupees per kiloliter. And from there, it was increased to rupees 2.07 lakh. But within few hours, we got a clarification from IOC that that increase is not for our domestic flights or say domestic airlines. And following that, around 9:40 a.m., company has put out the new price, and that was 1.04 lakh. So that tells you the increase of 8.5%, not 150% that company had announced early in the morning. And following that, we also had clarification coming in from both Aviation Minister as well as Oil Ministry, saying that despite the sharp increase in the international crude price or ATF price, we have made sure that it's not passed on to the customers. And domestic ATF was expected to be increased by more than 100% in the month of April, but they have increased, and this is Oil Ministry's statement, that they have done a staggered increase, or OMCs have passed on a staggered increase of 25%, or say rupees 15 per litre. But what is the reason behind this, or where exactly this math of 25% come? So now sources say that as of March 31, ATF price in Delhi was rupees 85 per litre, which has been increased to rupees 104 per litre. And if you do the calculation, that increase comes in the range of 22 to 25%. And in the rupees, it comes around 15 to 17 rupees per litre. Now, what's the impact on Indigo? So total ATF forms around 40% of total cost for Indigo. And now this 8.5% increase is much below what analysts were expecting. They were expecting an increase in the range of 50 to 100%, and because of that, you have seen a sharp uptick in the stock price. At one point, the stock was up as much as 10%.
All right, Sudarshan, many thanks for those details. But we also learned from sources that the airlines and oil marketing companies are now in talks to cap refining margins. This is in a bid to manage extreme volatility in fuel costs. Shivani Bazaz is here with those details. Shivani, what are you picking up?
Well, absolutely. Jet fuel prices remain elevated, although oil companies have partially shielded domestic airlines from the full global surge. Now, the focus is now on what comes next. Sources tell CNBC TV18 that the government is actively weighing multiple options to cool ATF prices, with VAT cuts and capping crack spreads emerging as key levers. Crack spread, which is the refining margin on jet fuel, has surged sharply from typical levels of $15 to $30 per barrel to over $70 per barrel. Now, airlines and oil companies are now working on a proposal to cap this between $10 to $22 per barrel to bring prices closer to historical norms. At the same time, the centre may engage with the states to reduce VAT on ATF, a major cost component for airlines. The broader aim is to ease cost pressures, stabilize fares and support airline profitability even as global fuel prices remain volatile. Back to you.
Right, Shivani, many thanks for those details. Now, the price of commercial LPG cylinders rise by over 10% across major cities. The government says oil marketing companies are currently incurring an under-recovery of 380 rupees per cylinder. The centre has estimated that cumulative LPG losses for oil marketing companies will cross over 40,000 crore rupees by the end of May. Indigo shares soared in trade after the airline named William Walsh as its new CEO. Walsh, who is currently Director General of the International Air Transport Association, has previously led British Airways and the International Airlines Group. He is expected to join Indigo on the 3rd of August after completing his tenure at IATA on the 31st of July. Airline promoter and MD Rahul Bhatia had assumed charge as CEO after Peter Elbers's resignation last month. Goods and services tax collections rose to a 10-month high of 2 lakh crore rupees in March. That's 8.8% higher than the same month last year. Gross domestic revenue rose 5.9% year-on-year, while revenue from imports rose 17.8%. The gross GST revenue for FY26 also rose 8.3%. The Central Board of Direct Taxes has stated that income from transfer of investments made before April 1st, 2017 will not be covered under general anti-avoidance rules. In a notification, the CBDT amended Rule 128 of the Income Tax Rules 2026, effectively protecting gains from the legacy investments. The updated rules clarify that the provisions will apply only to arrangements that generate tax benefits on or after that date. The move investors. The government has cancelled the auction of 11 critical mineral blocks which were put on sale in the 6th round. 5 blocks had to be scrapped after no bids were received at all, while another 5 were cancelled due to an insufficient number of technically eligible participants. The Mines Ministry launched the 6th tranche of auction for 23 critical mineral blocks spread across 13 states last year. The Finance Ministry has cleared an allocation of 1 lakh crore rupees for the second phase of the semiconductor mission. Sources tell CNBC TV 18 that the proposal is likely to come up for cabinet approval this month. Ashmit Kumar joins us now with all of those details. Ashmit?
Well, semicon continues to be top of the mind among the key thrust areas of the government. We've seen announcements of continued support coming in from the Prime Minister, from the IT Minister, Mr. Ashwini Vaishnav. And in the same spirit, we're given to understand that the progress is firmly afoot as far as ISM 2.0 is concerned. The latest that we're picking up is that the Finance Ministry has cleared the budget for ISM 2.0. As to what that budget is, well, sources tell us is that there could be an allocation of over 1 lakh crore rupees that has now received the nod from the Finance Ministry. And just to put things in context, this is substantially higher than the allocation under Phase 1, which was 76,000 crore rupees. Bear in mind, under Phase 1 itself, we've seen 10 projects being approved with a cumulative investment of over 1.6 lakh crore rupees. And 2 of those 10 projects have already gone online with commercial production. So the government keen on continuing its momentum as far as semicon is concerned. We're given to understand as far as the structure is concerned, there will be a heightened focus on design, R&D, innovation locally here in the country. That will be one of the key features. There will also be a clear push towards high-end cutting-edge chips, 3 nanometers, 2 nanometers, also likely to receive support under the ISM 2.0. And as far as the way forward is concerned, what we're hearing is that after the Finance Ministry nod, this file will now travel all the way to the Cabinet. We heard Cabinet note is being prepared as we speak, and that will likely come. Cabinet is likely to consider before the end of this month. So clearly, things are firmly afoot as far as ISM 2.0 is concerned.
All right, Ashmit, many thanks for those details. But on that note, it is time for us to head into a short break. But coming up, Oracle announces 30,000 layoffs across the world as it invests heavily on artificial intelligence. 12,000 employees sacked in India. More details when we come back. Stay tuned. Welcome back. You're still with us on Business 360. OpenAI has closed a record-breaking funding round at a post-money valuation of $852 billion. The round saw total commitments of $122 billion, up from the $110 billion announced earlier. This is the largest fundraise in the history of Silicon Valley. SoftBank led the round with other investors like Andreessen Horowitz and D.E. Shaw Ventures. This comes ahead of a blockbuster IPO, which is likely later this year. Oracle has laid off around 12,000 employees in India, with more job cuts expected in the coming weeks. These layoffs are part of a larger global restructuring that could impact nearly 30,000 roles as the company invests heavily on artificial intelligence. Rachna Dhanrajani joins us now with all of those details. Rachna, a massive cut to the workforce at Oracle, right?
That is absolutely correct. This is one of the most aggressive workforce cuts in Oracle's history, and it comes at a time when the company is by most metrics performing strongly. Between 20 to 30,000 jobs are being cut globally. That's nearly 18% of its total workforce. Employees across geographies received early morning termination emails, often without warning, and lost system access within hours. In India, too, the employees began receiving layoff emails as early as 6 in the morning. The company has not confirmed an official number, but in a statement to PTI, Oracle said it continues to adjust its workforce to align with its cloud and AI priorities, and described the changes as part of its ongoing business transformation. And that means more layoffs are expected to start this month. But this is not a story of slowing demand. In the previous quarter, Oracle reported revenue of $17.2 billion, and it was up 22% year-on-year. Net income saw a jump of 23%. Cloud revenue surged 44%, driven by demand for AI infrastructure. So the stress point lies elsewhere. The company has sharply increased capital expenditure to around $50 billion for the year as it builds data centers and scales its AI capabilities. That spending has pushed free cash flow deep into the red and taken debt levels higher. So the layoffs are not about weak performance leading to layoffs, but they're about a funding transition and reallocation of capital. Now, analysts estimate that cuts could free up as much as $8 to $10 billion, capital that Oracle needs now to stay competitive in the AI race. And unfortunately, this comes at a cost of human capital.
Absolutely. Thank you so much for those details, Rachna. But moving on, months after handing the CEO baton to Greg Abel, Warren Buffett has said that he still comes into the office daily and makes investment decisions at Berkshire Hathaway. In an exclusive conversation with CNBC, Buffett revealed that Berkshire bought US government bonds worth $17 billion in 1 week. He said that Berkshire will buy stocks on a big decline. Buffett dismissed concerns over the recent market volatility as historically mild. However, he warned the banking system is fragile and called for action from the US Federal Reserve. Take a look.
I don't know the exact number, but it's not much different than before. So, it's probably north of $350 billion in cash and treasury bills.
Yeah. So
we bought $17 billion this week.
$17 billion of T-bills?
The T-bills.
Berkshire's the largest owner of T-bills?
I think we're probably the largest bidder. The banking system is, in some senses, very strong, in other senses, very fragile. I mean, J.P. Morgan, in the last couple of annual reports, reported doing $10 trillion of business per day. Now, that's an unsecured policy. Now, they know what they're doing, believe me. I mean, there's nobody smarter than J.P. But I didn't want during the 2008 period, I didn't want anything unsecured, out there for a day. I mean, who knew? Nobody was any good. I mean, the world is very interconnected, and everybody panics.
But is it the banking system we should be concerned about right now, or is it the shadow banking system, the private credit at this point?
It's all parts of the banking system because they all affect each other, and the troubles from one can spread over to another, and well, you saw what happened. I mean, in 2008.
But at risk of potentially, I don't want people to say that you are commenting on what's happening in the private credit situation right now. What do you think of the private credit situation right now? Are there enough concerning issues there that you worry that it could cause a contagion in the banking system?
I don't think I know.
Okay.
I do not think I know what, but therefore I want to be prepared for anything. And therefore we will always have cash around. And we'll have treasury bills. We won't have money market funds. We didn't have them in 2008. We won't have commercial paper in 2008. There's just one thing that's legal tender.
But just to put a fine point on it, you don't think you know what's happening out there. You've had this huge cash hoard north of $350 billion. It's just there waiting for any time. It's not that you necessarily think that there's something on the horizon. It's just the longer time goes.
Sure. No, I always want to have cash, and I never want to buy anything just because people think the market is going up.
And with that, it is a wrap on this edition of Business 360. More news and updates coming up right here on CNBC TV 18.
Let's talk money.
Hello and welcome to Let's Talk Money. The celebrations continue here on the show because we have turned 100 episodes old. This one actually is the 101st episode, and we've been in conversation with some of our all-time friends who have helped both you and me learn personal finances better, learn investing better, and put us firmly on the path to long-term financial stability and wealth creation. So let me reintroduce our panel of experts. We have, of course, Feroz Aziz from Anand Rathi. We have Mr. A. Balasubramaniam from Aditya Birla Sun Life Mutual Fund and Mr. D.P. Singh from SBI Mutual Fund. So now, gentlemen, I just want to recap for viewers that in the last, episode, we spoke about how far we've come, the mistakes that we need to really avoid. And those mistakes, just to recap, is that we need to make sure we don't stop our SIPs when the markets are volatile. Don't make that mistake. Don't try and time the market with the SIP as an instrument. Top up those SIPs as our investment levels or our income levels are increasing. And Feroz gave a very important point. Do not chase the complex. By chasing the complex, you do not make money. That's not how the correlation works. Sometimes the simplest investments in a steady fashion with great asset allocation can give the best rewards. And Mr. D.P. Singh gave us another very, very important pointer that chasing the best performing mutual fund and churning your portfolio every 1-2 years will definitely not make you rich. In fact, if anything, it will take away from that pot of gold that you're hoping to create at the end of 10, 15 or 20 years. So keep those mistakes in mind and take a vow that we will not repeat them again. With that, let's move to the next level of the conversation. That is now wealth creation, no matter what. Wealth creation, even as a war has been raging on in the Middle East. So I want to come to a bit of the here and now in the market, gentlemen, because for a lot of investors, I think this is the first. Investors have seen, things like COVID, but COVID was a V-shaped recovery for the market. People have seen the Ukraine war, but again, it didn't last that long. The impact was not so direct on India. Oil prices were range-bound elevated and they cooled off. But this one feels very close home because of the macroeconomic implications. So DP sir, as you look at things right now, should investors be prepared for a prolonged bad patch? Because anyway, India underperformed on the equity side. And now we have a war.
No, I'll look at the things in a different manner. Fortunately for us, we have not been able to add too many new investors into the market in the last 3 to 5 years. If I look at the number of investors who have been added, it's hardly, but it's much below this thing. So people are there for 3 years, 5 years, 2 years, 1 year. And I was going through in spite of the wage, war getting into the 5th, 6th week. Even now, when I look at the returns, yes, 1 year looks very bad. Very bad in the sense, little negative or 2% or 1% return, but 3-year returns are still in the range of 10%, 12%, 15%. So people have not lost money. I think this is the time for us now. One, whosoever has been putting money, they have to increase their inputs into the funds, and this is the time we have to go whole hog to get new set of investors, so that they start from where the people started 3 years ago. So that's the kind of the thing I feel it should happen. And yes, the number of investors today we have got almost 100 million SIPs. Can we make it 200 million? There are 6 crores investors, 5.5 to 6 crore investors. Can we make it at least 10 crores? So that is the case, because that will not only stabilize the market, that will give us a lot of inflows to put in money at the right kind of values. And we should not wait FIIs that they will come and they will take the market. So we should not.
We're enough for ourselves, right? And at least we've seen that happen thanks to mutual funds and that steady money. At least the market managed to hold its ground in 2025. But Bala sir, the problem is that when you look at India's returns versus the rest of the world, that comparison is really looking stark. And I'm not only talking about the last 1 year, where of course India has underperformed. Even if you see 5-year returns, there are markets like South Korea and Japan. Some of them have outperformed. The Nifty is up about 60%. We'll put that graphic up on the screen. Some of these other markets have done better. The Nasdaq has done slightly better because of the IT tilt.
Correct.
So that is making now people ask fundamental questions that, should I be investing in other assets? Should I be investing in global equities? Is there a fundamental need to shift my equity portfolio away from being a India-only portfolio? Your thoughts?
Yeah, I think one must remember, market is bound by the volatility. The risk will come from anywhere, which we'll never know before the risk comes and hit the market. What has come in the last 1 month, I don't think anybody in the world would have expected the world war will come, therefore these kind of market volatility will come. Therefore, it's a reminder for everyone, bullishness is never permanent, nor the bearishness is permanent. So that's one. It's also very important to see the volatility. For all the new investors that have come in the last, say, 2-3 years, they've now seen the volatility. I think after COVID, nobody has seen the volatility. So therefore, it's also something one must remember when you're investing in equity market. There is a risk associated with that, which is always permanent. I think what is most important is actually, it also market every 2 years, it forms a new high. It also forms a new higher low compared to the previous 3 years. That's historically, if you draw a chart, you will find this is a permanent fixer.
True.
So therefore, if you have to believe in long-term wealth creation, and the Indian equity market is the only one which can actually grow about 11 to 12% kind of nominal GDP growth if you are able to grow, and the compounding effect is very high. Also, we must remember, I think we talk about today, we take pride about Korea and China and other markets doing better than India. The same market, it was 2 years back, if you have to just cycle back and 2 years back. India was one of the best performing market. China was performing market.
True.
Korea was the worst performing market. Japan went through almost 20 years of recession period.
Nothing was happening.
So
in that
nothing was
market.
happening for 20 years. Just in a matter of say 2 years, actually
Now
the
it's
company
shot up.
compensated for the
Yeah.
all the 20 years of waiting. That's the beauty of equity.
Yeah.
Therefore, you should never try to actually predict that what will happen in the short term or maybe even the medium term when we have already as a country moving towards making India as one of the best countries in the world. Therefore, we must have the leap of faith and while making investment
in the equity market.
The equity market. At the same time, remember the one acceleration what you mentioned about it. And second, remember this volatility is a period through which if you live through, the best return always comes only if you live through the whole volatility. Therefore, living through the volatility I think is more important. Rather than predicting the market.
Take your point. We have to stay invested and we have to have investments in India. No denying that. But Feroz, now, and I know you have an anecdote, right? Because we talk about the previous market crashes. There's a global financial crisis, there's COVID, in between some of the other meltdown, political crash here and there. Is this a different scenario playing out or will it be the same? You put money now, eventually you'll be rewarded.
So I think when you're in the eye of the storm, every instance looked different. COVID, of course, looked very different. Ukraine war again looked different. That's one thing which is, there is a commonality and there is also a difference. That's the subtle point I'm trying to make. But what we can as humans is look at data. There are two ways to look data in this situation. One is war instances or any instances greater than 20-25% falls, what has happened. So if you do these two analysis, there are 12 wars which we listed down.
Okay.
And then we did a simple study.
Okay.
On the day the war broke out, what was Nifty level?
Okay.
On the day when ceasefire and the war was settled, what was the Nifty level?
Okay.
And how many times after the war actually settles, does the Nifty overtake its level and come back and more? In 11 out of the 12 instances, Nifty re-established that level and went 10% higher than that level.
Okay.
Now, if there is one instance where it was -7%, even after the war ended.
I wonder which war was this?
Yeah, I'll tell you. It was actually the Ukraine war because it didn't end permanently. It just languished.
Yeah, it's still on. Correct.
It's still on in technical sense.
Okay.
Now, look at another instance. Now, to wrap that up, Nifty was 25,178 on the weekend when the war broke out on 27th of February. Now, what would be interesting to see is if the war, it has to get over someday, right? War can't last for more than 1 year, 6 months, at least this kind of war. So will the Nifty overtake that? In my judgment, yes, there is a reasonable probability, at least data says. Then we looked at the worst falls. And there were about 11 instances where Nifty has fallen more than 25%. And what was the next 3-year return? After the fall, it was 19.38% compounded. That is provided somebody actually got the rock bottom. It's not going to happen, right? You would get half that, you still make double-digit return on Nifty over the next 3-year period, even if you bought it at the eye of the storm before the market actually completely corrected.
Feroz always has so much of data, statistics. He's a statistics man out and out. Always looks at data and then decides the way forward. So very interesting anecdote over there. We're going to take a quick break. After the break, I have a bit of a rapid fire coming up for 3 of you gentlemen, and they have no idea what the questions are. And I have some rules in the rapid fire as well. So we'll be back with this very interesting one after the break.
Let's talk money. Let's talk money.
Welcome back. Here with this special edition of Let's Talk Money. We're celebrating 100 episodes, and I have a rapid fire now coming up with our guests. But there are some rules to this rapid fire. First of all, of course, it's rapid, so you have to answer very quickly. Secondly, some of these questions pertain to fresh money, your personal money if you were investing now. And my third rule is you can't choose both. If there's an option to pick one, you can't say both. Because I know these gentlemen, they'll say both. So let me try my luck. So let's get started. Okay, DP sir, I'll open with you. Fresh money that you have to invest in right now, gold or equity?
Equity.
Bala sir?
Equity.
Feroz's answer always equity.
100% equity.
Okay, let's do the next one. Fresh money investments, Indian equity or global equity?
Indian equity.
Indian equity.
And Feroz?
Clearly, borrow and invest in Indian equity.
Only India. Okay, full Indian bulls out there. MAF, the multi-asset allocation fund, or a BAF, which is a balanced advantage fund. Which one for you, DP sir?
MAF.
And why so?
Because see, precious metals, tactical money can be put in for a short period, and whenever we feel there's a chance to make money, it can make.
So
money.
MAF gets your thumbs up. And Bala sir?
Balanced advantage fund.
Balanced advantage fund.
Yeah, they will be the one to actually look at opportunity in the market and increase the equity exposure.
So now the balanced advantage funds would be buying more or increasing their equity exposure in the market, right?
Yeah,
so you hopefully get the benefit of the downside. Feroz, what about you? These two categories, BAF and MAF?
For HN, Ultra HN, neither.
Okay. For a
retail MAF.
MAF for retail. Okay, so the multi-asset allocation fund. Now this is a question, simple question. Would you invest in physical real estate? Sir?
No.
Why not?
Real estate is for usage only, because I don't have 20 years, 30 years to pay. What will happen, I don't know.
Okay.
I will not do that.
Bala sir?
Not as investment. The power of compounding is actually very weak in real estate when you compare with including fixed income investment as well.
But second home, holiday home and all that. In your hometown, I know you have a house in your hometown.
Agriculture land, of course, I have, because there the agriculture yield is actually better, it is like a dividend yield. But otherwise, real estate is not something which will give you a significant higher power of compounding. It doesn't actually get materialized when you compare when you have a choice to invest in equity for long term.
Okay. Yeah. And Feroz?
Consumption, yes.
Okay.
If it's a holiday home, it's not an investment. It's a consumption item.
Okay. Okay.
And residential real estate, if you love builders, please go ahead. 9.2% is the compounded return of 11,700 properties, compounded return from the date of registry.
So that's the return, 9% compounding.
11 years, 11.4 here holding period.
Hopefully equities will give better. These days equities are only giving 10% compounding. So
I'm just giving you data, not double digit. If people compound it and calculate it.
Okay. And finally, best investor or asset manager in your own house, in your family?
Myself.
Oh, very nice. Bala sir?
Yeah, myself only.
Oh, okay. Yeah. The bosses know how to manage the money. Feroz has to be Feroz, right?
No,
but okay, is there anyone who's beaten you in terms of having that knack? Family, friends, someone you really admire in terms of money management?
Yes, not in family, but yeah, my wife is a very good money manager.
Oh, okay.
Actually, she is. She tries to bring in some balance between both sides of the coin, risk and return.
Oh, okay.
Yeah. So I'd give that to my wife.
All right. So very interesting thoughts. Finally, we're coming down to final advice. And before we talk about the final investment rules that we really need to swear by, Feroz, remind us also of the personal finance 101 rules, because this is a conversation. See, investing is a part of your overall life journey, and if the overall goal in life is happiness, then personal finance and overall holistic planning is important, right? So what are those golden rules that we should not forget?
The golden rule is never take credit cards.
Okay.
That's one.
Okay.
Okay. Second, spending money doesn't make you poor. Spending money gives you the desire to earn.
Okay.
So if you want to spend money, spend it pragmatically, but that's what gives you the zeal. If without an aspiration, I want to do a holiday, global holiday, that gives you energy in your profession. In the initial part of life, you need to work in your profession twice as harder to get wealthy. People think paise aane ke baad main wealthy banunga. Because profession pe aap kaam karenge. So having goals, having spending patterns which are pragmatic, rational, gives you wings in your profession. So don't take a credit card. I've met the heads of credit cards of the banks. They say we make money out of your deferred payments only. HNIs are the worst credit cards owners. People lose money. Banks lose money on HNI credit cards.
Because they pay on time.
They pay on time.
Okay, all right, got that. But before we come down to the final rules of investing, I think we have some queries coming in from viewers. Let's try and squeeze in one or two. Viewers are the reason why we are here. So this is Naveen's question, and he's asking about SIFs, which is actually good because we didn't touch upon that in the conversation so far. He's saying, is the hybrid long-short fund a better option vis-a-vis, say, a traditional balanced advantage fund? Let me take that to Bala, sir, because you chose BAFs, as a route to balance out the risk in your portfolio. How will SIFs be, Bala, sir? And what can retail investors with little more risk appetite, what can they expect? SIFs will have to deliver better than mutual funds, right? Will they?
It's a product is yet to be tested in India, and most of the money managers are long-only investors, and they are good in bottom-up and top-down kind of investment approach. And that is being the case, a BAF would give over a period of time better experience than the SIF. At the same time, SIF is only for diversification purpose.
Okay.
So if somebody is actually already overexposed to actually the BAF or maybe even equity as an instrument, then for them actually trying a new instrument like SIF, I think is a better model to one can look at. It's more like a hedge fund. You try to optimize the return even a falling market and rising market by going long short and try and generate absolute return over and above the market. That is a primary objective of the SIF. But the product is yet to be tested.
Absolutely.
So therefore, it should come as part of your normal allocation that you can do after exposing yourself to
having an overall mutual fund portfolio, then you can add a little extra.
Is it for the first time investors? Absolutely no. The first time investors should always come and park themselves in BAF.
First with regular funds.
Experience, regular funds, and experience yourself of investing in equity for long term before jumping into the SIF as a product.
DB sir, I know that SBI has also launched the SIF, right? And most of the industry right now has started with the hybrid type of SIFs, not pure equity SIFs. What can an investor expect? What is the return, realistic expectation?
Yeah, I think this is very good investment option for the people who are diversifying, of course. See, now if you look at what has happened during the last 3-6 months, because this is the worst period which has happened, when the market is down by 10%, the range of plus minus is almost 2%. If I look at all the SIFs which have come, and at the worst for the last 1 or 3 months, it is negative by 1% to 3%. So that's, I think, is a very, very good way to do it. And there's a big niche in the market who want a static kind of return with the tax efficiency. And if they have a horizon of 2 years plus, then definitely this SIF long short hybrid, it makes very, very good sense for them. And see, people can definitely put a portion of that to that. But of course, it is just started. We have done only back testing for last 10-15 years, and we came out with the results. Yes, it makes money, but every time is different. We never thought that the market will go down by 10%. In 1 to 2 months, we had the earlier record. But I think it makes very, very good sense to portion.
You want to add anything on SIFs? Early thoughts? It's a new product. Any advice to investors before they, get in there?
Yeah, I'm very excited about SIF because when I came into the industry in 2004, I saw derivative. Anybody does not want to help other people with derivative. I had great derivative traders, and that's when I started learning derivatives because derivative for larger good didn't exist.
Of course.
This is the first
seen as an evil word.
It's an evil word, but so that's one. If you are looking for efficiency, there is not. There's a very, very strong case. Return upon risk, which is called efficiency ratio. I think SIF will do a great job.
Okay, so all right. So thumbs up, but watch the space carefully. Do your research analysis. Take the help of an investment advisor, and then decide if you want to be in SIFs. I think we have 2 quick queries. One query is on gold. What will gold do over the next 2 months? That's a tough one. I don't know if anyone on the panel or anyone at all can have the answer. That's one question. And I'll club it with the last question, which is coming in from Subhashish, who's asking about investing in a liquid fund. And I think this goes back to the need to be away from equity. The one thing that the last 18 months have taught us is asset allocation. A lot of investors were full up in on equity, and then they realized that the portfolio is underperforming. Now, Feroz, I'm going to ask you this because I know you're a big long-term, equity bull. I think last we spoke, you weren't advocating too much gold in the portfolio, but the queries are coming on gold, on liquid funds. Should I increase my fixed income exposure, etc.? What would you tell people right now who are looking for alternatives and maybe just tired of the equity market underperforming?
See, when I say I am an equity bull, a bull can be an English word, can be misrepresented or misinterpreted, not represented. When I say bull, I mean median return plus Nifty. 11% is the median return. Can it compound more than that? Can you create a strategy to make 13-14% when Nifty delivers 11? That's what I meant. So from today, for the next 3 years, you can mark me on this one, whether Nifty will deliver 11% compounded from here on a 2-year or a 3-year or a 4-year period. From here, if you measure it in 2028, 29, I think the odds are more than 90-95%. That's what I meant by bull. Now, gold has not behaved like gold. I've been highlighting in Manisha's show that it is a gamma squeeze trade. Okay, what that means, you have to AI and chat GPT it, you will get to know.
Gamma squeeze.
It's a short gamma squeeze. Now coming to, if you want gold, if you have debt money, you can move it to gold in a staggered fashion, not in a lump sum. Okay, so staggered fashion, if you have debt, you're better off loving gold than loving an FD. It'll repay it back.
But equity, right, or if you're allocating 100 rupees fresh, medium risk investor, at least a 2-3 year investment, how much of that 100 rupees goes to equity, how much to fixed income, how much to gold, if at all?
Correct. If you're a retail investor, 70 in equity,
okay,
15 in debt and 15 in gold. Gold has to be staggered.
Got that. Okay. Now, with that, we come to final thoughts and final advice to viewers in a very confusing market, in a challenging market. DP sir, what are the golden rules that will see us through this phase?
Don't compromise on the discipline. You have remain disciplined. And if possible, this is the time, as Feroz has also said, from here on up to 28, 29, we can expect good double-digit returns from here on. Please do whatever you can do, but don't take the money out of panic, for sure.
Okay, all right. And Bala sir?
I think have the leap of faith on the growth expectation that we have set as a country. And capital market is now getting expanded. More and more savings are coming in. I think market is becoming increasingly efficient. Therefore, looking at the future with a more optimistic approach and use the volatility as an opportunity to invest in for long term rather than using volatility to get taken out from the market.
Okay, use volatility as your friend to build long-term wealth rather than letting it kind of dissuade you from your investment journey. I think those are fantastic final words to wrap up on. Feroz, anything else you'd like to add?
Yeah. When times are bad is when you listen to Warren Buffett. He says when everyone else is fearful, be greedy, and vice versa. It's good to read it on books and say he's the greatest investor, but then following it is more important than just being appreciative of quotes.
This is the time when actions have to do the talking and not just words. All right, gentlemen, what a fantastic conversation. Thank you so much. It's been a masterclass all over again. And once again, a big thank you for being our friends through the decades and helping spread the word of financial awareness, financial literacy, and financial self-reliance. It all starts with you. So let's always keep talking money. Thank you for joining us on this special.
Let's talk money.
Hello and welcome to this special show on the West Asia war. I'm Ashmit Kumar. US President Donald Trump has claimed that the war with Iran could be over in about 2 to 3 weeks. He signaled military action could end without a deal on the Strait of Hormuz and also asked other nations, in his words, to go get your own oil. When CBS News questioned him about whether this meant US was pulling out forces from the fight, Trump said that at some point he will. Reports suggest that Secretary of State Marco Rubio omitted the Strait from his list of US war goals on Tuesday. Just hours before this, in a social media post, Trump threatened to blow up Iran's oil and electric infrastructure if Tehran did not unblock the Strait of Hormuz. Now, speaking to the press, President Trump also said that his goal was that Iran should not have any nuclear weapons, and according to him, that has already been achieved. Iran's Foreign Minister Abbas Araghchi has said that trust level is at zero and continues to insist that no negotiations are taking place with the United States. He added that Iran is not afraid of a potential US ground invasion. Meanwhile, crude oil prices have eased to $100 a barrel on hopes that the West Asia conflict will soon come to an end. But the oil trouble is far from over. International Energy Agency's Executive Director Fatih Birol has warned that oil loss in April is expected to be twice as high as in the month of March due to damage suffered by key energy infrastructure in West Asia. Speaking in a podcast with the Norges Bank Investment Management CEO Nikolai Tangen, Birol said that over 12 million barrels per day of oil supply has been lost so far. Before we discuss this further, let's listen in to what Donald Trump had to say.
Within 2 weeks, maybe 3. We're negotiating with them right now. They've been, again, we have had regime change. Now, regime change was not one of the things I had as a goal. I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job. But we want to knock out every single thing they have. Now, it's possible that we'll make a deal before that, because we'll hit bridges, and we've hit some. We'll hit some bridges. We've got a couple of nice bridges in mind. But if they come to the table, that'll be good.
Well, joining us now to discuss this further is with us Ambassador R. Gadam Dharmendra, a former Indian ambassador to Iran and a non-resident senior fellow of Carnegie, India, and Prabal Sen, energy analyst with ICICI Securities. Ambassador, let me come to you. We have Netanyahu of Israel very clearly saying that the campaign against Iran is far from over, indicating that this military campaign will continue. So, again, I circle back to the same question. Donald Trump may want to pull out, but that doesn't mean that it's over.
Quite true, because Netanyahu has been quite aggressive about this. Do keep in mind that he was the proponent of this from the outset. And how this will end, he will also have a say in this. But right now, in terms of two dimensions, one, the political, the costs for Trump are quite substantial, given that the US will be heading into midterms in November this year. So beginning of summer, the campaign will start. So obviously for Trump, the political cost of this exercise has become quite unacceptable. For Netanyahu, he'll also be heading into elections in October. But given that there is a blackout on the information coming out of Israel, there are penalties for broadcasting, taking photographs. We do not really have an idea of the extent of damage caused to Israel by the Iranians. So what will then be the threshold where Netanyahu will have to back down? And I think Trump can persuade him to back down, because this is Trump's call.
Well, that'll be interesting how it plays out between Donald Trump and Benjamin Netanyahu. But also, let's get Mr. Sen on this. Mr. Sen, one of the aspects that the oil markets had been watching is Donald Trump saying that, look, I want out of this situation. I'm not too bothered about the Strait of Hormuz. If somebody else wants the oil, go get your own oils. Though that was his exact wording used by the President of the United States. Again, is that something that the oil markets are now factoring in that brings in more concern, more certainty, or perhaps does it bring in more volatility?
I don't know how that brings in more certainty. I think all it does is essentially tells us that the US and specifically Mr. Trump seems to be basically trying to cut his losses. He has been trying, if you notice his pronouncements over the last couple of weeks, I think there have been increasing pronouncements where he has signaled that they're negotiating when Iran has denied it. He has signaled that, there are talks going on and this could end very soon. And then that has then reversed itself to, sort of threatening to blow up energy infrastructure and even civilian infrastructure in Iran if the strait is not opened. And now this sudden positioning that has come that, doesn't matter what the situation of the strait is, we have achieved our objectives and therefore we are pulling out. This is something I think that was discussed even earlier by commentators much more knowledgeable than yours truly, that, this war will, at least from the US's side, will end when Trump decides that he has won, irrespective of the reality on the ground. So in a way, this pronouncement is essentially that the strait at this point of time remains open to selective customers. We heard recently that Malaysian tankers, and Malaysia made that pronouncements, that they have been actually exempted from even paying a toll. There are 7 tankers of Malaysia that are awaiting clearance from Iranian authorities to basically transit the strait. They have been given a provisional exemption, given that they are considered an ally. And we've obviously had reports and we've had actual cargoes coming out from the strait belonging to India and China as well. So conditional approval probably continues to play, be in force. The reality is that instead of 100 ships passing through the strait, the current flow is about 10. And, until that is resolved, whatever positioning anybody makes is something that's based on just speculation at this point.
Sure. Mr. Sen, let me also bring in what Fatih Birol, the Executive Director of the International Energy Agency, had to say. His comments, he's of the view that the energy loss that we'll see in April will be much more than we saw in the month of March, and that's primarily on account of hits that the Gulf oil facilities have taken. Is that your assessment as well going forward, that this situation may just get more worse in terms of energy supply, even if the Strait of Hormuz is opened?
So you've got to consider that in March, what had happened was that there were some reserves that were there with most of the countries. There was some floating oil cargoes that people rapidly absorbed into the system. There were some strategic reserve releases. Some of it probably found its way into the market. Some of it might be still held in reserve. So, and there were obviously inventories that were lying with refineries, including with Indian refineries, for that matter. What will happen in April is probably that a lot of those reserves and natural buffers that were there may have gotten exhausted. And therefore, if flows do not really resume in a meaningful way, then you will probably see a much tighter supply market than you did in March. So I think to that extent, that I would probably agree with that assessment, that April could turn out to be worse than March unless a sudden resolution happens and the strait is reopened even to the extent of 30-40% of its flows.
So grim situation there. Ambassador, let me come back to you. One of the aspects that many analysts had been watching for was the buildup of ground forces in the region. There was speculation that Pentagon was considering possible ground offensive. So far, we've seen a few thousand soldiers being deployed in the region. Was that a bluff that was called by Iran, that a few thousand, 5,000 soldiers will be nowhere near enough to launch a meaningful ground offensive? Was that a bluff, or is that still on the table as a negotiating tactic at the very least?
Can I just add to what Prabal Sen said about oil? We'll have to keep in mind.
Please go ahead.
Asia is one of the largest importers of oil from the Gulf. And the other related point is the US, beginning around 2017-19, has emerged as one of the biggest oil and gas exporters. So we'll have to keep those two factors in mind going forward, because whatever losses will be coming out from the Gulf market, the US will definitely want to step in and shore up their take opportunities of that shortages. On the conventional insertion of troops into Kharg Island or Larak or seizure of the Hormuz, I think there is a at the beginning of this war there was an underappreciation of Iran's capabilities. I think this decision or whatever is being discussed or floated that they're going to insert troops into Iran, I think is really, really misguided. It's a large country. It's got more than 1 million people in arms. That is, you got paramilitary forces, you got the regular Iranian army, then you got the Revolutionary Guards Corps. So I think they know their territory. They are quite confident that any such move by the Americans, with whatever objectives, we do not know what is it going to be. Extraction of uranium from Isfahan. Isfahan is in the middle of Iran. How are you going to get there? Are you going to close the Hormuz Straits? You're within sight. It's about 18 kilometers from Iran coast, which is mortar range. So Kharg Island is basically a fuel pump. There's nothing there. It's 60% is just occupied by pumping stations. How are you going to secure them? I mean, you may seize control, but securing the islands, securing the straits, I don't think 2,000 Marines or 3,500 SEALs or special forces can fulfill that task. So I think it's a fool's errand, and it's really, really misguided. So let's wait and hear what Trump is due to announce later this evening. He's due to make a big statement, apparently. That's according to his press secretary. So we'll have to wait and see because he's looking for an exit, no doubt about it. And what the terms, he may just declare, like Prabal said, he may just declare victory and leave. And he said, control of the Hormuz is not for us. It's for the countries in the region to decide how they're going to control Hormuz. So we're getting conflicting, contradictory messaging from the Americans all along.
Right, Ambassador. Clearly a tricky situation. And in fact, adding to that matrix is a reportage coming in from the UAE, where the UAE seems to suggest that it is ready to force the Strait of Hormuz open, is ready to join the fight. So clearly Donald Trump may want out, but that may not mean the end of this conflict, the end of this situation. I'd like to thank both of our panelists for joining us and sharing their insights. With that, it's time now for heading into a very short break, but don't go anywhere. Coming up on the other side, we will discuss the impact of this conflict on Indian exporters, Indian MSMEs. That's up on the other side. Welcome back to this special broadcast on West Asia. Now, medium and small businesses are reeling from the impact of the West Asia conflict. Rising crude oil prices, gas supply shortages, higher raw material costs and working capital stress, along with logistical trade disruptions, are hurting MSMEs in a manner similar to the COVID-19 pandemic. Several manufacturing sectors, including metals, chemicals, glass and ceramics, are feeling the heat due to disruptions in gas supply. Businesses are not only facing production challenges, but also export-related disruptions. The Confederation of Indian Industry is urging the government to step in with relief measures for MSMEs. It has called for easing of customs rules to allow re-import of goods and reducing nominal warehouse charges to support exporters, among other measures. In addition, there is a push for a temporary moratorium for small and medium-sized firms. According to CNBC Awaaz sources, this moratorium could extend up to 6 months, with the Finance Ministry currently discussing multiple proposals, including a temporary suspension of loan repayments. And well, joining us now to help us understand some of these concerns facing the MSME and the export sector, we have with us a slew of panelists. We have with us from the ceramics industry, the industry that's coping, in fact, facing a lot of heat. We have with us Mr. Hiren Varmora, the Joint Managing Director of Varmora Tiles and Bathware. For a broader perspective on MSMEs, we're also joined by Mr. Anil Bharadwaj, Secretary General of the FISME. Mr. Bharadwaj, Mr. Varmora, thank you so much for joining us. Mr. Bharadwaj, coming to you first, can you tell us which are some of these sectors which are feeling the greatest amount of pain on account of these disruptions, whether that's cost pressures, whether that's gas supply? Which are the sectors feeling the most amount of pain?
Thank you for having me. Actually, the Middle East crisis is having impact on large number of MSMEs. Not only in terms of the input cost has increased for some, logistics costs have increased for exporters and for others, and working capital issues, particularly the squeeze that is there because payments are delayed and supply chains are sort of not functioning at full speed. The sectors that are affected particularly, first of all, are those that have been exporting to the region, exporting to Iran and other GCC countries. Many of them have been affected because their shipments have been in transit. Some of it actually was just waiting to be uploaded, onboarded when the problem started. And they faced a lot of difficulties. I mean, they could not get their goods delivered, forget about payments, and naturally, they were the ones that raised the issue of crisis-like situation before us, and that we took to the ministry. There we could get some respite. But actually, slowly and slowly, it is spread all over. Because, for example, take NCR region. So over the period of years, because of the Supreme Court decisions and NGT decisions, most of the industrial areas have been converted to, shifted from diesel and other sources of energy to green energy, especially piped gas. And immediately after 1 week of this conflict, they started getting the missives from the suppliers that the cost is being increased and also the supplies are going to be reduced. So it created the uncertainty.
Gas supply being an issue there.
Major issue.
Right, Mr. Bharadwaj? Right, Mr. Bharadwaj. So gas supply clearly being an issue. In fact, just yesterday we had with us Mr. Ajay Dua, the former Commerce Secretary, who had identified that certain industries at Morbi in Gujarat, the ceramic industry being one of them, was feeling a great deal of pain in terms of shortages of gas supply. In fact, to help us understand that better, we have with us Mr. Varmora, Hiren Varmora. Mr. Varmora, thank you for joining us again. Morbi is one area, ceramics is one sector which has hit the headlines in terms of feeling the most amount of pressure, especially on account of gas shortages. Tell us more about it. How severe is this pain being felt? Is it leading to closure of plants? How much pain are we seeing?
Hi, thank you, Vasmiji, for having me. Good evening, everyone. So basically, India is the second largest producer of ceramic in the world. We are contributing almost 14% of the world's production. And definitely, we have seen an impact because one of the major sources of raw material that we use is the gas. But in the whole event, if I may break it down to understand a little better, is that 40% of the factories were relying on the GSPC pipeline gas. And the rest 60% was dependent on the propane. So the downside of the propane was that the propane has a limited storage capacity, which is that every factory has a storage tank, and the maximum storage capacity is 3 to 5 days, let's say on an average. Whereas on the GSPC side of it, you have the continuous supply of the gas. So in between the whole uncertainty, there was two things. One, obviously, the crude prices were shooting up every other day, and everything was uncertain. And the second was the availability. So I think in the whole situation, in the middle of the March, collectively trade took up a decision that in the whole of the uncertainty, because propane supply was something that was impacted first, and the GSPC infrastructure was not enough to cater to the whole industry. So there was a collective decisions by the manufacturers to almost out of 800, 700 factories was closed down by almost the end of the March.
Sure. So with that pain being felt, I'm just trying to understand the context here. What I'm given to understand is that the kilns, which essentially power the ceramics industry, they need to be consistently fueled with LPG, that it can't be a day, it can't be a situation where they're running for 2 days and shut for one. That is a situation that can't work. So what happens with the situation that you currently have on your hands? Uncertainty in supply, is that leading to closure of plants? Is that leading to letting go of people, of workers?
Exactly. So as of now, the situation is that, I mean, without the fuel, it is impossible to run the factories. And the downside on the ceramic is you cannot close the factories for 1 or 2 days. Usually, on an average, the shutdown or the closure of the factory can lead up to almost 4 weeks, because the cost of shutting down and starting again is quite big. So usually, whenever a factory closes down because of any issues, let's say today at this point of time is the gas supply, and obviously the uncertainty of the prices as well. All the factories, majorly whoever shut down, they would be minimally closed down for almost, let's say, anything between 4 to 5 weeks any given day. So at this point of time, what happens is that every worker, the only upside is that right now 50% of the plants are operational, which meaning that the dispatches are still continue to happen. But the rest 50%, all the kilns are shut down. So 50% of the workers has been let go until the further notice by the manufacturers to restart the kilns.
Sure. Mr. Bharadwaj, let me come to you for a closing comment in terms of the reliefs that are required from the government. What are some of the recommendations that you've put on the government's table? Are you seeking for some form of moratorium in terms of payment of government dues, payment of interest dues? Is that something that's on the cards?
Actually, exporters and MSMEs have given various suggestions. Some are on the lines that similar types of measures could be proposed, as for example, were announced by the government during the COVID pandemic. So certainly moratorium was one. At the same time, because of the disruption in the supply chains, many MSMEs would not be able to fulfill their orders, especially that they have received from the different departments of the government. So they are also thinking that if some kind of a moratorium or some kind of extension could be given, 6 months extension could be given to such MSMEs. There are other things that are there before the government that they may take, can say, some time to decide. But in the meantime, RBI has given a relief that, earlier the MSME exporters, all exporters, were supposed to get the payments from abroad for the export supplies within 90 days. That has been increased to 15 months now. So I think that's a big relief. And similarly, 150 days, sorry. And similarly, insurance charges also, RBI has come out and, they have reduced the insurance charges. Ministry of MSME has also come out with a policy to reduce insurance charges. I think different departments of the government are working to alleviate the pains that MSMEs, exporters and MSMEs in general are experiencing. But one major issue that remains is the supplies, ensuring the supplies of the gas, because in the last couple of years, many MSMEs have really shifted to gas, and they are entirely dependent. And we have to find a way that how the relief could be given to them.
And one final question, just 30 more seconds, Mr. Bharadwaj. Is this perhaps a call to the broader industry to make that migration, like you said, to alternative forms of fuel, whether that's hydrogen, whether that's renewable? Is this something that you will be, as an industry body, be considering going forward?
See, going forward, I mean, so far as greening the energy is concerned, it's a way forward. But at the same time, this is also a fact that we have to see that whether we have adequate supplies within the country, because such disruptions are likely to be there in future also. We are living in a very tumultuous period of time, and by maybe overseeing this greening, we might be making our industry more vulnerable to such shocks. This is also a fact that we have to keep in mind.
Right, Mr. Bharadwaj, Mr. Vamora, thank you so much for joining us, for sharing those insights. But that's all the time that we have. It's a wrap on this special broadcast on the West Asia tensions. More news and updates will continue right here on CNBC TV 18.
Hello and welcome. You're watching On the Record with me, Shireen Bhan. It's been 12 days since the abrupt exit of Atanu Chakrabarti as the chairman of HDFC Bank. In his resignation letter, Chakrabarti said, and I quote, "Certain happenings and practices within the bank that I've observed over the last 2 years are not in congruence with my personal values and ethics," unquote. The bank's board said it had no indication of the issues involved. Mr. Chakrabarti's resignation also prompted the RBI to issue a rare public statement to allay fears of customers and shareholders. The RBI says it has found no material concerns on record as regards the bank's conduct or governance. Since his exit, HDFC Bank stock has fallen about 13%, wiping out nearly 1.6 lakh crore rupees in market capitalization. Joining us now for his first interview since his resignation is Atanu Chakrabarti, the former chairman of HDFC Bank. Mr. Chakrabarti, many thanks for joining us here on CNBC TV 18. Let me start with the 18th of March, sir. That is when you decided to put in your papers. Now, abrupt, sudden, there's nothing routine, quote unquote, in your words. You call your resignation routine, but there's nothing routine in the manner in which the resignation happened and what transpired post that and what you said in your letter. If I could start by asking you, what prompted you to put in your papers? What was the trigger? What was the tipping point? What was the final nail in the coffin?
Well, permit me to first thank so much for having me on your show. It's always a pleasure being here. Let me tell you, there is a bit of a background to it. I joined the bank as a part-time chairman, which is also seen as a non-executive chairman. And so both are very similar terms, similarly understood. And independent director on the board of HDFC Bank about 5 years back, slightly less than that. However, my name had been doing approval rounds with RBI before. So I had some opportunity to study the bank and felt that it needed to grow bigger and also improve its asset side. And so within a year, you had seen, and with the help of management and HDFC Limited, which was erstwhile promoter of the bank,
right,
that the bank went into a merger with its parent, which was one of the biggest mergers in the history of the bank. The very well executed merger as well, because however, as always, there are small and bigger flaws, which always remains, but that is okay. It went off well, which also improved the asset side. However, I have written in my letter that there are, it has to fully fructified. I will come to that later. Subsequently, the bank was also able to sell Credila, one of its companies, in a sense monetized it as per regulatory instructions. Subsequently, bank could also do the IPO of HDB Finance, one of the NBFCs under it, as per the regulatory guidelines laid down for the banks as well as for systemically important NBFCs.
Right.
These were all part of some of the actions on the business side, on the strategic actions during the time that I was in. Apart from setting up rather being a participant in, shall I correct myself, in setting up a good assurance setup under a very good teams who are able to do that. And also improve the governance structure. All those existed, but they needed better structuring and better flow of information to and fro between the committees themselves, and allow greater free-flowing discussions in the committees and the board so that the issues are discussed, addressed, spoken to, and good informed decision-making takes place, in which every director, whether executive, non-executive, or independent, participated wholeheartedly with varying degrees, naturally. So that was the background. And rest, as you asked my question that what happened? My resignation letter needs to be read in its entirety, starting with the first paragraph, which I elaborated further. Then I have also told towards the end that I have great faith in the verve and energy of the middle level management. That's what I always look at. Senior level will move on, but the middle level is very important. And that was where I see a great amount of energy, verve. They need to be channelized. Now that is how.
If I may, sir, it doesn't answer my question, because as I pointed out, you specified that there was a period of 2 years that you observed certain practices and happenings that clearly made you uncomfortable, that eventually led you to put in your resignation letter. Were these matters discussed with the board in any form or fashion? Did you raise your discomfort at the board level over the past 2 years in any form or fashion? And perhaps if those were not then adequately met, was that the cause for your resignation? I'm still trying to understand, as is everybody else, why did you put in your papers on the 18th of March?
Leave aside 18th of March. It could have been 19th of March as well. So leave aside the date.
I'm only going with the date that you actually put in your paper.
Yeah, that's even a month later would have had as much speculation as this because of a bit of lack of understanding in the larger domain about the word of value and ethics both. Now, if you see, my first term was largely covered grappling with the issues arising out of merger, which was very large, disbalances balance sheet, so on and so forth, and also preparing for meeting the regulators' conditions. Not that things were not happening during that time. But if we largely see that what are independent directors charged with, they have onerous responsibilities with respect to upholding ethical standards, probity, integrity, ensuring that management performs adequately, shareholders' wealth is maximized. They also have fiduciary responsibility with respect to depositors, which means that value terms, there needs to be a very high level of values with respect to honesty, integrity, transparency, fairness, and accountability, which translates for customer. And that's very important because for me, customer is the God, and I guess should be. That's what Gandhiji said, is that there has to be a long-term relationship of loyalty with the customer, not transactional. There has to be avoidance of risky practices which puts customer or depositor or anybody else dealing with bank at risk. Also that the bank contributes to the stability of the economy, improves credit growth. These are few of the conduct issues, and all these onerous responsibility ensuring that also lies, or rather largely lies with the independent directors. Therefore, that largely is the background setting. But you wish to ask me something there.
You've said a lot of things there, Mr. Chakrabarti. Let me try and unpack them. You said risky practices. Now, if I may ask you, was the bank indulging in risky practices that made you uncomfortable? If yes, did you raise that particular issue or those particular issues at the level of the board with the management?
Normally, I do not share any boardroom discussion. So, Shirinji, here also, I would not have shared any, except for one matter, which has come to public light by an interview by the CEO of the bank itself. Otherwise, I would sort of apologizing for not elaborating further. But just to elaborate, and if that throws any light, in the interview with the ET, daytime, that's Economic Times, Mr. Jagdishan, who has been the CEO of the bank for the last 5 years, with respect to the issues in Dubai, where the conduct issues with respect to customers, onboarding, and other things have been continuing from 2018, had come under both regulatory lens, both with international and domestic regulator. And they're all on record, so it's it's not that it's not known. And however, what he has said is that this was a technical lapse in documentation and regulatory interpretation. So it's seen as something technical. I feel if large number of customers are hurt, some amount of regulatory, or rather large amount of regulatory focus has come on the bank. It also brings reputational risk to the bank. Therefore, while the issues have been addressed, there has been involuntary separation of 3 senior management.
Yes.
That has been reported.
The termination, yes.
As well as 12 other people punished from major penalties to minor penalties. They are all at very senior levels. But they are a posteriori action. Something goes on for 8 years and suddenly we take an action. People will say that those are concerned, addressed, go home. Perhaps, and that's where I'll come to that. I feel that these conduct issues should not arise at the first place. Or the supervision, tight supervision, should ensure that even if they arise, they are nipped in the bud. However, if they are termed as technical, it leaves a little bit of a leeway. Perhaps they are experienced people, their reading may be correct. That's why I have not used divergence, I've used the word incongruence with my value and ethics. My value and ethics are very different from that. It's not that I am talking about values in a very rarefied atmosphere, that I have already elaborated deliberately before that, and nobody will deny that they are not needed for a DSIB-like HDFC Bank, and I take pride in being part of the bank for all these years. And, but that is where the incongruence took place. There are many other matters, and apart from that, underperformance with respect to the share value not performing up to the mark, which meant that shareholders' wealth was not getting maximized. Also, CASA was low, and cost-to-income ratio was high. A lot of people say, in the bank also I heard that chatter that it is because of merger. No, merger, if anything, was the best thing that happened. CEO himself has also mentioned on record. I'm in complete agreement with him. And that really didn't distort the balance sheet. And if at all, some distortion should have got corrected. Therefore, both underperformance, which is important for maximizing share, is a part of duty of the independent director, which comes out of the values and the ethical standards which we independent directors are required to uphold. And I was an independent director. So that was my dilemma.
Mr. Chakrabarti, again,
I'm sorry for being voluble on this.
No. I'm glad that you are being voluble in explaining to us what may have led to your resignation. If I may, do you believe that there was malign neglect or benign neglect?
As I said, my saying any of these things would amount to an insinuation. So I'll refrain from commenting.
Two law firms have now been appointed to look into this matter, so to speak, to assess, the governance structures, I would imagine, and the fallout of your resignation. Have you been in touch with anybody? Have they reached out to you in any form or fashion? And what do you make of this appointment?
Well, ideally, I shouldn't be concerned, but I read that in newspaper also. Otherwise, I'm devoting most of my time on reading the sports page of the newspaper these days. However, appointing a lawyer is more of a compliance requirement. Perhaps that may be an input that the board of the bank may be seeking. But what I mentioned, resignation is more a larger governance and governance plus kind of an issue, which the board of directors of the bank themselves should be introspecting and doing. No external lawyers would do that for them, apart from pointing out this meets the law, which doesn't meet the law, with a very strong four corners, or it met this audit para and it didn't meet that audit para. I don't know. That's not how things go. Lawyers could be appointed. I have nothing. I have no comment on to make on that. But that's essentially a compliance requirement which the board of the bank may have sought.
I come back again, Mr. Chakrabarti. You said in your words, this is a governance plus issue. Now, when you talk about a governance plus issue, as the chairman of the board, did you bring some of these governance plus issues to the notice of the board? Did you make them an agenda that the board needed to discuss, as you said, so that you don't act post-event, but you act pre-event and ensure that you don't follow the same pattern, in your words, that has perhaps transpired in many of these
Excellent question again, Shirinji. But kindly permit me to say this. Whatever has been discussed in boardroom, for me, remains in the boardroom unless brought by somebody into the public glare. I have discussed one issue to describe something, to say that how the differing conduct issues or ethical issues, the standards differ, and they may be correct standards on both sides. I may also be correct, they may also be correct. It's just an incongruence. And both of them may be meeting the requirement of the law at a given point. So that's not an issue. However, all that has been discussed, whatever has been discussed in the boardroom, I will not like to reveal at this stage by myself unless they come in public.
Let me end by asking you, Mr. Chakrabarti, do you regret having written this letter?
No. Why should I? Do you have any reason to ask me that question?
No, because again, I go back to the point that there are questions being raised, and some with some legitimacy, that you should have been more explicit if you were making a very sort of significant material statement, that there should have been some explicit time given by you to explain what you meant when you talk about governance as well as performance related issues.
I guess materiality or issues, they are subordinate to the larger matter that I mentioned, and what I mentioned was internal to me. As I had told you, that it caused dilemma for me. Whether it causes for the bank, its board has to address that. If it causes dilemma to me and I find it difficult to live with, I should move on. They feel it's okay, let it be done. So I guess for me, that's where the entire thing ends, because I've got over with my dilemma that, as I've explained to you, tried to explain to you at length. I don't know how clear I have been. However, the demand for certain amount of evidence to go with value and ethics, I guess we will enter into a very philosophical debate, which is better avoided for the given course of time. So maybe a separate primer with somebody else who understands these issues much better But as an individual who wanted to live with certain code, I feel that is how it is. And if the bank feels out there, and I'm not saying they have been wrong or anything. So it's no insinuation even intended or no malice intended. Let me put it this way, malice is intent. Insinuation is more material. So no. The rest, materiality and everything are very subordinate issues. And again, as I said, a posteriori.
So you believe that there is cause for concern for shareholders, depositors, customers, or do you believe that that the structure, practices are in place, and perhaps every large organization goes through some degree of pain and some degree of negligence, and it is manageable?
I would not like to comment on that part since I'm not with the bank. It would be unfair of me to comment and assure the shareholders of something for which perhaps now I don't have visibility or responsibility.
Ms. Chakrabarti, thank you very much for joining us here on CNBC TV 18, for giving us an understanding of what transpired and what led to your decision to resign ahead of your tenure ending at HDFC Bank, and why you believe that it's an incongruence of values and ethics that you spoke of, and explaining to us the dilemma that led you to make the decision that you eventually did. But appreciate you joining us here on CNBC TV 18.
Thanks to be on your show. It was a pleasure.
Thank you. With that, it is time for us to wrap up this edition of On the Record. From all of us here on the team, goodbye. Thanks for watching. with the CNBC TV 18 CEO Centimeter. I'm Shireen Bhan. The West Asia conflict rages on. President Trump blows hot and cold in the same breath, saying that he is confident that deal talks with Iran are progressing, that this is a much more reasonable regime, in his words, and in the same post also suggesting that if the deal talks fall through, there will be complete obliteration as far as Iran's infrastructure is concerned. All of this, of course, is keeping the markets around the world on the edge. Oil prices continue to trend higher, over $100 a barrel at this point in time. And in India, what we are seeing as a consequence of the fallout of the West Asia conflict is a warning coming in from the chief economic advisor in his economic review, saying very clearly that there is a significant downside risk to the growth estimate of 7 to 7.4% for FY27. We are going to see a trade deficit, and that will have an impact as far as the current account deficit is concerned. What will be the inflation number? That's the question as well. In fact, in my conversation with the former deputy MD of the IMF, Geeta Gopinath, she very clearly said that about 40 to 50 basis points will be shaved off global growth estimates if oil prices trend at about $85 a barrel through the year. And at this point in time, it looks like that number is going to be much higher. So let's get down to what industry is bracing itself for. The captains of the Confederation of Indian Industry are right off a very significant set of meetings with senior government officials to try and understand where the pain is being felt, where the pressure is being felt, and more importantly, what the road ahead looks like. Rajiv Mamani, let me come to you right off the bat. What is the sense that you get from government? How concerned are they? What is the sense within industry as well at this point in time? How much of the impact is already being felt? The mic is right there.
Firstly, Shireen, I think the government has been very, very engaged with industry on a very, very regular basis. So I think the good news is that the government and industry are completely in sync. And I think the proactivity with which the government has been dealing with this issue, we must credit them for that. I think as far as industry is concerned and government is also concerned, this is a really serious issue. It's starting to have impact from different, whether it's the raw material, it's the entire supply chain ecosystem that is shaking right now. So whether it's your raw material or some other material where someone else is depending, or logistics issue, which is equally big and very concerning. So I think there are issues around that, which I'm sure everyone's very familiar with. The 3 or 4 things where I think we are engaging a lot with the government. One is obviously short-term measures that need to be taken to reduce the pain that that is being faced, whether it's in the way the gas is allocated, immediate relief in some sectors from an allocation standpoint, relief that can be given from an MSME exporters credit standpoint, logistics issue that are being faced. So you have a bunch of short-term issues relating to financing, logistics, availability of feedstock and gas. Then I think the question is on the longer term issue, because you have big fluctuation in currency. Current account deficit is growing because of the energy imports. Remittances and foreign direct investments will be challenged given what's happening around the world. And we will have we'll have a challenge with the fisc as well for the reasons that I mentioned. So I think the government is very trying to see what are the steps that can be taken where we can ensure that some of this pain can be reduced, and also look at some of these things if they can be converted into opportunity going forward. So whether it is what areas can we encourage more for manufacturing, how can we move faster there, what are the areas where nudges can be given to attract foreign direct investment, where nudges can be given to ensure that the investment momentum that had picked up as far as private sector is concerned, that continues. And also what are the fiscal cushions that can be created so that the emphasis on capex that was there, that doesn't go away. So I think those are the sort of more medium term to long term policy engagements that we are having.
Okay, I'll address some of those long list of issues that you touched upon. But Mr. Mukundan, if I could come to you first, to Rajiv's point about the pain that is starting to be felt by industry. Gas allocation, of course, has been a cause of concern. Any conversation with the government on reviewing the current allocation, on whether we could expect more to be granted to certain sectors? Where is the pain being felt the most, and what is the impact of that already?
See, the pain actually is mostly in LPG, and in that also government, what they've done, they moved steadily in the last 11 days from 20% allocation to industry, almost 80% today. So I think largely the issues have been sorted out. There could be pockets which may have certain supply shortage, and I think that we are working with the government, especially to ensure that we can take care of those, what I would call specific shortage issues, which always arise in these sort of times. And rightly so, government has also pushed through a whole policy in terms of moving from LPG to PNG so that there's a greater availability. So that's on the energy side, but really speaking today, their supply side issue, they're grappling is about, they've been able to solve it about 60% of the demand. The rest has come through making sure the demand is going to the right sectors. That's how they've managed it. Going forward, I think we need to make sure that we work and engage to get the supply increase, at the same time conversion increase, and thirdly, getting the whole demand side program. What we have done as industry is to work out a framework of 8-point industry program, which is what industry should do, and also 20-point program for the government to do on an overall framework, not just limited to this issue. Because if you look at where is this issue going to hit us, as Rajiv has already highlighted, it's going to impact inflation, it's going to impact jobs, it's going to impact several other parts of the economy. And we have come with a voluntary industry pledge on what we will work on 8 points, which is fundamentally...
What are those 8 points?
We can go through each one of them, but I'm sure everybody will add the point. But fundamentally, for example, one of the key focus of the government is to ensure stability, both price and availability stability. I think industry is voluntarily saying, we will rise up to the occasion and maintain that. Employment security, we will rise up to the occasion and maintain that. So these are elements which are fundamentally for the longer term, because the supply shock is going to be for 8 weeks or 9 weeks, and impacts will be felt for 18 to 24 months. But we have to ensure that our long-term, medium-term direction is not affected by this whole events which have happened, which we are, of course, working our way through along with the government.
Mr. Munjal, let me address those issues with you. As we heard there from Mr. Mukundan, there is a 20-point plan that's been presented by CII to the government, and an 8-point voluntary plan that CII, as part of industry, is putting forward in terms of the measures that businesses will take. But what do you believe are the imperatives, the short-term imperatives that require prioritization today?
So my view is 2 parts to this question. One is the crisis is here and it's real. A lot of this has happened without any control that we have on this. What do we do to make the best of this? Use this as leverage to accelerate our own reform program, because this is happening on top of the rapid changes taking place due to technology already, which was causing apprehension and fear of job losses due to induction of artificial intelligence, etc. So we need to make sure that we can fix 2 or 3 things and build 2 or 3 for the future. If I go to the long-term ones, our fuel reserve, our crude reserves from 9.5 days, which we had, if we could up that and diversify our sources, look at the unconventional ones, look at Africa, look at Brazil, look at new routes, look at how we can create a long-term arrangement that Russian oil is always available to us. So one is on the energy side, because this is impacting all other sources of energy as well, by the way. Coal prices have shot up. Aviation fuel, I'm told from tomorrow, is been increased by 2.5 times by one supplier and 2 times by a second one, which is going to impact, again...
Operating costs of airlines will go through the roof on the back of...
Absolutely, and it's a very significant part of their cost. So we have a real set of issues that we need to handle. So operating efficiency is one of the ways that all of us will have to look inwards. We used to do this, 20 years ago, but India needs to become more efficient. Let's focus inwards. I think it's come time again to focus on the basics, look inwards, but at the same time, the work, as Rajiv said, that the industry is doing with government is where the real value will come from. providing things like additional support to research, encouraging startups to do more in the area of innovation, and give them some tax breaks. So it's not cash out of your pocket straight off, but it encourages the activities, encourages things like philanthropy, which are supplementing what the government does. Philanthropy has started, India has started seeing large organized philanthropy, but we don't have any tax breaks like many other countries do. So I think at this moment we need to widen the way we are addressing this issue. One, of course, is the specific ones we heard on gas supplies, etc., which is obviously urgent and immediate, because we know there are industries which have shut down. There are restaurants shut down which are not able to operate. So it's a real crisis for all of them. And many companies have had to scale down productions to by 30, 40, 50%.
Right.
So it's a real issue at this moment. They are working themselves on trying to find alternate fuels. And I think that in some sense has started to help. But it's not.
We have seen that diversification that you spoke of, and we've started to diversify where we're getting our crude from, and crude actually is not that big a problem at this point in time for India. It is LPG which is the big cause for concern. But CB, let's go back to that 20-point plan that Mr. Mukundan spoke of. Now, the CA acknowledges the fact, and Rajiv mentioned that as well, that fiscal space will need to be created. That's going to be one aspect that the government looks at. But what are the key measures that you're asking of the government as part of that 20-point plan that you've put forward?
See, so from the government, there will be asks, and this will evolve every day, every minute, the way it is. I think one of the things that we are really looking at are, which doesn't really stress the fiscal. Say, for instance, very simply, a moratorium, say, for instance, for our small, mid-sized companies, which faces many challenges at this point in time. Second, of course, easier way when we look at this, if we can work in partnership, when we look at transition, say, which is for ethanol blending, say, for instance, that's something that we could work together in a very strong way. The third part of it is, we see when we talk on diversification, our supply chain diversification, there is a lot of G2G discussions which could perhaps take place when we look at our different sources in terms of supply. I think that's something that we would need to look at, because this is not for today. I think what's happening is if we look at just only the day, we will miss the tomorrow, and therefore we really look at that to be seen. The fourth area, which has a lot of work has been already done. You see, there are lots of stuff even in the high seas at this point in time. We are looking at two areas. One is where anti-dumping, say, for instance, need to be very strong, and where in certain cases probably, and anti-dumping needs to be strong means anti-dumping needs to be hastened. In the speed in which it is imposed, it needs to be fast. And at the same time, there would be certain sectors where we would probably need to let things come in, because that would be essential, and we would probably need to dilute. So one has to calibrate these things very carefully. And another is QCOs have been of important advantage to us, and it's been done for quality. So we'll have to also see under this dynamic sort of a situation, how do we sort of navigate through it to make it easier for Indian businesses.